Alright class, and welcome back. Good morning. It's a fabulous morning for me because we are doing a one shot revision of not IDT but the entire income tax. So today's session is also being recorded and it will also be uploaded on YouTube, and this one is going to be a very exciting session because it will cover everything that we've done in DT so far. Today's entire 6 hours is going to be a revision, and this revision will end it. We will top it up with an RTP. So we will revise each and every chapter, section, etc. The entire DT gets revised. So whenever next you want to revise DT, all you have to do is start this video, watch it till the end, and you're done with the revision. When you see and revise this video, I'll tell you some bits how to use this video. I will be revising DT using a QuickBook. So I will be using a QuickBook which is provided in the link that you can see here on YouTube. I'll also put the link in the description so that you can access the QuickBook from there. We'll be using the QuickBook for the revision. Of course, while we do this, we will focus on exam questions, exam concepts, etc. And last, we will also solve the RTP of 2021. So you get an idea about what kind of questions are expected from you in DT in the exam. Guys, DT is 60 marks and this revision is going to be a game changer for all of you here. Of course, IDT revision we've already done. We've done a 3-hour GST revision which is also uploaded on YouTube. But this one is specifically, exclusively, wholeheartedly, only and only on direct taxes, that is income tax. So let's begin and cutting the ribbon, breaking that coconut, and with a very auspicious note, let's start. This is the updated link. Yes, this is the updated link. Don't worry, after today's class I'll update the link. But this is where you will find the QuickBook. Updates are very minor, so don't worry about them. Perfect. Let's begin, guys. Alright. DT, as you know, is 60 marks. Quickly recapping. You will first start with the MCQs. Any difficult MCQs like find out the tax liability of a person, which involves a lot of calculation, you will come back to. And then you will start doing the theory and practical questions. Question number 1, which is the 14-mark question, is generally very big, which we will do later. That is in the exam. You will do that question later. First, you will do the other questions like TDS, etc. And then you will go to question number 1. That's your exam strategy. What are the books you will study from? You will study from your notes. If you've been my student, you know you have notes. If you're not my student and you've gone to some other class, no problem. Whatever notes, whatever books they have given, you can stick to those. But you will revise using the QuickBook, and I would focus on the QuickBook one day before the exam, only and only on the QuickBook. And then you will do sums from every possible book, from your personal book, whichever your faculty has given. Good morning. From your book, which is the SMAT book, if you have the SMAT book. From the module, from the RTP, MTP, whatever you can find, whatever you can lay your hands on, you will do question after question. That's how you prepare yourself best for DT. And for every question, for every chapter, you need to solve at least 3 sums. You need to solve 3 sums per chapter. Perfect. And with that, guys, let's start DT. I'm going to go back to back on DT and I'm going to revise one after the other using the QuickBook. So I'm just uploading the QuickBook here. This, including rates of tax, everything will be covered in today's session. Perfect. This is the QuickBook being uploaded. You can use your notes and flip through your notes as well. Perfect. This is the SMAT QUIKBook. This is it. We are at the first chapter. Let's start doing this. Basic concepts and definition. Guys, in this first chapter, it is very important that you understand the basics. There was a story of the surgeon, his wife, children, brother and father, which you now know about. Why do you need to collect tax? Because we need to develop infrastructure, etc. Difference between direct and indirect tax. Direct tax is progressive. The more you earn, the more you pay. Indirect taxes are regressive. They pull you down. Direct taxes are paid directly by the person who earns it. Indirect taxes are paid indirectly by the consumers. Direct taxes, example income tax, and indirect tax, example GST. Next, levy. Ministry of Finance, Department of Revenue and CBDT are the main bodies which levy income tax. There's an Income Tax Act 1961. This is exactly, you will write it, Income Dash Tax, Act, 1961, and income tax rules which were next year because they forgot it, so 1962. The Act has sections, subsections, clauses, subclauses, and if there is any exception, they give a proviso. The Act is modified every year, and for your exam, guys, it's the Finance Act 2021 which is applicable. In case you're looking at what are the amendments made, we've covered most of them, but tomorrow's session will cover the amendments of the Finance Act 2020 also and 2021 as well. A bill is something that is not yet passed. Once it passes, becomes an act. CBDT issues circulars which are not binding for us. It is basically for the income tax department, so it's not so important, but the government issues notifications, and notifications are for all of us. Case laws are not applicable, therefore CA inter exams are not applicable, only for CA final exams they will be applicable. Next, who are the different persons? And these persons basically pay their own taxes, they file their own returns, they have their own PAN number. First is an individual, guys, minor individual, very very important. Minor individual, major, lunatic, deceased, all of these are individuals. HUF, you know, guys, HUF earns its own income, pays its own taxes, but from the HUF, when you get any income, are you taxed again? No, you are not taxed again. It is exempt if you remember the section 10(2). Next, firm and LLP. You can be a partner in a partnership firm or an LLP. Good morning. And when you're a partner in a partnership firm or LLP, and the partnership firm pays its own taxes, files its own returns, so when you get share of profit, it is exempt under 10(2)(a). But remember, partners getting salary and interest is taxable, but under PGBP, if you remember that. Yes, Indian company, once you're registered in India, you automatically become an Indian company. So Reliance, Kotak, ICAI are all Indian companies, and Indian companies have to pay taxes in India. Yes. But once they declare dividend, that is again taxed. Yes, that is again taxed. Why is that happening? Because they feel company is a separate legal entity. AOP and BOI, association of person, means any people like the surgeon and the hospital coming together to do a vaccination camp is an AOP. Body of individuals is only individuals, and they've come together automatically, not because of any purpose. Example, 3 friends, they get a house, the 4th neighbor has named a house after his death to the 3 friends, so the 3 friends earn some rental income. Local authority is like a municipality, and that's the first page. Next, AJP is like a trust, a Siddhi Vinayak trust, a Tirumala trust are all examples of AJPs. Just one second, just checking if it's being recorded perfectly fine. Yes. Alright. And next, each of the above persons pay their own taxes and have their own PAN number. Beneficial interest, guys, comes before B comes first, so 10% shareholding or 10% participation in the profit sharing, and substantial interest comes later, S comes later, so 20% or more equity share capital or profit sharing ratio. Assessee is a person who has to pay tax. Financial year starts on 1st of April, ends on 31st March. The previous year is the year you earn money. Assessment year is a year you pay your taxes. Calendar year is basically December to Jan, which is not important. In case of a new entity, from the date you start till the end of the year is the financial year. So basically, if I start today, that is the 16th of February, then from 16th of February to 31st March, that is my financial year. Next, assessment is discussed at CA final, not right now. Guys, whether it's regular or casual income, both are incomes. Whether I make one movie in 1 year or one movie in 4 years, both are incomes. Diversion of income, whether you apply income, how you divert, it's not taxable. But when you apply, that is your problem. So application of income is taxable. Example, if I get salary and I use salary to feed dogs on the street, that is my purpose, that is my application, so it will still be taxable, the salary. Illegal income is also taxed if it's found out. Income is taxable on due on receipt, whichever generally are depending on head of income. Guys, in PGBP and IFOS, you can follow whichever method of accounting you want, cash or accrual. But in salaries, in capital gain, and in IFHP, you cannot follow method of accounting. They have told you how to be taxed. Income versus capital receipt. A loan is not an income. Pin money is given to the wife or to someone in the house to run the house. That is not income. And in case of reorganization of business, example, a partnership firm gets converted into a company, that is reorganization, that there is no income tax on that because it's just changing the nature. You're just changing your clothes. What are the steps to calculate tax payable? Very, very important. First, you determine the legal status. Legal status means whether you're an individual, whether you're a partnership firm, LLP, company. For your exam, individual is the most important. Then you determine the residential status, whether you're a resident, non-resident, happy, unhappy. Then you determine the scope of income, which incomes are taxable. Then you compute the 5 heads of income, which are basically, first is salaries, then is house property, then is PGBP, then is capital gain, and then is IFOS. And then you go to clubbing, then you go to set off carry forward, then you go to GTI. From your gross total income, you minus the deductions under chapter 6 here, you get your total income on which you calculate tax, and you pay it using TDS TCS Advance Tax, self-assessment tax, and you finally give a report card to the government saying that this is my return of income. Rounding off, guys, some rates of tax also has been done here only, rounding off, 288A and 288B. There are only two places where rounding off happens. First is total income, not gross total income, only total income, where you ignore anything in paise. So if the total income is 7,62,826.52, 52 will be ignored, and the last digit, if it's 5 or more, it will go to the next one, that is 7,62,830. Same rounding off happens also in total tax payable, not basic tax, not surcharge, not cess. The final total tax payable will be rounded off. Same way it will be rounded off. Guys, this is your first chapter. While we're doing this, we'll also look at other chapters, but guys, one by one, back to back, we will finish all the chapters, and then we will also look at the RTP. That is your first chapter, done and dusted. Perfect. Let's move ahead to the next chapter. Here it's residential status. Ideally in your books it should be agriculture income, but whatever comes our way in the QuickBook, we will revise it. Next is residential status. Guys, difference between a resident and a citizen. Your passport is your citizenship. So if you have an Indian passport, if you're born in India, then you're an Indian citizen, but resident is where you stay, how much you stay, that becomes your resident. So citizen is more of a permanent concept. Resident is something that changes pretty often. Resident in India, guys, is unhappy. Why is the resident unhappy? Because he's taxed on the global income. So if you're a resident in India and you have a house in UK, even UK will tax it, yes, and even India will tax you because you're a resident. So hence double taxation. How to get relief, we'll see at CA final. A non-resident is very happy. Why is he so happy? Guys, because he's only taxed on the India connection income or the India centric income, which we have a shortcut, you and me, called dear income. What is this dear income? D is basically deemed to accrue or rise in India, which we will very soon see. What is D? E is earned in India, A is accruing in India, and R is received in India. Basically means if there is an India connection, the government wants to tax it. This is called dear income. Excellent, Vaishnavi. The surgeon's brother was a non-resident. He was only being taxed on the dear income in India. So that is your residential status, dear income. So actually this is scope of income. And scope of income is given under section 5. Only these incomes will be taxable. For an Indian resident, everything, and for a non-resident, only dear income. Moving on to the next page. Income it is earned in India, accruing in India, or received in India will be taxable in India. But remember guys, only the first receipt. In the exam, they will give you a question that in this year you've earned some salary which is later on remitted. Will it be taxable? Yes, because today they are talking about earning the salary. Later on, will it be taxed again? No, later on will not be taxed again. But we are talking about today. So today, will it be taxed? Yes, it will be. Receipt versus remittance. Receipt basically means the first receipt when you receive it the first time, and remittance is basically when you send it back to your country. Guys, remittance is never ever taxed. This is a table of scope of income, which is okay, not very important because you already know dear and non-dear. Guys, only thing between a RNOR, that is a resident and not ordinary resident, and a non-resident, the only difference is one. This is tax on dear income, and this is tax, excellent Vaishnavi, on dear plus 1 income. What is that plus 1? That is income earned abroad but controlled from India. So if you are earning some income abroad but they are controlling it from India, that we will tax it in India. That is the plus 1 income. Alright. RNOR and NR are very close to each other, except this one income which we've already spoken about. And in case of non-resident, salary received for services rendered outside India, seafarer, even if received in the NRE account, will not be included in total income. Let me explain this. Guys, if you're always on the sea, you're a seafarer. Who's a seafarer? Someone who's always on the sea. Then you're a non-resident because you're not in India for so many number of days. But then where is your salary coming? Your salary, it has to come to some account. So it comes into your NRE account. But that is an exception. That will not be considered as received in India. That's only and only for seafarers. It's a small exception. Watch it. This is ICAI illustration number 5. This is a May 19 question for 7 marks. Guys, we've done all the questions, but still, as and when questions come here, we'll try and do them. So I'm just going to go to the start of this and just try and show you how do you revise actually. In reality, whenever an exam question comes, you will go to the exam question and you will answer it. So here is how you will solve this. Whenever you come across an exam question in the QuickBook, you will go to the exam question paper. And you will go to that respective question. And you will solve it. This is the question for 7 marks. This question talks about whether incomes will be taxed in the hands of a resident and ordinary resident and resident and not ordinary resident. That is global income and DIR plus 1 income. This is where you will go and solve it. Income from a business in India, taxable. Controlled from London, doesn't matter guys, because for ROR everything is taxable. Same way you will do the entire sum for ROR. It's very simple. For RNOR, it is only DIR plus 1 income. So please keep in mind DIR plus 1 and only solve for DIR plus 1. Guys, this is typically how you will solve using the QuickBook. I'm not going to go through the questions right now because we will go to RTP questions at the end. But this is typically how you go through the QuickBook. Alright. Moving now to the next concept here. So this was scope of income. We'll discuss deemed income very soon. It will come here in the QuickBook, deemed income also. But right now it's section 6.1. Residential status of individuals. Guys, how are you an individual resident or not? This depends upon section 6. So section 6 deals with residential status and it had 4 sections. 6.1 is for individuals, 2 is for HUFs, 3 is for companies and 4 is for all others. Let's first start off with section 6.1. Every resident, whether it's you, whether it's me, whether it's Narendra Modi, is asked the first basic condition that stay in India, is it greater than or equal to 182 days? If yes, then congratulations, you're a resident. But if no, we don't give up so easily. We will go to basic condition 2. But while we go to basic condition 2, so when you solve question paper, I've already solved all the question papers. So abhi we've already in the last few days, we've solved all the question papers right from December 21 to May 19. Alright. So guys, while we're discussing this, basic condition 2, when you're going to basic condition 2, you will stop and ask 2 things. Basic condition 2 does not apply to the following people. Who are these people? An Indian citizen or a PIO who's visiting India. Indian citizen, you already know what is a PIO. PIO is someone whose parents or grandparents, whether your parents or your grandparents, mom's mom and dad's dad and dad, anyone was born in India, including in undivided India, then you're a PIO. Then to these people visiting India, no basic condition 2. And to an Indian citizen who's left India for employment or joining a ship during the year, if he's left India, then no basic condition 2. So this one will not apply to basic condition 2, will not apply to these people. Next, moving ahead. Once you know if the person is a resident or non-resident, once you know a person is a resident or a non-resident you will not disturb, but residents you will disturb, and you will ask them 2 additional conditions so that you can figure out whether they are RNOR or NR or ROR, sorry. So there are 2 additional conditions, additional condition 1 and additional condition 2, which are here. Additional condition 1 goes back 10 years. And they say in the last 10 years, at least greater than or equal to 2 years, you were a resident. That means you fulfill either basic condition 1 or basic condition 2 for at least 2 or more years in the last 10 years. And in the next one, basic and additional condition 2, they go last to the 7 years and they ask you, have your stay in India been greater than or equal to 730 days in the last 7 years? If both of them are yes, only then you become a ROR, otherwise your RNOR, DIR plus 1 income. Stay in India includes stay in the territorial waters, and when you arrive as well as when the day you leave, both are to be included in the calculation of stay in India. However guys, if you joined a crew of a ship as a crew member, then you have a continuous discharge certificate, CDC. In that is an exception. The date you leave and the date you arrive are not to be included in the calculation, so that is an exception. ICAI illustration. Guys, Finance Act 2020 brought 2 amendments as under. That's the second page or the third page also done. Here, Finance Act 2020 brought two amendments. For these two amendments, first, what is important, either Amendment 1 or Amendment 2, whatever is the case, you need to now see that these amendments apply only if the Indian income, that is dear income, is greater than 15 lakhs. Let's see the first amendment. The first amendment says that if you're an Indian citizen or a PIO who's rich, that is Indian income greater than 15 lakh, then the basic condition 2 will apply, but 60 days will be replaced by 120 days. Basic condition 2 is stay in India greater than or equal to 60 days, and last 4 years stays greater than or equal to 365. Everything remains the same, just replace 60 by 120 days. And if this is yes, then you become a RNOR. This is only to increase the population of RNOR. And additional condition 2, guys, is only and only for Indian citizen. If you are an Indian citizen and you are rich, that is Indian income greater than 15 lakh, not greater than or equal to, only greater than, then they want to not make you feel lonely. If you are not taxed in any country as a resident, don't worry, we will tax you in India as an RNOR. So both these amendments, the intention was to increase the number of RNORs only. Yes. Moving ahead. So when will you solve IDT QuickBook? I've already done IDT QuickBook. IDT QuickBook has been solved abhi and uploaded on the GST or on the YouTube also, and it's recorded here as well. So please watch out. Just go to my YouTube channel and just look at one of the last few videos, that is the GST QuickBook. Alright. Next, guys, this is residential status of individuals. For residential status of HUF, it's pretty simple. You have to see where is the control and management. If the control and management is fully in India or partly in India, that means any India connection, then you're a resident. And if it's fully abroad, only then you're a non-resident. And once you're a resident for HUF also, and only for individuals in HUF, you have further bifurcation between a ROR and a RNOR. The same two, additional condition 1 and additional condition 2, will be asked to the Karta. If the Karta answers in yes to both, then the HUF is a ROR, otherwise it will be RNOR. This is residential status of an HUF. There's a ICAI illustration number 4. Guys, you will keep using the module whenever you revise for your exam. Before that, you will keep these QuickBook with you and then open the module and solve these questions as and when they come on the screen. Section 6.3 is for companies. Very, very simple, guys. Indian company is always and always a resident, so you don't have to think much. Yes. But a foreign company, their residential status will depend on something beautiful they write. So foreign companies write beautiful poems. So depending upon their poem, where they've written the poem, if the poem is written in India, then resident. If the poem is written abroad, then a non-resident. That is section 6.3, residential status of companies. Not very important from CA inter perspective. And last, for all others like partnership firm, LLP, AOP, BOI, AJP, it all depends again on control and management. Same thing like HUF, yes. Only thing is they were not bifurcated into ROR and RNOR. This bifurcation is only for individuals and HUFs. Perfect. Now section 9, deemed income. Important, yes, because it's getting a lot of importance these days in the exam. So what is section 9? Section 9.1 actually says that India and the foreign countries have some argument about 8 incomes. I, S, S, D, I, R, F gifts. On these 8 incomes, India says, listen, all these incomes are being earned by a non-resident, but I don't want any argument, I will tax it. So they take this income and they tax it. This is 9.1, 1, 2, 3, 4, 5, 6, 7, 8. So you will remember the section, subsection and also the clause because of this sentence ISSD, IRF gifts. If a non-resident is getting a gift in cash, not in kind, of more than 50,000 from a resident, then we will tax the non-resident in India. This income will be deemed to accrue or arise in India. This is gifts. If a non-resident is earning some interest from India, some royalty from India, or some fees for technical services, interest, royalty or fees for technical services from India, then this interest, royalty or fees for technical services, FTS, will also be deemed to accrue or rise in India, but there are some conditions. If it's paid by the government of India, you will not check territorial nexus, but if it's paid by a resident or a non-resident, then you will check whether it is used for a business or profession or an income generating activity in India. So basically only if it's used in India, we can deem to accrue or rise it in India. The usage has to be in India, and one exception for interest. In case of interest paid to a non-resident by a non-resident, it has to be used in India, but the usage has to be only for business and profession, not for income generating activity. So if Bill Gates pays Elon Musk some interest and uses that money to invest in shares in India, that will not be deemed to accrue or arise in India. Next, dividend paid by an Indian company. So if a non-resident is earning dividend paid by an Indian company, that will be deemed to accrue rise in India. Very, very important. There is an Indian citizen who is working abroad in the Indian embassy in France, and the government of India is paying some money to them, salary. That salary will be deemed to accrue or arise in India. Besides the salary, guys, that Indian citizen is also paid 7 allowances. If you remember, that is exempt under section 10(7). Next is salary for services rendered in India. These are the Japanese metro employees. If you remember, these Japanese metro employees came to India and they did some work in India. So they rendered services in India for which they're getting some salary. This again will be deemed to accrue rise in India. And what is this I? This is income from the following things. So here it is 911I. Income from 3 things. Very, very important. One is income from business connection in India. What is a business connection? OnePlus China does not have OnePlus India Private Limited because they will be taxed in India and they don't want that. So they have a business connection, like they have an agent who is a dependent agent. Yes, that agent can conclude contracts, negotiate contracts, or secure orders for them, sell goods for them, stock goods for them. He does all of them, all of the work that OnePlus India would have done. So hence this agent is considered a business connection, and OnePlus China's will be taxed in India on this income from this business connection. So if this business connection in India sells phones worth 1 crore rupees, 1 crore will be taxable in India. But guys, business connection, don't worry, a lot of foreign companies got really anxious about business connection, so they have some exceptions to business connection in India, and the exception are India exports news, movies and diamonds. Very, very important. So only India centric income will be taxed for OnePlus China, not the entire global income will be taxed in India. Any purchase for the purpose of export will not be taxed in India, don't worry about it. Next, any news, collection of news and views like BBC India has some correspondence in India, those will not be considered as business connection and taxable in India. If you're shooting the next Slumdog Millionaire in India, a movie being shot in India, don't worry, that is not a business connection. And showcasing diamonds in free trade zones, special economic zones is not a business connection. So don't worry, foreigners, come to India. We're not going to tax all of y'all. Only if you have a business connection in India, we will tax you. But guys, companies like Netflix got smarter and they started, these are called digital companies, and they, instead of having an agent, were having an app in India. And they were getting a lot of money through the app. So we introduced a concept called significant economic presence. We said that, listen, foreigners, non-residents, if you have significant economic presence in India, if your little bit presence is okay, but if your presence is significant, is very important for your exam, it will definitely be there. That's my prediction. SEP. If you have a significant economic presence in India, then we will tax you in India. What is significant economic presence? Either your turnover in India is more than 2 crores, Netflix, or your users in India are more than 3 lakh rupees, any of them, then you have significant economic presence and we will tax you. This limits have been recently introduced, so very important from your exam perspective. Also guys, income from any capital asset in India. Example, if you have a land in India which is sold, or a property or source of income in India, in all these cases, it will basically be deemed to accrue or arise in India. That is section 9(1). We've just completed the huge section 9(1). It goes on and on here, 9(1), 1, 5, 6, 7, 8. But remember ISSD, IRF gift, and you'll be okay. Perfect. Guys, here is dividend income. We have not discussed this, honestly. It is something that we will discuss tomorrow in detail, but I'll just tell you it's very, very simple. I actually skipped it with the Unacademy batch, but the others know it. Guys, whenever dividend is declared by a company, obviously you know it is taxable in your hands. But when is it taxable? So let's say a company declares dividend today. Today is the 16th of February and a company declares dividend. And if it's the final dividend, then final dividend, the moment it is declared, it is taxed. So which year will it be taxed? It will be taxed in the year 21-22. That is this year. Final dividend whenever it is declared FD. That's the shortcut FD. But what if after 2 days, that is 18th of February, they declare an interim dividend? Now interim dividend can also be cancelled, and hence the government says we will tax it only when it's received. And let's say it's received on next year on the 5th of April, then it will be taxable next year. So interim dividend is taxed when it's received. This is a very small thing. Final dividend is taxed when it's declared only, but interim dividend is taxed only when it's received. This is your interim dividend taxable in the year in which it's received, whereas final dividend taxable in the year in which it's declared. This is given in section 8. So guys, this chapter we've done section 5, scope of income. We've done section 6, residential status. Section 7 is not there, and straight section 8 we've done. So these are the 3 sections that we've done in this chapter. Congratulations, one more chapter down. Jan 21 paper which we've already solved. ICAI questions, ICAI illustrations. Guys, whenever you're doing a full-fledged revision, make sure you're also doing these questions from that particular book. Now guys, a very very happy chapter which is agriculture income. In agriculture income, guys, this happy chapter, let's see what is happening. The surgeon has a piece of land. On that piece of land, guys, agriculture is also there in GST, so be careful about agriculture. Here he is growing and he has also a farm building. He also has a farm building. If you remember this diagram, he also has a farm building where he stays, where he stocks goods, stores, etc. Now guys, India has a very very generous heart towards agriculture. The first section 10.1 says agriculture income will be exempt, but this one is a rural agriculture land. Basically this is an agricultural land in rural areas. Now in rural areas everything is exempt. Cultivation of this land and selling the sugar or selling the wheat etc. will be exempt. Renting this land will also be exempt. Basic operations on this will be exempt. Income from seedlings and saplings, if you grow that also in a nursery also, that is also exempt. Income from farm building is also exempt. Growing flowers and creepers is also exempt. Basically everything is exempt, but has to be agriculture. Guys, pisciculture, sericulture, animal husbandry, all that is not exempt. Only and only agriculture income is exempt in DT, but in GST everything else is also covered. So remember, that's the difference. In DT only and only it has to be agriculture. So if you're doing dairy, is that exempt? No, dairy is not exempt, but has to have some linkage to agriculture. Next, guys, difference between urban and rural agriculture land. If it's an urban agriculture land, everything is the same except 2 things. Now that you're in the urban area, if you sell the urban agriculture land, this will be taxable. Remember, the sale of rural agriculture land was not agriculture income, but still it is not taxable. Remember this line, rural agriculture land sale is not taxable income. It's not agriculture income, but still it is not taxable. But urban agriculture land, 2 things change. Urban means now you're in a city, so if you sell the land, it's very valuable, hence the government wants to tax it. And also income from the farm building. Whatever be the purpose, even if the exam says it's used for agricultural purposes, even then income from farm building will be taxable. So both these 2 things change between rural and urban agricultural land. Now what is urban, what is rural? Whether I'm staying in Mumbai right now, is this urban area or not? How do I know? They have given a definition. They say if you're staying in a place which has a population of more than 10 lakhs, then that entire municipal area plus 8 kilometers. This till here, till 8 kilometers aerial distance, that is also urban areas. After that is all rural area. Yes, after that is all rural area. Next, if you're staying in a place which has a population of more than 1 lakh, but up to 10 lakhs, then in that case, up to 6 kilometers, guys, up to 6 kilometers. If you're staying in a population which is more than 10,000 and up to 1 lakh, then in that case, up to 2 kilometers. And if you're staying in a place which has a population of up to 10,000, that is a very small town, then only that municipal area. So these are basically the urban area definition. Up to 8, up to 6, up to 2, and on that periphery of 10,000, up to 10,000 population. These are urban areas. Anything in that is urban. Anything on that is also urban. Only outside that is rural area. Please remember difference between urban and rural. Guys, the following are not agriculture incomes. Income from breeding of livestock, Income from poultry, income from fisheries, income from dairy are not agriculture income. In DT they are not taxed because income tax cannot be so generous, and hence all these are taxable. I'm giving an example. You have some income from growing grass which is used to feed cattle, and that cattle is used for agri purposes. Is there an agriculture connection? Yes. So in that case it will not be taxable. This will be exempt. Guys, in the exam they could also ask you another question. You've received dividend from an Indian company. You've received dividend from an Indian company, and that Indian company is into agriculture operations. Is that dividend exempt? No, that is not exempt, guys. Please, they are only trying to confuse you. This is a classic confusion question in the exam. So if dividend from an Indian company which is into agriculture operation, doesn't matter. As long as you are directly involved in agriculture, only then it is exempt. Alright. In agriculture income, we always knew, guys, that things are exempt, but there is a scam of partial integration or a scheme of partial integration. What is that? So scheme of partial integrations, first step is they shock you. They take your agriculture income plus they take your taxable income and they tax you on that. So yes, if agriculture income is, let's say, 9 lakhs and your taxable income is, let's say, 6 lakh, so they will tax you on the entire 15 lakhs. Why? Because they want to shock you. In the second step, they calm you. They take your agriculture income and they take your basic exemption limit and they calculate the tax and they minus this. And step 3 is the tax that you pay. That is step 1 minus step 2. Now, why have they done this? First taxed me and then minus it. They wanted to do something. They've used your agriculture income to push your non-agriculture income into a higher tax slab. This slab was only 20%, but because of 9 lakh pushing 6 lakh into 15 lakhs, it goes in a 30% tax slab. So the exam will not tell you about it. You will have to identify. So when does a scheme become applicable? On the fulfillment of these conditions. First, you should be someone who enjoys basic exemption limit. So basically you should be an individual or an HUF or an AOP, BOI or an AJP. If you are one of these that is enjoying a basic exemption limit, then the scheme might be applicable. And also your agriculture income should be more than 5,000 in that year and your taxable income should be more than your basic exemption limit. These conditions if fulfilled, only then your scheme is applicable. So again, only for these people who enjoy basic exemption limit, agriculture income should be more than 5,000 net agriculture income after minusing expenses, and total income should be more than basic exemption limit. The scheme is this. This is a part of rates of tax. Remember, there's an illustration 3 and 2 questions of ICAI on this concept. Guys, moving ahead to composite income. Composite income is a mix of both. Guys, I have recently started a new batch just yesterday, which is hybrid model, which we are doing online also and offline also. Same way here, it's composite income, which basically means those activities which are both PGBP also and agriculture income also. What are these? There are 4 such activities. First is rule 8. Rule 8, because we have 8 cups of tea in a day, 40% in that is PGBP income. So if you are given a tea business in the exam, if let's say they give you tea business, 10 lakh rupees is the income from tea business, 6 lakh is the expenses, you will minus it, you will get 4 lakh rupees, and this 4 lakh will be split into 40% which is taxable and 60% which is not taxable because agriculture income. Next is rule 7b, is for 7 cups of barista, 7 cups made by a barista. This is coffee, again 40%. But if the coffee is only and only grown and cured, nothing more, no more grounding, roasting, etc., then only and only 25%. That is rule 7b. And rule 7a is for rubber. In rubber it is 35%. Guys, remember the PGBP because that is taxable. Agriculture income is not taxable. So this is basically a presumptive. Yes, this is almost like presuming your 25, 40, 35%, etc. is PGBP income. And last is, guys, if you have a farm where you grow sugarcane, this is your sugarcane farm, and if you have a factory which does manufacturing of sugar, then in that case you have to be very careful because sugarcane is sold to the sugar factory. Now what price is this being sold? It has to be at market value. That means you cannot artificially inflate, because here you want higher profits, so you'll put a higher selling price, and you want lower profits here because this is business taxable, so you'll have a higher cost. You can't do that. You have to do it at market value. So if sugarcane's market value is 10 lakh rupees, this will be 10 lakhs. This will be in your sales, and same 10 lakh will be a cost to the sugar factory. So please ensure that's at market value and both these amounts are the same. One person's income is the other person's cost. This is because you own both of them. If this was a third party, then it does not matter. Only if you are doing both of them, then this will matter. Guys, this is another chapter done and dusted, agriculture income. Guys, we are now looking at the next chapter, which is called exempt income. A very, very happy chapter, because exempt means you're not going to be taxed. So I'm just going to take a 1 minute breather and then we will continue with exempt income. Alright, so let's start, guys. The next chapter is exempt income. Very, very happy to start this chapter. Exempt income is a very happy chapter always, because they are earning income but they are not taxed. In the exam, they will give this income somewhere throughout the chapter, especially share of profit from a partnership firm. Exempt income does not come in E for exempt, E for exclude. It does not come in your computation only, whereas deductions are there in your income and you minus them after GTI. Section 10.2, 10.1 we've already finished. 10.2 is share of profit from an HUF. So share of income from an HUF is not taxable because HUF has already paid tax. 10.2a is share of profit from a partnership firm. The partners will be exempt when the share of profit comes to their hands. But remember, salary and interest is taxable under PGBP. 4.2% interest in an NRE account. So if you are a non-resident and you have an NRE account, then that is exempt. Guys, even if you come back to India on that money, it is still exempt. Don't worry, they will confuse you, but don't worry, NRE account interest is always exempt. 10.6.2, remember guys, we tax our people. The Indian embassy in France, we said we will tax our people under section 913. Same way, the foreign embassy, the foreign France is saying that they have 62 people in India which they want to tax, so we have to exempt them. But remember, this is only if they are foreign citizens. So Indian citizen, the salary although earned and received in France abroad will be deemed to accrue rise in India. So we had an arrangement with them. Same arrangement they also have with us. Next, 10.6.6, this is not there for your CA inter exam, so I'll remove it. 10.10BC, guys, big catastrophe. If there is a flood, earthquake, etc., and you get some money, that income is exempt. 10.10D is absolutely important, guys. 10.10D. What is D? D is death. If you get some money from an insurance company on the death of a person, it is exempt. If you get some money from an insurance company when the premiums are low, it is exempt. What is low premiums? Low premiums depend upon when the policy was taken. If it is taken before 1/4/2012, then low premiums were 20%, and after that low premiums are 10%. All the premiums have to be low, only then it will be exempt. For a handicapped person, this has changed from the 1st of April 2013 and it became 15% from 20%. Remember, all premiums have to be low. Even if one of the premium is high, it will be taxable. Next, Keyman insurance, guys, is another insurance policy, but Keyman insurance is always taxable. It does not subject to 10.10D. 10.11A, guys, in the envelope for the girl child, there was 11 rupees which they collected and they put money in the Sukanya Samriddhi account. and when you receive money from that account, that is exempt 1011A. When you put money, that is an exempt deduction you get under 80C, now that you know 80C as well. 1012A and 1012B, guys, national pension scheme is supposed to be for retirement. If you remove money in between 1012B, the government gets upset and they said whatever you removed, we will only exempt 25% of that withdrawal. So 25% of the withdrawal will be exempt. But if you withdraw after that, then 60% of the total amount will be exempt. All right. Sorry, my bad. When you withdraw in the middle, 25% of your contributions, only your contributions will be exempt. Whereas if you remove money after, A is for after, then in that case 60% of the total amount will be exempt. So here they are encouraging you to withdraw later. Next, 1015, guys, 15% interest is given by post office account. In your post office account, that's a joke, only 3,500 rupees is exempt. And if it's a joint account holder, then aggregate 7,000 is exempt. Remember, guys, exemption, this is exemption. Besides that, do you also get TTA? Yes. And you also get TTB? Yes. So remember, those will also get, but first you will get exemption and then only deduction. 1016 is at 16 years you get some scholarships from notified scholarships, not everyone. 1017 is 17 allowances to MPs, MLAs, etc. are exempt. 7 allowances and 17 allowances, remember that. 1017A is an award you get, like Bharat Ratna, etc. All those are exempt. 1018, 1019 award winners, gallantry award winners, when their family gets pension, that is exempt. 1019 at 19 years, soldiers lose their lives, when their family gets pension, that is exempt. 1026 AAA, above, if you remember Sikkim, then Sikkimese individuals when they get any income from Sikkim, that is exempt, plus dividend and interest from anywhere, that is exempt. Dividend and income can be from anywhere, guys. 1032, which is a funny exemption. If your minor child's income is being clubbed in your hands, then you will get an exemption of 1500 per child whose income is clubbed, maximum 1500. 1034 used to be there, but now it's not there. This was exemption for dividend income, now it is taxable. 1034A is basically a buyback. Because they tax dividend, they said that whenever we buy back shares, not very important for C-Enter, but whenever we buy back shares, let's say you have a share of Reliance which you bought at 800 rupees and now they are buying it back for 1000 rupees. So there is a profit of 200 that you are making, but the government says that the company will pay tax on this 200. So company will pay tax on this buyback. Next is 1037. You got an offer for your agriculture land, which was urban agriculture land, and you got an offer for 37, you refused, but they wanted to compulsorily acquire it. So guys, urban agriculture land sale is taxable. Compulsory acquisition is also taxable, but when they both happen together, remember, compulsory acquisition of urban agriculture land, when they both happen together, the government feels bad and the government says this will be exempt under section 1037 only for individual HOF, and you have to use this land, you should have used this land for agricultural purposes in the last 2 years. 1043, when life is really good, you do a reverse mortgage. In reverse mortgage, you give your papers to the bank and the bank pays you money every year. Guys, in that case, when you get money from the bank, it's a liability and hence it's not taxable. It is exempt under section 1043 reverse mortgage. Remember, reverse mortgage is not an income, it is a liability and hence it is not taxable, it is exempt. And 10AA, which is actually a deduction, but we're doing it here only because it's appearing in the QUIKBook. Guys, very important. This is like very important. This is one of the things for SAT deduction also, alternate minimum tax, but we'll see that later. But right now you're in an awesome area, that is an SEZ. If you're in an SEZ, then you have some benefits for the next 5 years and after that 5 years and after that 5 years. So 15 years overall you can take a benefit if you are in an SEZ. What is the benefit? In all these, you have to calculate the export profit. What is the export profit? First, you have to calculate the export percentage. How much are you exporting divided by total only on the SEZ unit, not the domestic area unit. And once you get the export percentage, you have to multiply with the profit. Let's say this time you've exported 80%. So 80% is your export. And what is the profit? And let's say the profit is 40 lakhs. So what is a 10AA deduction, or what is your export profit? That is 32 lakhs. Now in the first 5 years, you get 100% deduction. In the next 5 years, you'll get 50% deduction, that is 16 lakhs. and the last 5 years you will get 50% deduction, provided you put that money in in reinvestment reserve account. If you put only 10 lakhs, then only 10 lakhs you will get a deduction. So the amount of money you put, or 16 lakhs, whichever is more, that you will get. So first calculate export profit and then multiply to the percentage depending on which year you are in. Please remember, while you're calculating the export turnover as well as the total turnover, 3 things you don't have to include: FIT, any freight, any insurance, and any telecommunication charges which are paid for exports in foreign currency. Those 3 things you don't have to calculate, or you don't have to total it up while you calculate these 2 amounts. This, guys, you require compulsory auditable books is required, and guys, this is a deduction. That means in your PGBP, this entire 40 lakhs will first come in your PGBP. Then this 40 lakh will go to clubbing, set off, then it will come to GTI, and from GTI you can minus 32 lakhs because 10 AA is after GTI. I hope you remember the presentation also with the concept. Alright, with that, guys, we've completed 10 AA also. FIT is not to be included, and only focus on SEZ. Perfect. 10-14, this section 14 is not important. What it just says, guys, is agriculture income. When you have agriculture income and when you have a business income also, guys, I would want this income to be very, very low, and I want this income to be very, very high. So can I minus the agriculture expenses in business? The salary that I paid to my farm labor, can I minus it to my business? No, you cannot do that. That's what this section says. It's a very simple section. It says that if you have agriculture income, then only agriculture expenses can be minus from agriculture income. You cannot minus from business income. So basically you have to keep it separate. Alright. Now, guys, the 5 heads of income back to back. Yes, let's do this. Income from house property. Guys, our intention is today's day we have to complete all the chapters, and then not just that, we also want to solve the RTP after that. So that's the intention for today's session. This is income from house property. Let's begin. Okay. First, house property. Guys, although it sounds like a house, it can be an office, it can be a godown, it can be a parking lot, it can be anything which is a house property. And in house property, it is only taxed in the hands of the owner. If you're not the owner, you will not be taxed under house property. Golden rule of tax: if there is an income, it will be taxed, whether on one head or the other, but this one will only be if you're the owner. The sections are 22 to 27. These are the sections for house property. Let's do the first section, that is 23.1, which is LOP, which is very, very important. Guys, one question on this chapter is definite in your exam. In case of LOP, you will first calculate your actual rent for 12 months and your expected rent for 12 months. But what if I have the house only for 6 months? Then both are for only 6 months. In your actual rent, can you minus any bad debt or unrealized rent? Yes, you can minus any unrealized rent, provided 4 conditions are satisfied. Legally vacate our building. Legal action, you should ask him to vacate, no other building, and it should be a bona fide agreement. Then you can minus unrealized rent and you get your actual rent. ER has nothing to do with unrealized rent. Expected rent is something that the government expects when you have a house property. This is municipality figures the standard. Municipal value or fair rent, whichever is higher, but there is a ceiling of standard rent. So 8 lakh or 9 lakh subject to a ceiling of 10 lakh. So the expected rent will be 9 lakhs. Guys, after this, let's say this actual rent is 10 lakhs. So is your actual rent more than the expected rent? Yes. So AR wins. Yes. So in that case, if you have any vacancy loss, you can minus it. Yes. If let's say vacancy loss is 2 lakhs, can I minus the 2 lakhs? Yes, you can. Only if your AR is more than the ER. And now you don't have to look at ER again, because vacancy loss after you minus, that is 8 lakh, that becomes your GAV. In the exam, they will give you these values. Actual rent, they will give you. Unrealized rent, they will tell you that some people have not paid. And vacancy loss is when no one is in the house, no LOP, no SOP, nothing. Alright. So this becomes your GAV. This is the starting point, guys. 8 lakh rupees. Are you offering something to tax to the government? Yes. It's a give and take relationship. If you offer something to tax, the government gives you 3 deductions. The first one is municipal taxes, after which you get NAV. Municipal taxes are allowed as a deduction only and only if you pay it. Whether you pay for next year or last year, everything that you pay, you'll get a deduction. Only interest, not interest, only municipal taxes. So let's say municipal tax is 1 lakh rupees, so you'll get NAV is 7 lakh rupees. There are only 3 deductions, guys. From that, 24A says you can take an ad hoc 30%. So 30% of 7 lakh is 2 lakh 10,000 you can minus. Guys, after you minus 2 lakh 10, you cannot minus anything. Any ground rent, any staff salary, any mint, nothing, guys. Everything is included here. And then there's 24B, which is for borrowings, that is interest. Whatever interest you're paying, yes, interest is of two kinds, guys. Current year interest, the year you've constructed the property or acquired the property, and after that every year is a current year, full 100% of that, yes. And if there is any PCP interest, what is PCP interest? The year you construct, before that if you had to pay any, let's say this today 16th of February, this is when you finished your construction, then this year is the year of completion, so it's called current year. Before this, that is 2021, 1920, if you incurred any interest, that is called PCP interest, and that you can get only 1/5 every year. So the year you complete this year and the next 4 years you will get. So this is your interest. Guys, there is no limit to the interest because your interest is someone else's income. This interest can be from friend, family, brother, sister, bank, etc. No problem. Only in deductions it has to be from legitimate sources like banks, etc. This interest you will take a deduction. Let's say the interest is 3 lakh and 2 lakh and 90,000 rupees. Can you take a deduction? Yes. So that is 5 lakh. So your income from house property is 2 lakh rupees. This is your income from house property. It can also be a loss. Don't worry. Don't mind. It can also be a loss, but this is an income from house property. Guys, in the exam, they will give you insurance, fire insurance, some ground rent, but doesn't matter. Only 3 expenses. Keep your mind open. Only 3 expenses, nothing more. 24A, 24B, and municipal taxes. All right. This is LOP. This is when you bought the. This is when you use it. Use your house for LOP. The next thing, that is 23(2), is when you occupy it yourself. SOP. Guys, occupying it yourself means you are staying in it, your family is staying in it, and sometimes you cannot stay in it because of employment or business reasons. Even then it can be SOP as long as you don't derive any benefit from it. SOP is a complete benefit. Why? Because everything in SOP is nil. Everything except one, that is 24B interest. Can I minus interest? Yes, you can minus interest. How much can I minus? You can minus only maximum 2 lakh, and sometimes this drops to only 30,000 if one of the 4 conditions is also not satisfied. What are the 4 conditions? Certify 5 accounts for 99. The loan on which you are paying interest should be taken on or after 1/4/1999. The loan should be taken only for acquisition, only for construction, not for renewal, reconstruction, repairs, etc. You should have completed the construction 5 years, the year you take the loan or you start construction, not that year, after that 5 years. And you should obtain a certificate. If all these 4 conditions are satisfied, only then you can take 2 lakh, otherwise it drops to 30,000. So SOP has a limit, yes. But good part is you can have 2 SOPs also, but guys, 2 SOPs does not mean you have 4 lakh. You will still get in both, you will still get maximum 2 lakh because the SOP benefit is not per house, but it's per person. This is section 23(2). Next is 23(3), which is very common in the exam. If you have a doubt, I'll just open up to doubts. You can just make a note or you can put them in the chat box and I will reply. Section 23(3) is, guys, LOP plus SOP. That means part of the year you've self-occupied it and part of the year you've let it out. Very common in the exam. Then what you have to do is nothing, but this is exactly like LOP calculation. You'll have an actual rent, you'll have an expected rent. In the actual rent, the months you've occupied it yourself, that will be considered as rent is 0. That is your 23(3), and because you're offering something to tax, can you minus municipal tax, etc.? Yes. In SOP you cannot minus anything. Question box is not working. 1 second. Okay, I've just enabled it. Guys, you can raise your hand also. You can ask any questions. No problem at all. All right. Next is 23(3). This is LOP plus SOP. Next is 23(4), guys, which is deemed LOP. What is this deemed LOP? Guys, if you have multiple SOPs, let's say you have 3-4 houses and you call all of them as SOPs, the government is not allowed. At your option, you can take any of them as SOPs. any two as SOPs, but the third, fourth, fifth one we will deem as a LOP. In deemed LOP, you have not actually rented out, so there will be no AR, but they will be basing GAV on expected rent. And last is 23.5. In 23.5, you are a construction company. You have basically some stock which is not being sold even after 2 years of being constructed. That means this year you constructed it, after 2 years we will wait, but still if you have not sold your house, then it will be considered as a deemed let out property and we will start taxing it. For 2 years we will wait. The year of construction, after that 2 years we will wait. Thara, you have a doubt? Let me ask. So is it possible to calculate in practical like this, and how we get standard rent, fair rent? In real life, your CA will help you do that. Fair and standard rent generally can be seen. Yes, there are many ways to get standard rent, fair rent, etc. But practically, whatever actual rent is, you consider that as higher and you pay your taxes. Alright, good question, but not important from an exam perspective. So I'm not picking this doubt up right now. But I hope, Thara, your question is answered. Please let me know. Guys, this is section 23.5. Alright, perfect. Guys, moving ahead to the next section. 23 is done. 24A is ad hoc, please remember, and 24B is interest. Please remember there is no limit to the interest. And now that you know deductions, guys, you can take up to 2 lakhs a year in SOP. And can you take in under 80 EEA easy EMI again? Yes, but the house should be maximum stamp duty value 45 lakhs. Anyways, moving ahead to section 25. Guys, if you are supposed to pay interest outside India, then you're supposed to deduct TDS because you're using that money in India, and hence you're supposed to deduct TDS. If you don't deduct TDS, sorry, we will not give you that deduction of interest. This is for interest paid outside India. If you have any arrears, very common in the exam, any arrears of rent. Arrears means something it was not taxed earlier because it was unrealized rent, now you're getting it. Will it be taxed? Yes, but after giving a 30% deduction. Next is section 26. Congratulations, you're now married. At 26 years, the surgeon got married, and now you're co-owning the house with your spouse or with your friend or with your family member, mother, father, etc. In case of co-ownership, section 26 says co-ownership. In case of co-ownership, what changes, guys? Nothing changes. In case of LOP, nothing changes. You will do the same ARER calculation. In the end, whatever is the income or loss, you will split. But in case of SOP, because there's a benefit and both husband, wife and brothers can get the benefit, so hence in that case you will have two separate calculations. Yes, because each co-owner can get 2 lakh or 30,000 as the case may be. So this is in case of LOP, SOP. Remember to split it in the end, and remember to do separate calculation in case of SOP. Guys, in the exam, a very typical question could be that you have a house which has 3 floors. This is your house, guys. 3 floors, 1, 2, 3. The ground floor is self-occupied. Guys, will you do any calculation here? No, except section 24B. The first floor is LOP. In that you will do only municipal taxes you will minus. 24A ad hoc you will minus, and 24B you will minus, nothing else. And this last one is used for your business, PGBP. In that case, can I take it as SOP? No, SOP cannot be a business. SOP is only when you're residing in it. So then what can I take? Guys, in PGBP, the golden rule is any expense in relation to the business. So municipal tax, can I minus? Yes. Any ground rent, can I minus? Yes. Any fire insurance for that building, can I minus? Everything you can minus, but only proportionately, only for this proportion of this house. So don't worry, in the exam, they can break up the house into 3-4 parts, but the more parts they break up to, only thing is you have to do different calculations. Alright, that is another chapter. We have last section left, that is section 27. Guys, section 27 is similar to clubbing of income, but this section is only applicable to house property. So if you have a house property and you've given it to a spouse without consideration, or when you are not living apart, then in that case the spouse can own the house. They're not about the ownership, but the income will be taxed back in your hands, guys, because you've sold it without consideration or without the agreement to live apart. Same thing, if you transferred the house to a minor child, then it will come back to you because you've sold it without adequate consideration. But guys, 2 exceptions. What if the minor child has paid you enough money? Then in that case it will not come back to you. Or what if the minor child is a minor married daughter? That encourages dowry, honestly, so we don't like it, but that is a section 27 provision. Also, section 27 says that if you are a tenant, That is, if you have tenancy rights in a house, then even though landlord is the owner, it will be taxability will be back in your hands. If you are a person who says that, listen, I have not bought the house, etc., because I've not registered it, registration is a mere formality, the house belongs to you, so it will come back to you. If you are saying I've just have shares in a cooperative society, we understand shares in a cooperative society means you own the house also, so it will be back in your hands. These are not really important, but remember section 27. How will you differentiate? If I transfer gold, if I transfer debentures, or if I transfer cash to my spouse, it will be under clubbing of income, but only if I transfer house property, it will be under section 27. So remember the difference from a section perspective. This is your house property. Guys, there are some other things in house property which I want to discuss with you, which are important. Guys, sometimes with the house you also give facilities like lift, power generator, etc. Can I put all that services also in house property and take 30% deduction? No, they say you have to split it up. This is under house property, only the house, and all the facilities, furniture, etc. services will be under IFOS if you can separate. But if you can't separate, everything will be an IFOS or PGBP, because they don't want to give 30% deduction. So remember, if you give a house property on rent for 1 lakh, 1 lakh will be here, and if you have a generator given on rent for 10,000, 10,000 will be here, and generator expenses can be minus from here. This was an exam question which you've already done. So this is composite rent. It's called composite rent. I'm just seeing if there's anything else left. Vacancy loss we've discussed. There are illustrations, very good questions. One question in the exam already. Deductions, self-occupied property, LOP plus SOP. Yes, guys, we've forgotten one thing, a portion of the house. If they say, you've already discussed it indirectly, one portion is SOP and one portion is LOP, then SOP, you know, only 24B will happen, and LOP you will do municipal tax 24A, 24B, but everything will be apportioned. Apportion, yes, apportion means apportioned. Perfect. Apportion, 25, 25A areas, 26 co-ownership, 27 is deemed ownership, and 22 other sections. House property includes all other properties. Registration is not compulsory. Guys, ground rent, this is a very common thing in the exam. What is ground rent? Sometimes you have a house but the land you don't own, so you're paying ground rent. Will you get a deduction in IFHP for ground rent? Please answer, guys. Will you get a deduction for ground rent in IFHP? No, because only 24A, 24B in municipal tax, no, nothing else. Alright. Composite rent we've seen. Yes. Guys, income from house property abroad. Guys, if I have a house in London, will I be taxed? That depends on whether you are a ROR. If you're an ROR, then it will be taxed. If you're an NR and RNOR and the income is received earned abroad, then why will you be taxed? And if you're taxed even the house abroad, you'll have the same municipal taxes, 24A and 24B deduction. Alright. That brings us to an end of another chapter. Very, very good, guys. Let's see what chapters we've already done. We've done residential status. We've done scope of income. We've done agriculture income. We've done exempt income. We've also done now IFHP. And we've obviously done introduction chapter. All this has happened in 1 hour and 9 minutes. We're going to take a 2-minute breather here and we're going to come back and attack the next chapter, which is IFOS, gift taxation, dividend taxation, waiting for us in this chapter. 2-minute break and then we continue. Thank you. Alright, and we continue guys. The next chapter on the screen is IFOS. Let's do this. IFOS is a very interesting chapter. People think it's not important, but it's absolutely golden. Very, very important. Why is it important? Because gift taxation, dividend taxation are really important. So IFOS deals with section 56, 57, 58 and 59 mainly. But first we will do gift and dividend taxation, and then we'll come to these sections. So first, right now, my aim is gift taxation, which is section 56 to 10. For gift taxation, guys, you always have to see from the person who's receiving it. So we're always from the receiver's perspective. And guys, you have to take the gift through 3 steps. Step 1, it should be in the definition of property. What is the definition of property? MISB sad jaw. That's the shortcut, guys. Miss B was sad because she was told that her gifts will be taxed. Miss B sad jaw, that is money, immovable property like land, house, shares or securities, bullion, sculptures, archaeological collection, drawings, jewelry, art and any other work of art. If it's this, only then it is taxable, or it might become taxable. But if it's a car, a car, a bike, a laptop, this is not in the definition of property. So enjoy them, no tax on those gifts. Next is step number 2. Step number 2, it should not be in one of these situations. What are these situations? These situations are like gift coming from a relative on marriage, etc. So the shortcut is don't tax tip and money received from LAHUF. So on the death of a person, on inheritance, if you get it on the marriage, if you get it from your relatives, if you get it from a local authority, some money, if you get some money from an HUF, if you get some money from basically a fund, if you get from specified persons like slum dwellers when they get a house in exchange of their slum, that, if you get money from a trust, if you give some property to a trust for the benefit of your family, if you then these cases, guys, will not be subject to gift taxation. Mainly in the exam, your marriage, you getting it from relatives. How many relatives? 232 relatives. Let's see what are these 232 relatives. If this is you, then for you, who are your 232 relatives? Your spouse is your relative, two spouses, 3 brothers and sisters, and 2 LAs and LDs. Let's see what is it. Your spouse, your brothers and sisters, your spouse's brothers and sisters, and your parents' brothers and sisters. These are 3 brothers and sisters. So this is done. Remember, your brothers and sisters, even your spouse's brothers and sisters. Next, 2 LAs and LDs. That means people above you, legal ascendants and legal descendants. Even for your spouse, the people above them, parents, grandparents, etc. And the second spouse, guys, all the people you mentioned, like your brother, his spouse, your sister, her spouse, your uncles and aunts, their spouses, everyone who's mentioned in this diagram, their spouses, that's the second spouse. So guys, that is what is 232 relatives. Next, continuing ahead here. All right, if it's one of these situations, then it will not be gift tax. But if not one of these situations, like example, you've got some money on your birthday, it's not your marriage, etc., then you will go to step number 3, and step number 3 puts them in 3 categories. What are the 3 categories? Money, movable property and immovable property. Money, you have to see aggregate. Mobile property, you have to see aggregate. Immovable property, you have to see individual. And if the aggregate or the individual is greater than 50,000 each, 50,000, 50,000, 50,000, that means your money you've got is 70,000, or mobile property you've got is 70,000, or immovable property individual you've got is 7 lakhs. Then if it's more than 50,000, the entire thing will be taxed. 2 spouse, we've already discussed many times, guys. 2 spouse is first your spouse, and then whoever you've discussed, their spouses, like your brother, his spouse, your sister, her spouse, your spouse's brother and sister and their spouses will all be included. Yes, that's the second spouse. All right. So guys, once it goes to 3 steps, only then it will be gift tax, and gift tax is always in your hands. And if you're a minor, then first you will calculate gift tax and then you will add it in the income of your parents. That is what is gift taxation. This is free gifts. Basically, you've not paid anything. These are called gifts without consideration. But guys, can it happen that you pay some money? Yes, sometimes it happens that for a 10 lakh rupee gold ring you paid only 3 lakhs, or for a 1 crore house you've only paid 75 lakhs. So then in that case, that is called gifts with inadequate consideration, or gifts for inadequate consideration, which I call as benefit taxation. So first you have to calculate the benefit. Let's say on a ring, a mobile property, you've got a benefit of 7 lakhs. And on an immovable property, you've got a benefit of 25 lakhs, because a 1 crore stamp duty value house you got for only 75 lakhs. So first step is calculate the benefit. Actually, this is step 0 because step 1 remains the same. This is only in case it is again in the definition of property. So if you get a benefit on a t-shirt on Amazon, is that supposed to be taxed? No. On a watch on Flipkart? No. It's only and only on property, MISB SAT job. Step 2 is also the same. Step 3 here. Money is not a category. Why? Because guys, you will never exchange 1000 rupees for 5000 rupees. Movable property and immovable property. If movable property, the aggregate benefit that you've got is more than 50,000. In case of ring, have you got an aggregate benefit of more than 50,000? Yes. So the entire 7 lakh will be taxable in your hands. Yes. And for immovable property, if the individual benefit, you have to see individual benefit, is greater than either 50,000 or 10% of the sale consideration. You bought the house for 75 lakhs. So 10% of sale consideration is 7.5 lakhs, whichever is more. So 50,000 or 7.5 lakh. So 7.5 lakh is more. If the benefit is more than that, that means your benefit in this example was 25 lakhs. So is it more? Yes. Then the entire 25 lakh will be taxed. Remember, stamp duty value you have to take. In this case, you have to take the stamp duty value. You can take the stamp duty value, generally the date of registration stamp duty value. But what if there are 2 or more stamp duty values? One is date of agreement and one is date of registration. Others are not important. Then in this case, if this is 1 crore and if this is 80 lakhs, can you take 80 lakhs? You would want to take the lower stamp duty value, because lower the value, stamp duty, lower will be the benefit and you will not be taxed, or you will be taxed on a lower amount. Then you can you take this stamp duty value? This is very important, guys. Yes, you may take this stamp duty value if on or before the date of agreement some amount has been paid by any means other than cash. Example, if today is the date of agreement, that is 16th of February, then on 16th of February or before, you should have paid some amount of money in other than cash. That means the government should know that this was really the date of agreement. Cash is not allowed. Cross is a big cross, guys, so it's not allowed. Cross check, cross demand draft not allowed, and bearer check, bearer demand draft not allowed. So these 3 things are not allowed. Other than that, Paytm, Google Pay, account pay check, RTGS, NEFT, all of them are allowed. So this could be the decision on you choosing which stamp duty value. All right, that is the first, gift taxation, guys. In gift taxation we just studied this. Now let's move to dividend taxation. So this is gift taxation. I'm just going to show it to you here on the screen. Gifts to be received, always from the receiver's perspective. Free gifts, step 1, step 2, and next is step 3. And gifts for inadequate consideration, step 1, step 2 is the same, and step 3 is basically, this is very important, 50,000 or 10% of sale consideration. In case of more than stamp duty value, what do you see? And this one is an amendment which we will talk about tomorrow. In case of a house property, guys, generally we see 10%. In case of house property, we'll see 20% of the sale consideration. I'll add the amendment in tomorrow's lecture when we discuss the amendment 2021. All right, guys, remember the above gift taxation does not apply if the property received is the nature of stock. That means I'm a jeweler and I get jewelry for 10 lakhs for 3 lakhs, then this is not applicable. It's only applicable on MISB SAT job, which does not have to be stock. Relatives are 232 relatives, and in case of Hindu undivided family, any member is a relative. Perfect. Let's go and do dividend taxation now. Sorry, here we go. This is dividend taxation. Guys, dividend, as you know, now is taxable in the hands of the shareholders. So whichever, whether it's an Indian company, foreign company, small company, big company, whichever company gives dividend to the shareholder, obviously dividend is always received by the shareholder. The shareholder will be taxed, and dividend has only one direction, that will always be taxed in IFOS. You and Rakesh Jhunjhunwala both are taxed under IFOS only in case of dividend, which is great. But there is a specific section. If you remember the section 115 BBD, bring back dividend. If you are an Indian company, it applies only to Indian company. and you have a foreign company in which you hold 26% or more in the foreign company, then in that case this foreign company is called a specified foreign company, and if you bring back dividend into India, the government has promised you to tax you only at 15% in case of bringing back dividend 115 BBD. So in case of 115 BBD, you will be taxed only at flat 15%, but no other deductions. Yes, and this is only for Indian companies. This is great, but exam focuses on deemed dividend. Guys, if you are very smart and you're trying to remove money from the company without calling it dividend, the government says, listen, we know this is a company and this is you, the shareholder, and we know you're not calling it dividend, but this looks like dividend, so we are going to deem it as dividend. Section 222. If the company is giving out assets like gold coins, if the company is giving out some bonus, B is bonds, debentures, preference shares, free as bonus, except equity shares, or if the company is closing down and giving out assets, or if the company is decreasing the share capital, reducing share capital and giving out money. In all these four cases, we know you're indirectly trying to remove money from the company without calling it dividend. So this is called deemed dividend, which will also be taxed under IFOS in the hands of the shareholder. But it will only be taxed up to the extent of accumulated profits, whether capitalized or not. So the company only up to the accumulated profits will be taxed. The shareholder will be taxed only on up to the extent of accumulated profits, whether capitalized or not. This applies to all companies, yes, biggest companies also and smallest companies also. But this last section 222E is the most extreme step, in which you are just not any shareholder, you're a beneficial interest shareholder. That means you hold 10% or more in the company, and in this case you are taking a loan from the company. This loan will be taxable as deemed dividend, yes. In your hands in IFOS, yes. Either directly you're taking it, or indirectly a entity in which you have substantial interest, if that entity is also getting a loan, or if a third party is getting a loan. In all these three cases, third party for your benefit, is it ultimately connected to you? Yes. So in all these three cases, whether you take it directly or through an entity in which you have substantial interest, or to a third party in which is for your benefit, but remember guys, you have to be a beneficial interest holder, then it will be taxed as deemed dividend. But this is separate, different. Why is it so different? It is only applicable to closely held companies, that is private companies, etc. It is not applicable to banking and insurance companies, banking, insurance, lending companies, not applicable to. It is only applicable to accumulated profit which is not capitalized. So only which is not capitalized, only that much accumulated profit, yes. And even if you repay the loan, does it matter? No. Even if you pay interest, does it matter? No. But remember, if after giving this loan they declare another dividend, will that be taxed again? No, that will not be taxed again. This is guys dividend taxation. Now moving behind to the general parts of IFOS, let's look at the general parts of IFOS, which is section 56. Section 56 says that there are some incomes which are always in the dustbin section. So 56.1 says any income which is not taxable under any of the 5 heads can be taxed here. Yes, this is the dustbin section of incomes. But 56.2 has a line which is called, in retirement/death, I will receive some welfare gifts from insurance contracts. So all these will be taxable under 56.2 only, always, yes. Any interest, any rental income from your spare capacity of laptops, plant and machinery, furniture, any amount which is basically any dividend is only one direction. Any interest again on enhanced compensation, guys, when you ask for enhanced compensation and you get interest on that or delayed compensation, but remember you get a flat 50% off. Any winnings from lotteries, etc., you've gotten lucky, the government does not allow any deductions, no base exemption limit from this. Next, rental from composite rent. Next, this is securities byju's, when they issue it at a premium first, and second, when the amount they receive for the shares is more than the fair market value, that will be taxed in the hands of byju's. Any welfare gifts for the employees, any welfare amounts, if you don't put them within the specified due date, monthly due date, then it will be added to your income. Any gift taxation, any forfeiture after 1/4/2014, because before that it is reduced from the cost, you saw it in capital gains. Any insurance, which kind of insurance? This is keyman insurance. It is always taxable either in PGBP or salary, or here in IFOS, here the family is getting it, or any non-business contracts. In all these cases, section 56 will apply, yes, and it will be taxable, yes. But don't worry, any income has expenses also which we can minus. Will, repair, pick in general. Will is welfare amounts. If you put them within monthly due dates, you'll also get a deduction. Any repair, maintenance, depreciation on that plant and machinery, furniture, you'll get deduction. Any family pension, you'll get 1/3 of the amount, or 15,000 per month, whichever is lower, as a deduction per month. Interest on enhanced compensation, you'll get flat 50% off. Any commission or charges you pay on the earning that interest on securities, you will get a deduction. Any interest you paid on a loan which is taken to earn that dividend income, that you will get, but maximum 20% of dividend income, if you remember. And any other general expenses, all of this will be allowed as a deduction. Section 57 says we understand you have deductions. 58 talks about disallowances, that those amounts, those pizzas which you've paid for but they don't come to your house, poor wins cash income. Income tax, not allowed. Cash up to 10,000 is allowed, above that is not allowed. Guys, cash is not allowed. Winning from lotteries, no deductions. Any excessive or unreasonable to relatives, not allowed. Here guys, the relatives is not 232, it's a smaller definition. You, yourself, your spouse, your children, and your LA and LDs only. Next, OOR, if you're paying outside India to a non-resident, or if you're paying outside India and you've not deducted TDS, 100% of that amount will be disallowed. And if you're paying in India to a resident and you've not deducted TDS, or you've not paid, then 30% will be disallowed. Remember, TDS is important. If you don't pay, then it will be disallowed, but it's not a permanent disallowance. When you will be allowed, then whenever you make the payment, whichever year. And any personal expenses, not allowed. Remember, in TDS, if you have not deducted it, but the person who's received the money, if they pay the TDS, if they include their income in the return, if they file their return, then you will get the deduction, yes, in the year they file their return. This is the interest on enhanced compensation. It will be taxable in the year you received it, and you will get a 50% deduction on that. This is Byju's. Step 1 and step 2, only if it issued at a premium and more than the fair market value, that will be taxable. And this is gift taxation, guys. That brings us to the end of another very, very good chapter, which is IFOS. Alright, we have PGBP here. We are going to the next chapter, which is PGBP. We'll start in exactly 1 minute. We'll finish it before the break, and maybe something more also we'll finish, but we're going very, very steady. Guys, after IFOS, generally we do clubbing. So let's do clubbing. We'll do the same pattern that we've been following. So after IFOS, we had done clubbing. So let's try and do that. Just for a change, clubbing of income. Clubbing of income basically means it's your income, yes, but you don't want to pay tax on it. You're heavily taxed. So hence you try and give it to someone else. Section 60, 61, 62 and 63 talk about, for everyone, this applies to everyone. Here, you're transferring some income, but you're not transferring the asset. That means I've given my debenture interest to someone else, but debentures are still with me. Clubbing will apply. Yes, clubbing will apply. Section 60. In section 61, I am giving my income as well as I am giving my asset, but it's a revocable transfer. That means someone is giving you an iPhone in your birthday and taking it back. Is that a real gift? No. What is revocable transfer? If you have the right to take it back, or if you enjoy even some part of the income or the full income, then it is revocable. In that case also clubbing will apply, because it's a fake transfer. And section 62, finally, you are giving away the income and you are giving away the asset, which is irrevocable transfer. Then in that case, the government knows this is a real transfer, and in that case, no boomerang. Yes, no boomerang will come back. Section 63 says that transfer for revocable, there have to be 2 conditions. You have the right to take it back. Whether you exercise the right doesn't matter, or if you enjoy the income, whether in part or in full, then it is revocable transfer. Section 64, very, very interesting, guys. Minor children. Guys, if a minor child has any income, will it be taxed in anyone's hands? No, it will either be taxed in his hands only if it's SIM income, skill, intelligence and manual work, or everything else will be clubbed. Guys, there was a question which says the minor has got a gift from an uncle. An uncle has given a gift of 70,000 to the minor in cash. and from that he is earning interest income of 7,000. All right, let's see. Guys, first, does the minor have any gift which is taxable? Yes, 70,000. So in whose hands will it be taxed? Will it be taxed in the uncle's hands? No guys, never. It will always be taxed in the parent's hand, whoever has higher income. So uncle and all is only given to confuse you. It will be taxed back in the parent's hands. This also and this also, yes, both. Okay. Going to clubbing, section 64 1A for your A1 children. This is 1A. Income, every income of the minor child will be clubbed in the hands of the parent, that parent which has more income before such clubbing. And when you do the clubbing, you'll give a minus of 1500. Don't forget that, because that then your answer will be wrong. But except 3 incomes, which is sim income, if it's because of a skill, intelligence and manual work, then it will not be clubbed. But guys, even if it's sim income, from sim income, if you have second level of income, will that be clubbed? Yes, because children don't have a mind of their own. So even second level, which is called accretion of income, will be clubbed. Perfect. And once guys you've decided in whose hands it will be clubbed, every year it will be clubbed in the same parent's hand. If the parents are separated, then the parent who maintains the child, in their hand it will be clubbed. Very, very important question from an exam perspective. Guys, here there is nothing called married daughter. So minor is minor, whether married or not doesn't matter. Next is spouse and son's wife. Guys, spouse is 64 1, 2, 4 and 7. 2, 4 and 7, 247 is spouse. If you transfer, if you have any entity in which you have substantial interest, here you along with your relatives. So substantial interest, if you have an entity in which you have substantial interest, that is 20% or more, you along with your relatives have substantial interest, and that entity is paying salary to your spouse which is not linked to her or his education or professional qualification, then clubbing will apply. Yes, it will boomerang back to you. Remember, only if it is not linked to the education or professional qualifications. Next, 64.1.4. If you transfer an asset to your spouse, just like house property, but this is any other asset you transfer to your spouse, then it's your drugs, it is your income. Why did you transfer? It's your asset, so it will come back to you. If it's house property, then section 27, otherwise it will come here. But there are two exceptions. If your spouse has paid adequate consideration, or if you're living apart, that is, you're separated, then in those two cases clubbing will not happen. Guys, here sometimes the spouse invests that money in a business. Let's say you gave gold to your spouse worth 10 lakh rupees and she used her own gold of 10 lakh rupees, and with this 20 lakh she started a business, PGBP. Then from that PGBP, if she has an income of 70,000 rupees, that income 35,000 will be clubbed back in your hands. So proportionately it will be clubbed back, income as well as losses. And remember, this investment of yours has to be invested from the first day of the year, only then clubbing will happen. If it's invested on today, that is 16th of Feb, then this year there will be no clubbing. From next year there will be clubbing. And next, 64.1.7 is indirectly you have a third party in the middle, you give it to a third party, the third party gives it to the spouse, again without consideration, then in that case it will be clubbed back in your hands. Next is for son's wife, that is spouse, not spouse, son's wife. 64.1.6 and 8, same thing. If you give it to a son's wife an asset without adequate consideration, the income will be clubbed back. And if you give it indirectly with a third party in the middle, again the income will be clubbed back. And last, important, yes, transfer to an HUF. Your HUF also has a basic exemption limit. So if you transfer any asset to an HUF and the HUF basically is making money but cheating the government because they have a basic exemption limit, it will be clubbed back. And even if the HUF gets divided and the asset goes to a relative, even then clubbing will apply. So remember, 64.2 says even in case of HUF, the clubbing will apply. Cross transfer is basically you've transferred some asset to your friend's wife and your friend has transferred an asset to your wife so that to avoid clubbing provisions. Then if they are interrelated transactions with an intention to avoid tax, then it will be taxed, clubbed back in the hands of the respective relative. Clubbing of income also means losses will also be clubbed. Guys, clubbing happens before set off. Now going to PGBP. I'm going to look at PGBP next. Here it is, PGBP. Give me a minute and we will start PGBP in just 1 minute. Let's start, guys. PGBP is on the cards. PGBP is a bigger, older cousin of IFOS. In the exam, PGBP is never given directly. They will always give you a sum which is solved and you have to correct them. So that is PGBP. Golden rule. Any expense which is in relation to business, will it be allowed? Yes. And any income, will it be taxed? Yes. Business and profession, the definition is not important because everything is taxed under same head of PGBP. Profit may be in cash or in kind, doesn't matter, everything will be taxed in PGBP. Section 28 talks about incomes. Painkillers can always easily, effectively benefit people to cure knife cuts and bruises. Profits. Business contracts, any receipts. Any associations earning income. Export benefits being sold. Any benefit in kind, just like gift taxation in IFOS was from a third party. If in relation to your business or profession you get any benefit, will be taxed here. Very important, partners getting salary interest will be taxable here. Not in salaries head, not in IFOS head. Only to the extent allowed to the partnership firm. Non-compete fee for not doing something. Keyman insurance as a business, if you get keyman insurance money. Conversion of what? Conversion of your stock into capital asset, because we don't know whether you've sold it or not, so it will be taxable even if you convert into capital asset. And last, specified business reversal will happen here in 28. 29 is Google Map. It only tells you how to calculate PGBP. Speculative business and non-speculative business, guys, when you buy and sell without taking delivery, that's speculative, and that can be carried forward only for 4 years, etc. The government doesn't like speculative business. And specified business, something that the government tells you to start, also develop, like a 100-bed hospital, a warehouse for food, grain, sugar, etc., which we will see in 35 AD. Section 30 to section 37 are expenses. Section 30 says that for land and building, if you have any RRTRI, then in that cases, of course, revenue in nature, you can minus it. Any repairs, rent, rates, taxes, repairs and insurance, you can minus it from a PGBP because obviously it's a business deduction. But remember, anything which is capital will go to the balance sheet and you will get depreciation. That is section 30. Same thing, but only RI for plant and machinery and furniture will be section 31. Section 32, actually section 32(1) talks about depreciation. Depreciation based on twin test, you should be owning the asset and you should be putting it to use. The word put to use is important only for depreciation. If you put to use the asset for less than 180 days, that means on 4th October or after that, then you will get only half year's depreciation. Otherwise, you will get full year's depreciation. Depreciation is only and only based on income tax rates. The exam will give you depreciation, which is as per P&L account. It is wrong. You have to minus depreciation as per Income Tax Act. There are 4 categories: land and building, furniture, buildings and intangible assets. Guys, goodwill is no more to be depreciated. That's an amendment in the Finance Act 2021. So if goodwill was depreciated earlier, no problem, but from 1st of April 2021, goodwill is not to be depreciated. Rates of depreciation for building, it is a very small amount. Generally for buildings it is 10%, but sometimes for residential building it is 5% also. Temporary shed it is 40%. Furniture it's only 10% and intangible assets 25%, but goodwill is not to be depreciated. And for plant and machinery it is generally 15%. Motor car 15%, but for some things which are like life-saving medical equipment, pollution control equipment, computers, books, etc. are 40%. Ships go slow, so 20%. Airplanes go fast, so 40%. And anything which is very important like windmills, computers, books, etc., all these are at 40% rate. Next, assets put to use for 180 days or less. In case of amalgamation, demerger, etc., don't worry, depreciation calculate just the same way, then bifurcate it depending on number of days of use of the assets. This is 3212, which is depreciation based on WDV method. WDV method talks about block of asset which is one family. If it's subject to the same rate and if it's subject to the same rate and if it's subject to the same type of asset, it becomes to one family. And once you're in a one family, then you don't look at individual asset. You take the opening block, you add any purchases, but remember when you add half year, full year, you have to see, and you minus any sales, and that's how you get the value on which depreciation will be calculated. Next, for some units like power generating units, etc., they have an option of using SLM, but no one uses SLM because you have to focus on individual assets, which is a pain. But if you're using SLM, then there will be something called terminal depreciation and balancing charge. How? Guys, if your SLM asset is for 1 lakh and you depreciate it to 80,000 and you sell it for 85, then 5,000 is your balancing charge or income. And if you sell it for 72, then 8,000 is your terminal depreciation. Land is never depreciated, and spares, etc., will also be is a revenue expense. If it's a bigger spare only to be used with that machine, then it will be capitalized and there will be depreciation. All right. Additional depreciation, very, very important, guys. In case of manufacturing and power generating, only power industries and manufacturing, you get 20% additional. Excellent. And that 20% is only for new plant and machinery, not second hand. Even if abroad, if they've used it second hand, not on motor cars, trucks, airplanes, etc., no motor vehicles, not on office appliances. A computer in the factory you will get additional, but a computer in the office you will not get additional depreciation. So only on new plant and machinery, not on furniture, land, intangibles, etc. 20%. If you get 10% this year, the next 10% you will get next year. Same half year, same concept here as well. After additional depreciation, unabsorbed depreciation, guys, sometimes your depreciation is a lot and your profits are small, so you cannot minus 120 depreciation from 100 profits. You can only minus 100 depreciation, and the extra 20 will be called unabsorbed depreciation, which does not have any, it can be carried forward indefinitely. And in set off chapter, it does not even have a quarantine stamp. It can be set off from any other head except salaries. Terminal depreciation is an SLM asset. We've already seen it. Block of asset is basically, a block means a family where you take the opening, anything purchase you add, anything still you minus. That is what block of asset means. 43.1 says cost. What is the cost, guys? When you buy a machine, all the cost till the asset is put to use will be included in the cost. Yes, but there are some specific things, like the first explanation says that in case of scientific research, because you get an entire deduction under section 35, the cost will be 0. In case of explanation 8, 9 and 10, 8% interest, any interest till the asset is put to use will be added. Any import duties, etc., will be added unless you take a credit. And any subsidies will be minus because you have not paid for it. So cost of the asset is done using explanation to section 43.1, not very important. Just remember, all the cost will be included. One more explanation which was very important is that if I have a car which I introduced into my business and earlier it was personal, then what will be the cost of the car in the business? The original cost, yes. But only for building, it will be the cost of the building less notional depreciation. For all the years that I use it for personal purposes, there will be notional depreciation in that case. That is section 43.1. Not very important. I've given all the explanations, but it's not really important, guys. You have just to read it once and you're good to go. Next, guys, is section 35. In 35, basically you have scientific research, and in-house, basically it's linked to your business. So you spend some money, revenue expenditure, will it be allowed? Yes, but not just the current year, even 3 previous years before the year you start. So if today I start 16 Feb 2022, then 3 years before revenue also, but only salaries and raw materials, I will get a deduction, yes, under 35.11. And 35.14 says that if I do a capital expenditure, excluding land, if I do any capital expenditure, even now, even 3 years prior, will I get a 100% reduction? Yes, and that's the reason the cost of the asset is nil. But remember, If you use it for scientific purposes, it goes into the block, and when you sell it, no problem. But if you don't put it to business purpose and you sell it, then let's say the microscope was for 1 lakh, you got 100% deduction. So now the microscope is for nil value. So if you sell it up to 1 lakh, it will be reversed in PGBP, and above 1 lakh, it will go into capital gain. 35 also says that you can donate to scientific research to outsiders also. Outsiders means USIN. Outsiders means Baba Ramdev's company for statistical social research for specified institutions. Yes, even if their approval is withdrawn later on, does not matter, as long as right now they have an approval. Perfect. Just 1 second, guys. All right. That is section 35. Next is section 35D, which is dial a doctor. Guys, if you're starting a new business or you're expanding your line of business, then can you have some PEs, that is preliminary expenditure? Yes. So total it up. In case of preliminary expenditure, will you get a deduction? But yes, you will get it in 5 equal installments, starting from the year you start business and 4 more years. What is PE? PE means any expenditure, but it has to be revenue. Project FEM, if you remember, that is project report, feasibility, engineering and market study. These will be only if you get it done in-house or from approved sources, and others like advertisement, legal, AOA, MOA, that can be from any. You will total it up, and this total you will get 1/5. But remember, there is a capping. What is the capping? The capping is 5% of the cost of the project, and if you're a company, then 5% of capital employed, whichever is higher you can take. Both these will be taken as on the last day of the current year. The year you start, the last day of that value you will take. Cost of project means actual cost, yes, of everything including land also, yes. And capital employed is your equity, preference, share capital, loans, etc., debentures, etc. But foreign loans only if they are more than 7 years can you include it. So 5% of this or 5% of this, that is your ceiling, whichever is higher. Please remember, any capital expenditure will not be taken as PE, preliminary expenditure. And if you are amalgamated, etc., then how many ever years you've taken, the next year onwards, the other company will take it, the amalgamated company or the resulting company. 35 DDA, Delhi Development Authority, gave a VRS scheme. In the VRS scheme, from the company's perspective, they get again 1/5 every year from the year of payment and 4 more years. 35 AD, congratulations, you've done something which the government has told you to also develop. So super fast bike can cover 3 hospitals, 3 workshops and 3 institutions. These are specified businesses. They will tell you in the exam that this is subject to 35 AD. Now guys, when it's subject to 35 AD, what's so special about it? That you get 100% deduction of any capital expenditure done right now also, yes. And even if it is done previously but it's capitalized now, you get a deduction, except land, except goodwill and financial instrument, no 100% deduction for those cases. Because you get 100% deduction, you have to make one promise, that you have to use the asset for 8 years. And if you don't use the asset for 8 years, because now the value is 0, and if you sell it up to the cost, it will be reversed under PGBP, and above the cost, it will go into capital gain. Guys, here your audit report is compulsory. Also, you remember from set off chapter, you can carry forward the loss and set off the loss only from specified businesses only, and you can carry it forward only if you file your return of income on time. Guys, any capital expenditure made in cash also will not be allowed more than 10,000. All right. Here, guys, second-hand machinery will be allowed up to 20%. And if it's abroad imported machinery which has been used abroad in India, it will be considered new. These are some exceptions to section 35AD also developed. Very important, specified business. 36 have had some specific deductions like insurance, for your stock, for your employees, for your animals. Next, bonus and commission that you pay to your employees. Next, any interest that you pay for a business loans, guys. Business requires loans, so you pay interest. And interest can be taken as a deduction. No interest late limitation, no interest limitation, except it cannot be interest on interest. It cannot be any penalties. And interest on income tax is not okay. Interest on dividend is okay. Deduction on zero coupon bonds. So if you bought zero coupon bonds for 85 rupees and you're repaying them 100 rupees, so that 15 rupees or the 15 lakh is your expense, which has to be spread out on the life of the zero coupon bonds based on number of months. 36(1)(4), very important, 4, 4A and 5. You are keeping your employees happy. You are contributing to their provident fund, superannuation fund, or to their national pension scheme, or to their gratuity fund. In that cases, will you get a deduction? Yes. But for national pension scheme, it is only up to 10% of your salary or 14% in case you're a central government employer. In these cases, guys, you will get a deduction, but you have to pay these amounts by the return filing due date. And in 3615A, it is not your money, it is the slave's money which they have given you to put ahead in these amounts. So they will be added to your income, but minus only and only if you pay within monthly due dates. Guys, this is a very, very strong due date, monthly due date. Next, for animals, you have deduction. For bad debts, you have a deduction, because if someone doesn't pay you, you get a deduction, yes, but no provision, only actual bad debts. And no personal bad debts. If you've given a loan to a friend and he's not repaying it to you, you will not minus that, because that was never included in your income anyway. Guys, bad debt recovery is an income under section 41(4) deemed income. Someone paying you back is an income. Yes, you feel happy that someone's paying you back. But remember, if you wanted 5 lakh as a deduction, but the income tax officer only gave you 3 lakh as a deduction, that means 2 lakh was already taxed. And now if the bad debt recovery is 2,50,000, how much will be taxed under 41(4)? Only 50,000, because 2 lakhs was already taxed. Remember this exception, remember this example when you work ahead. Alright, just one second. Perfect. Next, family planning expenditure, 9 kids, but only allowed to companies, guys, remember that. And this revenue expenditure allowed immediately, capital expenditure allowed in 5 equal installments. STT and CTT, will you get a deduction? Yes, only in PGBP, not in capital gain. 37 is general expense. Any expense which is for business purpose, can you minus? Yes, provided it is not capital in nature, it is not personal, and it is not in the nature of CSR. CSR has been told by the Companies Act, they will give you deduction. Why should we give you deduction? So we don't give you CSR unless it's, guys, is like scientific research, family planning, which we already have included above. Next, 43B. Certain deductions you will be allowed as deduction only if you pay. So they put a huge tree in the middle, if you remember the shortcut tree. So these deductions will you get, guys, when you follow accrual basis of accounting. Even if you don't pay electricity expense, will you get the deduction? Yes. But these expenses you will get a deduction only if you pay by the return filing due date. What is that tree deduction? Tax, railway asset, employees bonus, employees leave salary, employees welfare amounts, and interest to banks, interest to financial institutions, interest to NBFCs. Only these interests, not interest to a friend. If you don't pay interest to a friend, can you still take the deduction? Yes, because you follow accrual system of accounting. So only for these, yes. And you have to file, you have to pay by tomorrow? No, by the return filing due date. What if you pay later? Then don't worry, you will get the deduction in the year of payment. So this year you have to pay by return filing due date. If you miss that, then whenever you pay that year, you will get the deduction. Next is 37(2)B. If you have any expenditure of advertisement in any political souvenir or ads, then you will not be allowed here. But guys, will this be allowed under 80 GGB for companies? Yes, give big, it will be allowed there, but not here, not in PGBP. 40A1 and 40A1A are very similar to poor wins cash income, because here also you're paying to a non-resident or outside India without deducting TDS. 100% will be disallowed. Two things you have to do. Deduction has to happen this year, and the payment has to be made by the return filing due date. Even if one of them is not fulfilled, your 100% will be disallowed. So when will I be given the deduction? Don't worry, in the year you pay, you will get a deduction in the year you pay. Just one second, guys. If in this case, if the person who's receiving the income, they put the income in their return and they pay the tax, you will get the deduction. Yes, in the year they filed their return. And same thing is here, but here the amount is paid to a resident in India without deducting TDS. So if not deducted or not paid, then 30% will be disallowed, but again allowed later on. 48(2) says, yes, sorry, I'm back. 48(2) says interest will not be allowed, income tax, same like poor wins cash income. This one is not important anymore. 48(3) is a permanent disallowance because you're paying outside India or to a non-resident salary. If salary is your employee, you should have deducted TDS. If you don't deduct, then that will be disallowed. 40A5 is basically you have paid for the employee's perquisites any tax. You've given a house to an employee and you paid the tax on it. Income tax is not allowed if you pay for yourself also. So hence income tax is never allowed even if you pay for your employee. 40B4 and 40B5 are, guys, when a partnership firm pays interest, etc., salary, there is a limitation. Let's first see interest. Interest can be paid only up to 12%, only if it's authorized, and only up to the profit. So if your profit is 1 lakh, can you minus 1 lakh 20 as interest? No, only up to profits. Just 1 second. Seems to be some network issue. Yes, back. And guys, once that interest is minus, then you can see salary. Guys, salary can be paid to partners, yes. If it's a loss-making entity, then the only salary you can pay to all the partners in a year is 1,50,000 per annum. Yes, only that much if it's a loss-making partnership firm, LLP. But if it's a profit-making, then you split the profits up to 3 lakhs and above 3 lakhs. Up to 3 lakhs, it is 90% of that amount, or 1,50,000, whichever is more, and above 3 lakhs, it is 60% of the salary. So you will calculate this is the maximum salary that can be paid. Can you pay more than that? You can pay, but the deduction will be maximum this. Can you pay less? Yes, less is okay, but above this you will not get a deduction, and only how much is allowed as a deduction to the partnership firm, only that much is taxable in the hands of the partners in PGBP. Salary can be paid only to working partners. Interest can be paid to working and non-working partners both. So this is the difference between 40B4 and 40B5. This is only for partnership firms, LLPs. 40A2 says that you cannot be excessive or unreasonable to specified persons. Guys, these were earlier related persons. Now this is specified persons. What is specified persons? For you, your relatives, individual. For an HUF, they are relatives. For a partnership firm, the partners and their relatives. For a company, the directors and their relatives. And also in all these cases, specified persons also, specified substantial interest also. That means if I hold substantial interest in an entity or vice versa, even those are specified persons. Cash payment up to 10,000 is okay. In case of goods transport, up to 35,000 is okay. Guys, this is the last section before we take a small break. Let's do till 40A, 9, 10, 11 and then take a break. In these cases, up to 10,000 is okay. For goods transport, up to 35,000 is okay. Above that will be disallowed, guys, in cash. But there are some exceptions. Rule 6DD says deduct in certain cases, like you're paying to agriculturalists, animal husbandry, dairy, etc. No problem. You are paying to some person in a village who does not have banking facility, no problem. If you're paying gratuity, etc. to an employee up to 50,000 in cash, no problem. If you're paying to an employee who's out of office for more than 15 days, and you're paying him salary after deducting TDS, no problem in cash. So there are certain exceptions which are no problem. Otherwise, guys, more than 10,000 is not allowed. Entire thing will be disallowed. And even a liability if you discharge in cash will be disallowed. 40A7 says any gratuity that you put in an approved gratuity fund, in a LIC gratuity fund, will be allowed. And finally, when you pay, only then it will be allowed. Otherwise, guys, if you put in the drawer, then it will not be allowed unless you finally pay it. And 40A 9, 10, 11 says that any abrupt provisions for employees, New Year party, etc. will not be allowed. This will not be allowed. 43CA says that in case you're selling any land and building, guys, then you need to check the stale consideration and you have to multiply it with 110%. There's a small change here. In case of residential properties, it's now 20%, which we'll see tomorrow in Finance Act 2021. But in case of residential accommodation, residential property which is being sold from a particular date to a particular date, only in that case it will be 20%, which we will see tomorrow in Finance Amendment 2021. As deemed income onwards, we will continue when we come back from the break. We've done a lot in this session. We'll do a lot more in the next one. Thank you so much. I'll see you guys now in 15 minutes in the next session. Thank you. Alright, and welcome back. I hope audio is perfectly fine, guys. Audio, video, I hope everything is perfectly fine. We are getting back. I'm just checking for everything, if everything is okay. Looks like everything is okay. Just 1 second. Perfect. Looks like it's all okay. Let's begin. All clear? Let's all clear. Guys, we are back with one short revision. This is not of GST. It's only and only focusing on DT. We will finish all the revision and then we will top it up with an RTP if we get the time today. I think we should. Let's see how that goes. But right now, I'm looking at a complete revision. We are at PGBP. I'm just uploading the QuickBook because that helps us to revise the best. So just uploading the QuickBook. Here we are. The QuickBook is here. We've almost finished a lot of the QuickBook already. So here we've almost done till PGBP, a part of PGBP also we've done. This is clubbing just before that. Yes. Guys, we were looking at deemed income and ahead on PGBP. In PGBP, the golden rule is any income, any expense that looks like a business or profession has to be added and minused, except the disallowances. Now, deemed incomes. Guys, in deemed incomes, there are certain incomes which are not actually incomes, but you're saving money. Like 41.1, where a liability you don't have to pay anymore. Like 41.2, 2 words, balancing charge for SLM assets if you get something more than the depreciated value. 43.3, 3 words, scientific research expenditure or scientific research asset. If you sell that asset, then up to the PGBP, it will be reversed here. And 41.4, 4 letters, DEBT, debtor recovery, will be here. So these are basically deemed incomes. Composite income we've already done in agriculture, not repeating it. 44A is arrange accounts. Are you supposed to maintain the books of accounts and keep them for 6 years? Yes, depending on whether you are in profession, something like this, and business and something like this. What is profession? Profession is all that your parents wanted you to be: CA, lawyer, engineer, doctor, etc. All these are profession. The government likes all of them. So if in all the 3 previous years, if your turnover is more than 1,50,000, only then you need to maintain books of accounts, otherwise don't. And in business, the government doesn't like all of them. So in any of the 3 years before this year, not this year, but before this year, if your turnover increase is more than 10 lakhs, or if your profits are more than 1,20,000, then you need to maintain. For individual HUF, these limits are 25 lakh and 2.5 lakh respectively. This is 44AA. Next is 44AB. 44AB is basically audit the books. Very, very important, guys. Who is supposed to audit the books? For a professional, if your turnover is more than 50 lakh rupees, then go to a CA and get him to check your books of accounts, because the government doesn't believe you. And if you're a businessman, then if your turnover is more than 1 crore rupees, then go to an auditor and go to a CA and get it audited, because the government doesn't believe your tax calculation. Only in PGBP, yes, only in PGBP there is an audit requirement. Guys, next, there is an extended audit limit of 10 crore, but only if your cash receipts are up to maximum 5% of the total receipts, and cash payments are also up to, so both have to be there. Yes, this and this, both cash receipts also and cash payments both have to be up to 5% maximum. But this is audit the books, and you will get an extended due date. For audit, you know the due date is 31st October. Because you have to go to a CA, etc., you will have an extended due date. Alright. Next, guys, some people want to be in a dream world where they can presume their expenses. So 44AD is assume the deductions. In case of businessmen, yes, 44AD is applicable only to residents who are small individuals, partnership firm, not even LLPs and HUFs. If your turnover is up to 2 crores, that means, guys, if you're above 1 crore and up to 2 crores, can you save yourself from audit by opting for 44AD? Yes, you can. But here the government says you need to show at least 8% of your turnover as your profit. And in case of coming into a bank account, if money is coming into your bank account, then 6%. Can you show higher? Yes, higher is okay, but lower is not okay. No other deductions you will get in PGBP, but you can do set off of losses. That's not a problem. Depreciation will be calculated normally. No other deduction, no other remuneration will be given. Once 44AD is used, it's a drug which has to be used for 5 years. Basically, you cannot come out of it for the next 5 years. Each of the next 5 years, you have to use 44AD. If you break the chain, then 3 repercussions will happen. That is that year you will not be able to take 44AD. So audit your books and maintain them and audit them. And the next 5 years, you cannot be under 44AD. Alright. Next is 44ADS, same like 44AD, but for professionals up to having a turnover up to 50 lakh rupees, but they have to show presumptive profits of 50%. Higher is okay, lower is not okay. No chain reaction here. Again, only to resident people and only to individuals, HUFs and partnership firms, not even LLPs. And 44AE is always on the expressway. This is important because it applies to everyone. Resident, non-resident, entity, any entity, individual, company, etc. But only up to those having 10 goods carriages, ownership of 10 goods carriages during the year. On light and medium goods vehicle, it is 7,500 per month or part thereof. And on heavy goods vehicle, what is heavy? More than 10,000, it is 1,000 per ton per month. You can take any deduction. No, you've assumed all deductions. Only interest and salary paid by partnership firm to partners can be taken as a deduction here. All right. And if in any of these cases you want to show lower profits, then you'll have to get your books of accounts maintained and get them audited. That is your PGBP, guys. The first question is always and always on PGBP. Clubbing of income was done. Before we move to the next salaries, let's do set off and then come back to salaries. Yes. Guys, set off is a very nice chapter which gets you a lot of marks in the exam. Set off is basically when you have income, the government taxes you. Same way, when you have a loss, the government says, listen, you have a loss, I will allow you to set it off this year. And if you can't set it off, I'll allow you to carry it forward and set it off in the next years, subject to the sections 70 and more. This is like a blood bank. In case of section 70, can you go to your own family members for blood? Yes. So this is called intra head, or basically within the same head you will go intra head adjustment. And in that case, anyone can go to any head. Salaries will never require to go. IFHP can go, PGBP, capital gain and IFOS, in that you can go within the head, except 4 examples of specified blood, which is speculative business, specified business, long-term capital loss, and horses owning and maintaining race horses. These 4 losses are unique blood. That means they cannot be set off even within the family. Section 71 says that if family is not enough, can you go outsiders? Yes, you can go to outsiders. This is called inter-head adjustment, and in that case you can go, but again these 4 will not be able to go out. Also, in case of salary, in case of house property, you can go out, but only up to maximum 2 lakhs, because they are shy. This is section 71. Under PGBP, normal business can be subject, they can knock on any door except salaries. They don't knock under salaries. And casual income, no one can knock. And no inter-head adjustment for capital loss. Capital loss is non-friendly. That means they can't go out at all. Next is carry forward. If this is not enough, then can you carry it forward to the next year? Yes. But for that, guys, you need to file your return of income within due date. You know that already. Also, it can be carried forward based on certain conditions. IFHP can be carried forward for 8 years. No return filing requirement here. And this is 71B, house number 71B. Normal business can be carried forward generally for 8 years only. So this one is also 8 years. Return of income formality is required within due date. Speculation business only for 4 years because the government doesn't like it. Specified business the government loves, so unlimited number of years. But for all of this except 4 losses, you need to file a return of income on time. Capital loss for 8 years, and horses again for 4 years because the government doesn't like this. Once you go to the next years, you get a quarantine stamp. That means, can you go outside the family now? No. Once you carry it forward, you have to be within the family, only and only within the family. Loss can be carried forward only if ROI is filed within due dates. Guys, there are 4 incomes which can be carried forward even if ROI is not filed, which is income from loss from house property, unabsorbed depreciation, scientific research, and family planning expenditure can be carried forward even if no return of income is filed or if it's filed late. If the income is exempt, then it's not taxed, so same loss will not be allowed to be set off or carried forward. First clubbing and then set off. For the same person, one business loss can be set off against another business income. You can have multiple businesses. Under IFOS, only loss from horses can be carried forward. Unabsorbed depreciation breaks the quarantine rule. Basically, it can be set off even against other heads except salaries. Loss from a discontinued business can be set off same way, just like normal business loss. And there is an order of set off and carry forward. If it's coming from previous years, you will first take current year. Then you will take previous years but loss, business loss. Then you will take unabsorbed depreciation, scientific research, and family planning. So basically, this is a series. And open the fridge, and when you open the fridge, you will first consume that which will expire first. This is set off. Very small chapter, got over in just 3 minutes revision. But the best thing to do is do sums in this. We've done a lot of sums. You should also practice a couple of sums at this juncture. Illustrations, RTP, etc. This we are anyways going to do when we do the RTP. Now guys, looking at capital gain. Before we go to salaries, we'll look at capital gain. Capital gain is basically the 4th head of income, and it starts at section 45 and it goes on till section 55. For capital gain, you need ATSCP. It should be an asset. An asset is basically to section 214. Asset is property of any kind except 4 things are not assets, but spare personal land, but spare personal asset, but spare personal land also you can write. That is basically agricultural land, rural agricultural land. Personal mobile assets except SAT jaw. That means your mobile is not an asset, so no capital gain when you sell it, but your jewelry is. Stock and some bonds, these are not assets. Other than that, everything is an asset. Transfer. Transfer includes everything: sir, extinguished and compulsorily converted zero coupon bonds. So sale, exchange, relinquishment, extinguishment of an asset, compulsory acquisition because they pay you money, conversion of what? Capital asset into stock. But I have not sold it. How will I have the money? Don't worry, we'll tax you only when you sell the stock. And discount or redemption of zero coupon bonds. All these will be subject to transfer. The sale price can be manipulated, and hence whenever you sell, we will check the sale price first against 50C. We will check your sale price into 110%, and if stamp duty value is within that range, no problem. If it's unlisted shares, then 50CA, we'll check it against the fair market value. And if you say you can't determine it, I will determine it under 50D. That is what the Income Tax Act says. Period of holding. It's important to know the period of holding because long term, short term matters. So for period of holding, it's basically more than 36, more than 24, and more than 12 months. More than 36 for all assets. More than 24 is for 2 assets, which is unlisted shares and land and building. And more than 12 months, guys, please tell me for which one. It is only for listed Zoom. What is listed Zoom? Excellent. Any listed security, any bonds, debenture, etc. which are listed, any zero coupon bonds, any units of UTI, any units of equity oriented mutual fund. For these 4, the period of holding, if it's more than 12 months, that becomes long term. If it's long term, you get many benefits like indexation, etc. And that's when we go to cost. There are 2 kinds of cost: cost of acquisition and cost of improvement. 1 second, guys. Cost of acquisition is whatever you bought the asset for, including all the registration, stamp duty, all the costs incurred till bringing the asset to use. Anything before 1/4/2012, anything before 1/4/2001, you can take the FMV as on 1/4/2001. That's an option, but the FMV cannot be more than the stamp duty value in case of land and building as on 1/4/2001. In case of cost of improvement, any capital expenditure, but anything before 1/4/2001 has to be ignored. For intangible assets, guys, everything is 000 unless you purchase the intangible asset, then there will be a cost of acquisition. That is your cost. Guys, both the cost can be indexed, yes, if the asset is long term, yes, depends upon asset, and it doesn't depend upon the cost. Preetham, hello sir, sorry to interrupt. I started watching recorded classes of yours, GST lectures, and amazing, and no one explains the law like you. Thank you so much for that compliment. Make sure you watch DT also, and make sure you enjoy. Preetham, let me know how you like DT as well. Perfect. Thank you. All right. Guys, this is ATSCP. Moving ahead to once you get ATSCP, guys, you will get your capital gain. But here some more things. Thank you guys for the compliment. Makes my day. All right. So Preetham, you should also join this Telegram link in case you have any doubts in future. And there's also a link which I'm putting up here, which is of the Google Drive. You can also use that to access any notes, etc. that you want. This is it. Just copying it. Perfect. All right, moving ahead, guys. Thank you. Guys, generally it is taxable in the year. Generally, it is taxable in the year of transfer, which is section 45(1) says it. But there are certain in the year of transfer, but there are certain exceptions. Just 1 second. Perfect. Okay. So there are some exceptions like 45(1)(a). 1A is for accident, guys. Whenever there is some accident like fire, etc., and in that cases, it will be taxable, but only in the year you receive the insurance compensation or you receive the asset from the insurance company. 45(2) says that in case of transfer, where you're transferring the capital asset into stock, you'll have two calculations. One is capital gain 80 SCP and one is stock. But what will be most used is the fair market value as on the date of conversion. That will be the sale price here and that will be the cost here as well. This will be taxed only in the year the stock is sold. If it's fully sold, fully, otherwise part. 45(2)(a) says in case of angel broking your demat account, you will always follow FIFO method for both the cost as well as the period of holding. 45(3) and 4 are fortunately not there for you. 45(5) is basically when you wanted 5 crore rupees for your enhanced compensation or for your bungalow. So you got 1 crore first initial compensation and then you got 4 crore. Then in that case you'll have to do 280 SCP calculations, but both in the year of receipt. In the second one you cannot minus the cost because you've already minus that, but litigation expense you can minus. And 45(5)(a) is when you want to make 5 additional floors, that is joint development agreement. Guys, in that also just follow 80 SCP, but this 80 SCP will happen in the year of CC, that is year of completion certificate. And when you do 80 SCP, the flat or the additional space that you're getting, the stamp duty value will be on the date of CC. Perfect. These are some different sections. Next, guys, once you're done with this, there are some additional sections. One is section 47, which is not really important. But this says that they look like transfers, transactions that look like transfers, but will not be subject to capital gain. That is not important for CA Inter, but I'm just telling you that if an HUF on the partition, if they transfer assets to the members, then it looks like 80 SCP, but it will not be subject to capital gain. When under a gift, will, inheritance, if you transfer an asset, then it will not be subject to capital gain. For the receiver, it might be subject to IFOS gift taxation, but for a transferor, it will not be subject to capital gains. Next, when a Reliance gives an asset to Jio, wholly owned subsidiary in India, or when Jio gives an asset to Reliance, a wholly owned parent in India, then in both these cases, the intention is not to make money and hence there is no capital gain. Next, in case of amalgamation, when one company like Vodafone gives the assets to Idea, or the shareholders of Vodafone get shares of Idea, then in that case there will be no capital gain. Same for merger also, there will be no capital gain when Jaguar Land Rover transfers certain assets to the next Tata Motors. In that case and shareholders case, again it will not be subject to transfer. And most important, sovereign gold bonds. When you give sovereign gold bonds to the government after 8 years, redemption of sovereign gold bonds, then in that case these SGBs will not be subject to transfer. You will make money, but there will be no capital gains, which is a very good thing. So sovereign gold bonds are very, very important, but only on redemption after 8 years. Next, there is a section called section 46 in which Kingfisher Airlines is used. Kingfisher Airlines, which is going under liquidation, and when they exchange an asset with a shareholder, that will not be subject to capital gain in the hands of the company. But for the shareholder, because he is getting an asset in exchange of shares, there will be 80 SCP in the hands of the shareholder under section 46(1), no capital gain, but 46(2), there will be capital gain. Next, guys, after this is section 50, where PGBP meets capital gain, guys. Here both the sections are meeting. So if you have a block of asset and you're selling, example, 4 ambulances, if you sell part of the block or you sell the full block, if you sell the full block, there is no block now, so 4 ambulances worth, let's say, 40 lakhs. If you sell all the 4 ambulances for 32 lakhs, then the 8 lakh will be a loss. That is a short-term capital loss. Why short-term? Because depreciable assets are always short-term. But if the same 40 lakh assets you sell for 42 lakhs, then again this 2 lakhs will be a profit, which is always going to be short-term capital gain. Short-term, capital loss, capital gain, because the full block is being sold. But guys, what if only a part of the block is being sold? So 40 lakh worth of ambulances, only one ambulance is sold for 10 lakh rupees, then no problem. You have a positive balance, continue depreciation on the 30 lakh 3 ambulances. But what if one crazy guy, for that 40 lakh, one ambulance, he pays 47 lakh? So then you have a profit of 7 lakh, which will be called short-term capital gain, and you will not do any more depreciation because the value has become negative. So no more depreciation. This is section 50, full block and part block being sold. Next, guys, is section 51, auspicious amount. When there is any forfeiture before 1/4/2014, and there is a forfeiture of an amount, let's say 51,000 rupees was paid as an advance for an asset, and this is forfeited, what they will do is they will not tax you on this 51,000 now, but whenever you sell AT-SCP, then your cost will be reduced by this 51,000. Reduction of cost means increasing the gain. First they will reduce and then they will index if indexation is applicable. Next, guys, assets are classified into two categories: normal assets and listed UU. Section 48 says that you will take the sale consideration, you will minus three things: expenses on transfer, index cost of acquisition or cost of acquisition, or index cost of improvement, cost of improvement. So only three things to be minused, yes, and that's when you get your capital gain or loss. In this case, there were some provisos. Inflation 3% bonds stable. So indexation will only and only be for long-term capital assets, but on three assets, that is listed UU, listed equity shares, listed units of equity oriented mutual fund, and listed units of business trust. Business trust we will see at CA final. In these cases, there will be no indexation. On bonds and debentures, they don't change in value, so no indexation, except sovereign gold bonds and inflation index bonds. And STT, CTT, will not be given to you in capital gain head. It will be given to you in PGBP, but not here. But here you get indexation. All right. Now, guys, Arun Jaitley gave a speech. On that speech, on the 31st of Jan 2018, he said that capital gain will now be applicable on listed UU. Earlier, it was not applicable. So, any asset that you bought listed UU before Arun Jaitley's speech date and selling it after Arun Jaitley's speech date, then in that case, on this date, you will have to find out a new cost. What is the new cost? Old cost of acquisition or new cost of acquisition, whichever is higher. And what is this new cost? The new cost is basically nothing but the lower of FMV as on 31st Jan 2018, Arun Jaitley's speech date, or the sale price, whichever is lower. So let's say you bought a share for 100 rupees. The FMV is 130 and the selling price is 150. So lower of these two is 130 and the higher of these two is 130. So 130 rupees will be your new cost of acquisition. So this is Arun Jaitley's speech and Arun Jaitley's cost. This is only and only for listed UU, which are bought before Arun Jaitley's speech and sold after that, and that to long-term capital gain. All right. Now that you know capital gain, guys, capital gain can be exempted under different sections. For individuals and HUF only, there is section 54, 54B and 54F. Everyone, let's focus on this. 54 is a house for a house. So what house are you selling? You can sell any residential house property, yes, but it has to be long term, yes. Not land, no. You will first calculate long term capital gain, and that long term capital gain has to be bought a new house with. Yes, you can buy one house, and if your long term capital gain is up to 2 crores, you can even buy two houses only once in your lifetime. The house has to be acquired within 2 years after the date of transfer or 1 year before, and if it's constructed, then it has to be constructed within 3 years. Till then, you cannot misuse the money. You have to put in capital gain account scheme, and if you want, you can also buy bonds under 54 EC. The new house has to be held for 3 years close to you, and if you sell it within 3 years, then the cost will be reduced. There's no offense, it's only that the cost will be reduced whenever, and you can use 54 as many times as you want in your life. Next is 54B, again for individual HUF. Here you're selling an agricultural land and you're buying another agricultural land. The selling land has to be urban, because rural there is anyways no capital gain. In this case, it can be short term as well as long term, doesn't matter, because agriculture, government loves agriculture. The new land should be bought within 2 years, held for 3 years. All of the same provisions apply here as well. And 54F is slightly different, because here you're selling any family's assets like gold, shares, any land also, yes, except house, anything here, and you're buying a house property. In this case, be very careful. This has to be a long-term capital gain, and the net sale consideration has to be invested. If the net sale consideration is 1 crore, you have to invest 1 crore. What if you invest 80 lakh? Then if you are doing only 80%, the government will also do only 80% of the exemption. The new house has to be bought within the same time periods, has to be held for 3 years. Everything is the same. For others, there is another exemption which is given in section 54D and 54 EC. 54D is demand. You had some industrial land and building which they've demanded, so there is compulsory acquisition, yes, and you have to buy some new industrial land and building. But here it can be long term as well as short term, because they can demand any time, and you'll have some capital gain which you have to invest ahead. Within 3 years you need to buy the new industrial land and building. Other things all remain the same. What is 54 EC? Guys, capital gain account scheme, you have to invest by the return filing due date the money in the capital gain account scheme. 54 EC is ease of capital gain, is basically can be any long term capital gain on sale of residential house property, or including land, yes, including land, and within 6 months. So first you will calculate this, and within 6 months you have to invest in certain bonds, NHAI, REC, or any other specified bonds. You can do maximum 50 lakhs here. You have to invest within 6 months. You have to hold it for 5 years. You can't even pledge, you can't even sell. And if you do any of that, it will be taxable. The exempted long term will be taxable in the year of sale. Alright, so this is 54 EC, and 54H says that in case of compulsory acquisition in any of the above cases, you have to hold on the timeline of further investment till you receive the money. Alright. And last, guys, capital gain has some specific taxation. Only in capital gain, no other head has some specific taxation. For that, you need to bifurcate the assets into normal assets and listed UU. Normal assets, short term capital gain has no benefit. Why? Because the government doesn't like short term, but long term you get indexation first, and after that you will be only taxed at 20%. This is a section called section 112, and that too you can minus the basic exemption limit. Non-residents can't minus this, but otherwise you can use your basic exemption limit against this, yes, but only unutilized. Why? Because first it will be used against normal incomes, only then against this. And guys, what time do you buy your listed shares? Listed UU means STT has been paid. Then in that case, if it's short term or long term, you always buy it at 10:15 in the morning. Right now almost like 10:15, exactly 10:15, guys. Look at the watch, exactly 10:15 on the watch, and we are talking about this. Amazing. So in long term it will be taxed at 10%, only above 1 lakh. So entire thing will go in total income. Yes, guys, if you have 1,20,000, entire 1,20,000 will be your income, but taxed will be only on 20,000, and this will be at 15%. I can't believe that luck. And it will be at 15%. Yes, it will be at 15%. Perfect. This is section 112A because long term, and this is 111A. Can I use the basic exemption limit? Yes, but non-residents can't use it. So how will I use the basic exemption limit? First against normal incomes, then generally against this because it's 20%, then next against this 15%, and then next against this. All right, perfect. That is capital gain chapter. Guys, in that there is one thing which I want to discuss more, which is slump sale, which is section 50B. Now in case of slump sale, Thara has a doubt. Let me just check. So I'm a little confused here. Is rebate applicable for 112, 112A and 111A? Rebate is not applicable for 112A and 111A. Listed you don't get rebate. Alright. Don't worry so much about it, Thara. Don't miss the bus for that one small thing. So focus on this. Rates of tax we'll do at that point anyway. So don't worry. But rebate on listed UU is not applicable. Don't worry about that. Alright. Section 50B. B is Britannia slump sale. Am I transferring an entire undertaking? Yes. ATSCP. Asset transfer, sale price, but what is the cost of that undertaking? Period of holding, if it's more than 3 years, then long term. First up, no indexation in this case, no indexation. And what is the cost? The cost, guys, used to be is the net worth. Sorry, the cost is the net worth. There is some change in the Finance Act 2021 in this case, which we will discuss tomorrow. But right now, the net worth is basically the cost So of land which is non-depreciable, you will take the book value. Of depreciable assets, you will take the WDV and you will add up this. And from this, you will minus the liabilities of that undertaking which is being sold, assets and liabilities of the undertaking which is being sold. Perfect. Alright. This is section 50B. 50C is very similar to gift taxation. Stamp duty value is the same. 50CA, 50D. We've done almost everything. Yes. As that is the chapter on capital gain. The more sums you solve on this, the better you will get. And now let's look at the last head of income, which is salaries. Okay. Guys, salaries is when you are an employee, employer, when you are a slave and you have a master, that is salaries. Now we have to look at it from only and only 6 places. SAP minus SEP. If you remember this, guys, SAP minus SEP. I'm just going to take 1 minute before we move ahead. Alright, so let's do SAP minus SEP. Guys, for salary, all you need to find out is these 6 letters. Whenever you do salary, you will first take the salary. It could be basic salary, it could be dearness allowance, it could be any of those. You will take the allowances minus the exemption and the perquisites. And when you get that final amount, you will minus 3 deductions. We are starting off with that first. You will first minus a standard deduction under section 16(1)(a) of 50,000. If your income is lower than that, then lower, but otherwise 50,000. Entertainment allowance deduction is only if you get entertainment allowance, and the deduction is only for government employees. It is least of the following. 1 is the entertainment allowance that is received. Next, 20% of basic or statutory limit of 5,000 per annum. And professional tax, if you have paid or your employer has paid, then you will get a deduction. Don't worry, whoever has paid, you will get a deduction, but only on payment basis. That ends your SEP. So now let's focus on SAP. In case of SAP, the first one is salary. Guys, whatever it be it called, the government wants to tax everything, whether it is basic, whether it is dearness allowance, whether it is commission, whether it is any bonus, whether it is Pongal bonus, Diwali bonus, Valentine bonus, whatever bonus, whether it is called wages, whether it is called remuneration, whether it is called pension, whatever it is called, the government wants to tax it under the head salaries. But while you're doing this, keep in mind a specific calculation of B, D, C. What is B? B is basic. What is D? D is that dearness allowance which is forms part of retirement benefits. And what is C? That commission which is a percentage of turnover, not a flat commission. This is BDC. Keep it in mind, although everything will be taxed, but just keep this in mind for calculation purposes. Salary is taxed on due basis or receipt basis, whichever is earlier. The government is very smart. And salary which is foregone still follows you, it will still be taxed, but salary which is surrendered finally stops. Any loan that you've taken is not in part of salary because it's a liability, but if you've taken advance salary only, then that advance is received, so it will be taxable. Next are allowances. Guys, allowances are like pocket money. A for allowance, A for add. So any allowance you will get, you will blindly add it. Yes, you will blindly add it first. You will add the allowances. Let's say you get an allowance of 1 lakh rupees for HRA. You will add it first, and then you will see this list. HRA can demotivate and hurt heartbeat. HRA exemption is given under a section called section 1013A. You can minus HRA exemption, but only to the least of the following. What is first? The HRA that you have received. Second, the rent that you paid minus 10% of salary. Salary is BDC. Or third, 40 or 50% of salary, depending on if you stay in metro or don't stay in metro. Metro is only Mumbai, Delhi, Chennai and Calcutta.
Guys, here the salary is BDC, and this exemption you will get only if you are paying rent, only if you have actually rented. If you have not rented, allowance you can get, but exemption you will not get. Next, can demotivate hurt. Conveyance allowance, daily, helper, uniform, research and tour and transfer, all these you will add and you can minus the amount that is spent. But guys, conveyance from home to office and back is not amount spent, that you cannot minus. And last one is, guys, heartbeat. In that case, these are from fixed amounts you will minus. So you will take the allowance, you will add it. But for children's hostel allowance, you can minus only 300 per month per child, maximum 2 children. For education, only a very petty 100 per month per child, maximum 2 children. For blind, handicapped, deaf, mute people, for home to office and back, 3,200 per month, that you can minus. For area based allowance, depends on different area, underground 800, tribal 200, etc. per month you can minus. And last is transport sector employee like pilots, TTs, air hostesses, etc. they can minus. If they get the allowance, they can minus 10,000 per month or 70% of the allowance, whichever is lower. How you'll remember? Because it's a minus, they will only give lower. This is under section 1014. Even can demotivate hurt was under section 1014. Besides that, movie allowance, popcorn allowance, medical allowance, servant allowance, gas allowance, non-gas allowance, whatever allowance you will add, but there will be no exemption from these. But some people got upset. 2 judges went for UN abroad. So employees who are working abroad, 10(7) allowances are exempt. UN employees working in India, allowances are exempt. And 2 judges, High Court and Supreme Court, those judges getting allowances, those are exempt. So we can't tax them. No, we can't tax them at all. Next, guys, are perquisites. Perquisites, golden rule. Are you benefiting? Yes. Is it a benefit? And if you're benefiting personally, then the government would want to add it. Let's see what are perquisites here. Back to back, let's do perquisites. Accommodation which is leased by your employer, then whatever lease rent he is paying, or 15% of your salary. Your salary is different, guys, it's not BDC. Salary includes everything, but no OD, other dearness allowance you cannot take. You cannot take any arrears or advance salary. So salary you can take everything. Allowance is only taxable, and perquisites only monetary perquisites you will take. That is your salary definition. If accommodation is not leased but owned by the employer, then it will depend upon population. 7.5, 10 and 15% depending on population. More than 10 lakh, 10 to 25 lakh, sorry, up to 10 lakh, 10 to 25 lakh, and more than 25 lakh. If furniture, then if the furniture is leased, then whatever lease rent is being paid by the employer, and if it's owned, then 10% of the original cost. Guys, if more than one accommodation is provided, you can take one of them, the lower one, up to 90 days, but after that you have to take both. If accommodation is provided in a remote area like a mining site, etc., then it will not be included, because where else will you stay in that case? Hotel accommodation, it's slightly more expensive, so it will be 24% of your salary, but up to 15 days, no problem in case of tours and transfer. Next, gas, electricity, water, whatever is the employer paying. In case the employer is generating it, then the generation cost. Domestic servant, whatever the employer is paying. Education facility, for you, your MBA is free. For your spouse, your children, whatever the employer is paying will be added. You will, for children, you will get 1500 minus. But if you selected the institute, then no minusing 1500 up to 2 children. Transport facility will be added unless your employer is an airline company or a railway company. Medical facility in India, very, very important. First, only for your family. Family includes self, spouse, children, parents and siblings if they are dependent. And in that case, if it's private medical, it will be taxable. But if it's government or self-owned or commissioner approved, then it will not be added. It will be exempt perquisite. Outside India, it is always exempt. Travel, stay and treatment +1 also. But travel is exempt only if you're poor. That means your GTI is up to 2 lakhs. Motor car, we've not discussed. I'll discuss it tomorrow with other amendments. I'll discuss this one small thing. I have a small list of pending items for you all. But generally, guys, motor car is a benefit to you. Yes. So if the motor car is owned by your employer, then 10% of that original cost will be added. If there's a driver which is being paid for, that driver's salary and the actual cost of fuel, etc. will be added. Very, very simple. We'll see it tomorrow again. Next, movable assets. If you're using any laptop, computer, mobile phone and journals, no problem. But if you're using projector, etc. for personal use, 10% of the original cost, or if it's rented, then rent paid. And if you're buying it, then whatever is the depreciated value minus whatever you're paying, that is the value of perquisite. In this case, depreciation rates are different, 50%, 20 and 10. These are WDV and this is SLM. And it is based on completed number of years. If after 10 years it's sold, then no perquisite, and if the employer manufactures those projectors, then no problem. Guys, just 1 minute. Lunch refreshment, if during office hours, up to 50 rupees, no problem. Above that will be a perquisite. And if non-business hours, then definitely a perquisite. For tea, coffee, snacks, it's never a perquisite. In remote areas, lunch, the entire lunch is not a perquisite. Gifts up to 5,000 in kind is okay. Above that will be taxable, and in case of cash and check, no threshold limit, everything is taxable. Credit card, clubhouse, taxable. Loan, medical loans and up to 20,000 aggregate loans, no problem, but above that aggregate will be taxable on the beneficial interest rate only for the months that you use the loan. And in case of medical insurance, you get receiving the amount, you have to pay it by the month end, otherwise it will be taxable. Holiday is taxable. Sweat equity shares, you have to find out what is the FMV and you have to find out how much are you paying. This all you have to find out on the exercise date, the day you agree. This is called the exercise price. This is the FMV, the average value, the opening plus closing divided by 2. The highest and lowest price divided by 2 on the exercise date. And if it's unlisted shares, then you get an investment banker to value it. And leave travel concession, you should holiday in a block of 4 years, 2 holidays if you take, and an employer pays for your airfare, railway ticket, bus ticket, etc. Closest, shortest route possible, then you can minus it. First you will add it and then you will minus it. For self, spouse and up to 2 children you can minus. And any other benefit which is not listed here also you will add it to your perquisite. If your employer is paying any of your liabilities like your salon bill, etc., your employer pays, that is a perquisite. If the employer is paying your taxes also on the perquisite, for him it will not be allowed as a deduction, but in your hands it will not be taxed again, because guys, your perquisite is 1 lakh. On that tax, 10,000 is paid by the employer. Is this also a perquisite? Yes, but this will not be added because then the chain will never stop. And any amount that you paid contribution will have to be minused. So any amount that the employee pays to the employer will be minus from the perquisite value. There are some employees who are called specified employees, 50 substantial directors. That means 50,000 and more if your salary is there, or if you hold substantial interest, or if you're a director, then only these perquisites will only be taxable. In case of specified employees, it's useless, this definition, because every employee earns more than 50,000 and hence every employee is a specified employee. Educated servant, transported gas, medical gas by car, that's the shortcut here. Guys, 2 exceptions. Salary received by MPs, MRAs are not taxed under this head but taxed under IFOS, and partners are taxed under PGBP. Foregone, surrender, yes, all we've seen. Employer-employee relationship we've seen. Employee can be part-time also, guys. Alright. National pension scheme, when your employer has contributed to a national pension scheme, the entire amount will be taxed in your hands, but don't worry, you'll get a deduction under 80 CCD2, which we will discuss ahead in deductions and entire NPS relief. Guys, sometimes you get arrears of salary which you did not know and hence it was not taxed earlier. Like Air India paying you 5 lakh rupees more. In that case, you will go to current year, you will calculate the tax on the entire salary including the arrears and without the arrears, and you'll find out how much extra you're paying this year. This is current year. If the same arrears were paid that year, then including arrears and excluding, how much extra would you pay that year? So let's say this year you were paying 1 lakh extra and that year you would have paid only 60,000 extra, then you will get a relief of 40,000 under section 89. This is only in case of arrears and advance salary. Alright. Guys, retirement benefits. You get a lump sum amount. All these, if received during employment, are always and always taxable. But otherwise, if received on retirement, you'll get certain exemptions. Gradually, people leave, retire, voluntarily retire, post service. Surgeon loves government position. Gratuity is a big thank you, so 20 lakh limit. Covered by POGA, not covered by POGA. Remember the difference. And if received by a government employee, then it's fully exempt. Surgeon loves government positions. Any gratuity received during employment is fully taxable. Any pension received during employment, taxable. Pension, monthly pension, always taxable. But lump sum pension, guys, for government employee, exempt. For you, it is exempt up to half the total salary. And if you're also getting gratuity, then 1/3 of the total salary. Leave encashment, if you get some leave encashment, lump sum, then is exempt for government employees. During employment, taxable for all. But for others, it is exempt. You have to calculate leave, salary pending, etc. Leaves pending in terms of months. This voluntary statutory limit is 3 lakh. Next. Retrenchment compensation. If you're fired from your job, industrial workers, and you get some money, this is very similar to gratuity, BDOD, same thing. VRS, if you get voluntary retirement, will you feel nostalgic? Will you see behind and will you see ahead? Yes. This one, guys, you will get an exemption. Statutory limit here is 5 lakh rupees. Here also retrenchment, also it is 5 lakh. Here also it is 5 lakh. You will see behind, completed number of years into 3, and you will see ahead, that is number of months pending till retirement. Provident fund, very, very important. Statutory provident fund, contribution by the employer, exempt. Interest you earn, exempt. And when you withdraw, exempt. Recognized provident fund, when the employer contributes, exempt, but only up to 12% of salary. If he puts more putting is allowed, but you will be taxed. Interest exempt up to 9.5, but this is not a problem because right now interest rates anyways are low. And if you withdraw after 5 years, it is exempt. Within 5 years, it will be taxable, unless, guys, it's because of any closure of business, unemployment, etc., illness, etc. And URPF, which is put in the drawer, it is not taxed at the time of contribution because you have not got it. Interest also you have not got. But when you finally get it, will it be taxed? Yes. Why no exemption? Because the government doesn't get to use this, and it will be taxable. This and this under salaries. And if you have contributed and you have earned interest, that part will be under IFOS. Alright. And superannuation fund, not very important, guys, but superannuation fund is also exempt. Employer's contribution up to 1.5 lakh rupees. So if your employer puts in your superannuation account 1,55,000, then 5,000 will be taxable under salaries. Don't forget to do SEP. Standard deduction is very, very important. And with that, guys, we've completed all the 5 heads. With that, we've completed clubbing and set off also. Now over to deductions, TDS, TCS, and return of income, rates of tax. We will take a 2-minute breather here and we will come back to look at deductions. 2 minutes and we are back. Thank you. Alright, so let's continue, guys. Here we are on deductions under chapter 6A. Guys, this is in the exam, will be sprinkled in a lot of different chapters, in a lot of different sums. Thank you. You have to identify the section. Every section has shortcuts. And from your GTI, can you minus deductions? Yes. So in the exam, if they say find out your total income, then you definitely have to calculate deductions. Some small pointers. Whenever you calculate deduction, remember 80 TTA and TTB can be hidden. They will not tell you. 80 GG, which is Ghar can be hidden. And whenever you see 80 GG or 80 G, especially the third and fourth category, you have to do these last because you need to find out your adjusted total income. Alright, and with that, let's start. Your deductions cannot be more than your GTI. In fact, more than the available GTI. What is available GTI? Guys, your GTI can have casual income. Your GTI can have 112 LTCG income, 111A income and 112A income, etc. These incomes, the government doesn't want you to deduct any deductions. So from your available GTI, you cannot minus these, you cannot minus any deductions from these incomes. So you'll have to separate your GTI into available GTI, mentally guys, not actually, and unavailable GTI. And let's say your available GTI is 8 lakhs, so your deductions can only be up to 8 lakhs. This is what section 80A says. Aggregate deductions cannot be more than the gross total income which is available. Next section, guys, is one of the main sections, 80C, where you are contributing to the economy and hence is applicable to all residents and non-residents, but both only individuals and HUF. Girls' life now needs 5 senior assets: Provident Fund, Mutual Fund, Shares and Debentures with ULIPs, National Housing Bank loan and Indian education. Sukanya Samriddhi contribution, life insurance contribution up to those specific limits, even for your family members, even abroad, even if they are independent. Family here is self, spouse and children only. NABARD, National Savings Certificate, 5-year deposits, senior sitting accounts, annuity plans, Provident Fund including PPF, yes, mutual fund, specific shares and debentures and ULIPs, a house, very important guys, principal repayment a house, the loan should be from specific sources, the house should be ready, and it includes stamp duty and registration charges also, NHB bonds and Indian education fees for your children, not for yourself, up to 2 children, only in Indian education, not capital expenditure. This guys is under 80C. Remember here you have to contribute for yourself except life insurance, where you can contribute for your family as well. Family definition here is very, very small. This one is 80C. 80CCC is care. Again for individual HUFs, you are contributing to LIC, annuity plans. And 80CCD1, you are contributing to National Pension Scheme up to 10% of salary or 20% of GTI. And all these three, are they within an umbrella or an extent of 80CCE? Yes, of 1,50,000. So that means guys, your NPS contribution already has a capping inside also and outside also. Yes, I am never able to contribute to NPS because my entire deduction goes in 80C PF, entire 1.5 lakh. So unfortunately, I am not able to contribute and take a deduction for NPS. So I went to the government and I complained to them. So the government says no problem, we will give you an additional benefit 80CCD1B, which is outside this limit of 1.5 lakh, where you can contribute your self contribution and you can take a deduction up to 50,000. So both these are your contribution. Yes, both these are your contribution. So in the exam, if they say NPS you have contributed, check how much you have contributed. You can spread it between this and this. Alright. Now what if your employer contributes? Let's write that here. Then there are 3 repercussions. First, your employer will get a deduction under PGBP section 36, but only up to 10% or 14% of salary for central government employees. Whatever deduction he gets, you will also get under 80CCD2, same thing. Yes, so you don't have to do any new calculation. Yes, same thing you will get. This is for your employer contribution. But why are you getting 2 deductions for the same expense? Because whenever he contributes, it is added to your salaries. So let's say he contributes 1 lakh, it will be added to your salaries. And either 1 lakh, or if that is more than 10-14%, then only 80,000, let's say if that is within the limit, only 80,000 is the deduction. So on deduction, do they have a limit? Yes. But on income, do they have any limit? No, income will be full. So that's the reason you have two deductions. So guys, this is employer's contribution, this is employee's contribution. I hope you understood this. So I'm adding 80 CCD2, but CCD2 is for employer's contribution, master's contribution 10% or 14%. Guys, what is salary BDC? Do a practical sum on it. Very, very important. In December exam, this was asked in a paper for 7 marks. Alright. So 80 C series is over. Now I'm going to the D series. Guys, going to the D series here. Going to the next page. In the D series is also applicable only to individuals and HUFs. And because you're contributing towards medical insurance, both residents and non-residents, both it is applicable. Here the family size is self, spouse, children and parents also. Yes, very, very important from an exam perspective. In this case, your limit is 25k, and if any of you all are senior citizens, then 50k. You can contribute to medical insurance, also to central government health schemes. And you have medical checkup also, but that we will see last, because first you will exhaust your limit with this. For parents also 25k, and if the parent is a senior citizen and a resident, then 50k. They can contribute towards medical insurance, you can contribute for your parents. And guys, here, if your parent cannot be insured and they are senior citizen and they cannot be insured, or they don't have insurance, then you can also take a deduction for their medical treatment, but both within the same limits. Yes, so first you will check this limit. This has to be paid only in check. Yes, only in check, not cash. But besides this, guys, no, including this, we have a 5,000 limit for checkup. This is a shared limit. Both have to share it, and this is within the limit of 25 and 50k. That means, guys, if the limit is over, then you will not get checkup. But if the limit is not over, then can you take checkup? Yes. But overall checkup cannot be more than 5,000, shared between the two categories. And this checkup can be also paid in cash. Can you also pay lump sum amount under 80D4A? You get a lump sum amount deduction. Yes. So if you pay 1 lakh rupees for 4 years, will you get a deduction divided by 4? No. You will get a deduction divided by 5. 4 plus 1 always. Why? Because it basically is the number of financial years it covers, unless the policy has been taken from 1st April only. This is health insurance 80D. Here the family size is slightly bigger. Next is 80DD, disabled dependent. In case of disabled and dependent, D and D, it's a flat 75k and flat 125k if disability is 80% or more. Individuals and HUF, here the family increases, also includes your siblings now. But because it's an automatic deduction without any expense, it is only applicable to residents. And 80DDB, double dangerous bimari, again guys, applicable only for individuals, HUFs, and because here you're not spending for the benefit of the economy, only applies to resident. Good thing you don't have to buy hard this. And in case of 80 double DDB, double dangerous bimari, whatever the amount you spend, you will get a deduction of maximum 40,000. And if the person who's sick is a senior citizen and a resident, then whatever you spend, maximum 1 lakh will be a deduction. Guys, here you will first compare. So let's say you spend 55,000 or 40,000, whichever is less. So you will get your answer 40,000. First you compare, and then if you get some money from insurance premium or from your employer, you will minus that. Let's say 10,000 from insurance and 8,000 from your employer. So your deduction will only be 22,000. So first compare and then deduct. How do you remember? First D comes and so first C comes and then D comes. This is 80 DDB. This D series is now over. We are going to the E series, guys. The entire E series is for things which are expensive, that is interest, and it is only applicable to individuals. First one is 80E. You've taken a loan for yourself, spouse and children. Here the family size is again very small, and the interest that you pay on that loan only on payment basis. Yes, only if paid. For how many years? For 8 years. The first year of payment and 7 next years. Is there any limit? No limit. Only thing, in deduction chapter, the loan should be from legitimate sources like bank, financial institutions, etc. only. 80EE is not important for your exam because this is definitely never coming in your exam in writing from me. But 80EEA is easy EMI again, which is very similar. It's like Batman Returns. This is the next sequel of 80EE. Very, very important. Here, you get an interest deduction of up to 1.5 lakhs. But I anyways get interest deduction in IFHP 24B. But this is over and above that, yes. There you get SOP of 2 lakhs. Here you can take the balance. And there in LOP you can take 2 lakh because only set off of 2 lakh is allowed. So here you can take the balance. But there are some conditions here. This should be a first house property. It should be a residential house property. It can be SOP, LOP, both, doesn't matter. It should be basically bought between, or the loan should be sanctioned between 2019 to 31st March 2022. And most important, the stamp duty value of the house should be maximum up to 45 lakhs. Maximum up to 45 lakhs. Then you can take a deduction. Again, only for individuals, yes. And very also very important is electric bikes. 80 EEB easy electric bikes, if you remember the shortcut. Here you will get a deduction of 1.5 lakhs for the purchase of an electric vehicle, provided the loan is sanctioned between 1st April 2019 to 31st March 2023. The loan should be from a bank or financial institution, even NBFC. Only here NBFC is not allowed. In EEA, NBFC is not allowed. Here NBFC is allowed, yes. And the bike can be for personal use, private use, any use, doesn't matter. You'll get a deduction of 1,50,000 rupees for the interest that you pay. Alright, next is 80G series. Guys, the G series is all about giving, and hence it applies to all assessees. Yes, resident, non-resident, both, doesn't matter. First is 80G, which most people quit, but you will not, because 80G is giving donations. Cash is not allowed, but there are 4 categories of donations, 1, 2, 3, 4. First category 100%, second category 50%, third category 100% but with a limit, and fourth category again 50% but with a limit. So guys, if the third and fourth category come, then you have to wait and do it in the end. Here, the first category is communal PM, relieved and defended Armenia and Africa from blood and illness. Disabled CMs started MDS Children University in Maharashtra, Gujarat and Andhra Pradesh. Army cares, cleans Ganga. And this category here is Jawaharlal Nehru, Indira Gandhi, Rahul Gandhi and Ren Trott. It's funny because they get only 50%. Third category is Family Olympics, and fourth category is give him money to create temples. In all these 4 categories, the important thing in the exam is generally PM Cares Fund here and charity, which is here. Guys, for the third and fourth category, they have to share a limit, basically a cake size, which is 10% of your ATI. What is ATI? ATI is your available GTI minus all deductions except 80G. And you will get your ATI. Let's say the ATI is 6 lakh rupees. So 10% of ATI is 60,000. That is your limit, guys. That is the cake. The cake has to be shared by both. Yes. First the elder sibling and then the younger sibling. In that, now that you know it's 60,000, first it will be used by the elder sibling. So if let's say category 3 has a donation of 40,000, so then 40,000 or the limit of 60,000, whichever is low, first compares for 40,000 and 100% of that. So now the limit is, now the cake is reduced to only 20,000. And the next category, if you've donated 30k, so you will compare 30k with 20k, whichever is lower, 20k and then 50%. So first compare and then percentage, because C comes before P. Cash donations above 2,000 fully disallowed, guys. Here now it has been a change. You have the uploaded PDF, don't worry. So no cash donations allowed. Alright, sorry, up to 2,000 allowed, my bad. Up to 2,000 allowed, this is still allowed, my bad. Only for political parties fully disallowed. Okay. 80GG is Ghar Ghar. If you remember Ghar Ghar, there are some salaried people who don't get HRA and then can't take an exemption, and there are some self-employed people like me who also don't get HRA, so hence can't take the 1013A exemption, but we are also paying rent. So the government says, don't worry, we'll give you a reduction under 80GG. First, 5,000 per month. Second, rent paid minus 10% of ATI. And third is 25% of ATI, whichever is the least. ATI is the same, your available GTI minus all deductions except 80GG. Alright. This is only and only if you don't have a house in the same city you're renting. If in Mumbai I have a house and I'm renting, then I don't get 80 GG. Alright. Next is GGA, give around. If you don't have PGBP, so then when can you donate to scientific research, etc.? You'll take it under a year, but 2000 cash is allowed. Above that is not allowed. 80 GGB and GGC, give big and give chota. Donating to political parties or electoral trust, cash is not allowed here. And 80 GGB, if under 37 2B it was disallowed, it will be allowed here only for companies. Next, JJAA, job, add. Just one second. Job, add is basically when you add jobs. So if you're any auditable entity, any entity is subject to audit, and if you add jobs, then you get a 30% over and above deduction for 3 years. Every year you have to check for extra jobs. But there are some conditions. You cannot pay in cash. You cannot pay more than 25,000. You have to contribute to their PF, and you have to employ them for 240 or 150 days in the year in case of LAF industry, that is leather, apparel and footwear. But if 240 or 150 are not fulfilled this year and fulfilled next year afresh, then you can take the deduction next year even if there are no additional employees. Salary includes everything except employers' contribution to PF and retirement benefits that you don't include. And guys, here you get a deduction under 80 JJAA from your GTI. 80 QQB, quality books. If you're a writer, author, congratulations. The royalty that you get from your books, it will go into your PGBP first. There is no restriction there on PGBP minus the expenses or IFOS minus the expenses. But when you take the deduction, there are some steps. Royalty to be maximum only 15% of sales. This condition is not in case of lump sum. Royalty whatever is brought into India within 6 months. And after that you have to minus the expenses already taken in PGBP IFOS. That is the reduction by maximum 3 lakhs. Same thing is RRB, royalty on registered BAT. But in this case 15% is not there, otherwise it's the same thing. Here also guys, the limitation is on the deduction, not in the income. Income, everything will go, whether you've got it in India and all doesn't matter, everything will go in income. TTA, very hidden and smart. This is only for individuals below 60 years like you, and only for HUFs. Only for saving account in banks and post offices they get maximum 10,000 annually overall from all bank accounts. But if they get from post office, then minus the exemption and then minus 80 TTA. This is only saving account. But what for older people? That is 80 TTB, guys. This is savings and hence encourages savings, so residents and non-residents both. But 80 TTB is for citizens, or sorry, individuals who are above 60 or more, and that gives a huge limit of 50,000 per annum on saving and FD as well, and hence only applicable to residents. Why? Because it's a huge reduction. The government cannot afford to give everyone. 80 AC is a very cool thing that if you want deductions, you need to stand in a line and you have to file your return within due date. For 3 deductions, join return queue. For JJA, RRB and QQB. 80U is if you yourself are disabled, same like 80DD, but there someone else was disabled and dependent on you, you yourself are disabled, same 75,000 or 1,20,000. Deductions have to be minus, exemptions are not even included. The categories of deductions, it's okay, you don't need to know the categories. And there is one more deduction called ATP, which we will see tomorrow in Finance Act 2021. Very simple deduction, ATP. That brings us to one of the last chapters, that big chapter, that is TDS TCS Advance Tax. After that, guys, there is return of income and rates of tax, and then we'll be done and dusted with the entire portion. So happy, guys, it's happened in no time. We will take a 5-minute breather here, no problem. When we come back, we will continue into TDS, TCS and Advance Tax, and we will take it from there in 5 minutes from now. Thank you so much. Perfect. Let's do this, guys. Starting another chapter, and this happens to be one of the last big chapters. So very happy with the progress we've made today. Guys, this is TDS, TCS and Advance Tax. Let me remind you, it's not a different tax. It's your same tax, which the government doesn't want to wait. They have no chill. So they want the tax as early as possible through either TDS or TCS or Advance Tax. They need one of them to recover the taxes. First we will see TDS, then we will look at TCS, and then we'll look at advance tax. In TDS, it's the person who's paying the money. It can be KBC, it can be your employer, it can be anyone who's paying the money. They will deduct TDS and they will pay to the government. So diagram is very important. This is the payer and this is the receiver. Alright. In this example, most of it is basically payment or credit, whichever is early, except some which are on payment basis, which we will discuss first. Most of them, if you don't give your PAN number, then TDS will be deducted at the rate of 20%, unless there's an exception. We will talk about the exception, but most of them, if you don't give your PAN number, then TDS will be deducted at the rate of 20%. Alright, let's start. The first one is 194B. B is for betting. In that case, the rate is 30%. KBC will deduct tax and pay to the government 30%. In the exam, if they give you net amount, you will always take the gross amount and we will add it, guys. And this is the person who earns it. We'll call him the surgeon. He gets 70%. This is the PAN. If you don't give your PAN, there is no repercussion because anyway it's at 30%. There is no surcharge and cess on this. It's a flat rate of 30%. This is on payment basis. Yes, it's on payment basis. So whenever they pay, by the 7th of the next month, they have to pay to the government. So if they deduct it today, that is 16th of February, then by 7th of March, they have to pay to the government. If they don't pay it on time, then there's an interest of 1%. And if they don't deduct it only, if they don't deduct it, an interest of 1%. If they deduct it but don't pay, then interest of 1.5% per month or part thereof. That is 194B. The shortcut is betting. That is 194B. Same thing is for 194BB, is bigger betting, but please remember guys, this will be applicable, both of these, only when the amount is more than 10,000. Only then on the entire amount always there will be TDS. Here also it will be 30%. BB is exactly the same. This is on winnings from horse races. Again on payment basis, yes. Next is 192. This is your master or this is the employer. When they are paying you salary, they will also deduct TDS and pay to the government, but TDS is based here on average rates. This is section 192. 192 employees, if you remember. Here the master becomes your CA. He will take all your details, like what are the other incomes, what are your deductions, all of that he will take. Loss also he will take, but only loss from house property, and he will calculate your income, tax payable, and he will deduct the tax accordingly. As here it is on payment basis, so whenever he makes a payment to you, that time he will deduct the tax and pay to the government. And if you don't give the PAN number, here it will be at the rate of maximum marginal rate, which is basically 42.744%. Alright. Next is 192A. This is the Provident Fund department, and when you withdraw Provident Fund, generally it is not taxable. But if you withdraw within 5 years and it's not due to unemployment, closure, etc., then the government says, listen, we want to deduct TDS at the rate of 10%. And if you don't give your PAN, then it's at MMR. This is 192A. A is for Aram. If you want to do Aram and you withdraw your PPF balance within 5 years, then there will be TDS. But what if you withdraw after that? Then there's no TDS because there's no tax only, so then there's no TDS. If you go to a marriage, there's no bill and there's no price of the food, and hence there is no bill. This is also on payment basis. Next guys, initially you always rent. So if this Calorie Cafe and they are renting out land and building, plant and machinery and furniture, then the rent they pay under section 194I, there will be a TDS at the rate of 10% for land and building and furniture and 2% for plant and machinery, payment or credit, whichever is earlier. I is initially you rent, but the rent, the threshold is more than 2,40,000 per annum, only if you are paying more than 2,40,000 per annum, not per category, per person. So if one guy is giving you land and building also and is giving you plant and machinery also, then you have to collectively save 2,40,000. Here this is 194I. This does not apply to small individual, small HUF who's paying. So if you're a small individual, small HUF, what is small individual, small HUF? That means not this year, but last year your turnover in profession was up to 50 lakhs and in business was up to 1 crore. Then you're a small individual, small HUF. And if you are paying rent, plant and machinery, furniture rent, then no TDS under this section 194I. This is 194I. Next is 194IA. You have acquired the immovable property. This is Calorie Cafe, who is acquiring that property from the owner. The government wants to know who this owner is, so the government says deduct TDS at the rate of 1% only if the value is more than 50 lakhs, not the stamp duty value. No, we don't care about that. Whatever you're paying, overall amount, whatever you're paying, including parking, garage, stamp duty, everything together, whatever you're paying, if it's more than 50 lakh rupees, then deduct 1% and pay to the government. If no PAN, always guys, most of the cases 20%. Here, immovable property that you acquire, it applies to everyone, including you, that is a small individual, small HUF, yes. And hence the government says that you don't need to pay by the 7th of next month. You can pay after this month, the next month, 30 days. Within 30 days you can pay. So by 30th March you can pay. This is section 194IA. Next is 194C, that is contractor. Your calorie cafe, and you are paying to a lot of people, including goods transport, a decorator, a transporter. You are paying to a lot of people contracting. The government says, listen, deduct TDS at the rate of 2%, and if the contractor is an individual HUF, then 1%, and this has a small personal limit. Small individual, small HUF, this does not apply to you. If this contract is for personal purpose like a wedding, birthday party, it does not apply. And what is the limit? The individual payment only if they are more than 30,000, and aggregate payments only if they are more than 1 lakh. Any of these, only then there will be TDS, otherwise there will be no TDS. If the limits are not crossed, there will be no TDS. Guys, some more points. For a goods transport agency who owns up to 10 goods carriages and who gives you a PAN, there will be no TDS for goods transport agency. In case of a works contract, what is a works contract? You have to give the specifications also, and you have to give the material. When both of these there, only then there is works contract, which will be subject to 194C. Otherwise, it will be a purchase where there is no TDS. And here, when you park a flight and you land it, when you land the flight and you park it, that will be under 194C. When you have cold storage, that will also be under 194C. Alright. This also does not apply to small individuals, small HUF. Next is 194J. J is jealous professionals. Just one second, guys. 194J is also jealous professional. I have to keep checking the recording is on. So in case of jealous professional, this is calorie cafe, and they are paying to PTNRD. PTNRD. What is PTNRD? Professionals, technical services, non-compete, royalty and directors fees. When they are paying, then again the government says, listen, deduct TDS and pay to us at the rate of 10%. Why such a high percentage? Because professionals make more money. Here also there is a small personal limit. Small individual, small HUF, when they are paying, no TDS. When you are paying for personal purpose like developing your own website or paying your own income tax return, then no TDS. And if it's within the limit of 30,000 rupees, guys, this limit of 30,000 is per category and per person, guys. Per category there's a limit of 30,000. Then in that case, only one limit, 1 lakh limit is not there. Then in that case, no TDS. This limit does not apply to directors. So directors, even if you're paying 28,000, there will be TDS. And for certain cases like technical services, royalty for movies, and call center, the rate is only 2%. Payment or credit, whichever is earlier, is default, and if you don't give your PAN, then TDS is at the rate of 20%. This is 194J, jealous professionals. Next, guys, if someone compulsorily acquires your land, let's say there's a government body which compulsorily acquires your asset, compulsory acquisition, legally acquire, section 194 LA, legally acquire, then in that case the government says deduct TDS at the rate of 10% if the amount you are paying is more than 2.5 lakhs. That is 194 LA. This is again on payment basis only because the government is paying, so whenever they pay, that time TDS has to be deducted and paid. Alright. Next, guys, 3 which are very, very similar. Guys, there is someone who's always helping us, 194H, whom you pay brokerage or commission to. There is 194G, who helps you to gamble. And there is 194D, for doctor's fees or death, you take an insurance. So these are all commissions, brokerage and commission, lottery commission and insurance commission. When you are paying these commissions, then only if the amount is more than 15,000, there will be TDS at the rate of 5%. And for this one, small individual, small HUF is not applicable to this one. So when you're a small individual, small HUF and you're paying to a broker or to a commission agent, or to an agent, then you don't have to pay commission on this. You don't have to be subject to TDS. All right. Next guys, small individuals, small HUFs were very happy because under section 194M they were misusing it. Small individuals, small HUFs. They were paying to J, justify his case. They were paying under 194 to jealous professionals. They were paying to helpers and they were paying to contractors a lot of money. So the government said, listen, you're misusing the provision and hence you will have to deduct TDS at the rate of 5% only if this is more than 50 lakhs per annum. If you're paying to any of these categories more than 50 lakh per annum, then you have to deduct TDS at the rate of 5%. And we understand that a small individual, small HUF, so you can pay over the next month within 30 days. Also, on 194, initially rent, small individual, small HUF are not applicable, but small individual, small HUF were paying huge rent for residential house property. So the government says if you are paying for a house property and if you are paying rent of more than 50,000 per month, then you need to deduct TDS and pay to the government at the rate of 5%. This is only when the per month rent is more than 50,000. This is section 194 IB, impossible to buy. Even they found it impossible to buy, so even they rented it out. Here again, it's only for small individual, small HUF, so they can pay within 30 days after the month ends. This is 194 IB. Very, very important guys. A life insurance company or a life insurance policy is making a payment to you. The government is watching at the other end. If the payment is on account of death, it is exempt, so no tax and hence no TDS. If the premiums are always low, then no tax, no TDS. But if the premiums are high, then step 1, check how much are you getting. If you're getting more than 1 lakh, only then you go to next step, what is section 194DA, death amount. First, if it's exempt, then you don't even go to the steps, only if it's taxable, see if it's more than 1 lakh. If it is, then step 2, that TDS at the rate of 5% on the net amount. What is the net amount? How much are you getting? Let's say you're getting 6 lakh rupees. How much insurance have you already paid premiums? Let's say you paid 5 lakh 20 already. So on that 80,000, there will be at the rate of 5%. Very, very important. I have a feeling this would be there in your exam again. So this is 194 death amount only if the receipts are more than 1 lakh. As if the premiums are low, always, and if the death of a person, you get amount that is exempt under 1010D, so hence there will be no tax and hence no TDS. Alright. Next guys are all the incomes. If Calorie Cafe is earning income, this is Calorie Cafe. They are earning different incomes. Income from interest on debentures, interest from Axis Bank account, from dividend from companies, income from Kotak mutual funds, income from national savings certificate, etc. Then all of these, there will be a TDS of only flat 10%. This is all the incomes. Let me see the sections one after the other. First is interest on debentures or interest on securities, 193. If the amount is more than 5,000, generally there will be TDS at the rate of 10%. But in case of bonds, etc., you have to see the nominal value if that is more than 10,000. In case of LIC GIC, there will be no, if the person is not Calorie Cafe but the person who's earning it is LIC GIC, then there will be no TDS because the government doesn't want LIC GIC to receive less money. 194A is other interest from other than securities, like bank account. You can give interest, in a partnership firm can pay you interest, a friend can pay you interest. So 194A is other than securities. First, the general limit is 5,000, but for banks the limit is 40,000 for people who are below 60, and for people who are 60 and above the limit is 50,000. This limit has to be seen aggregate all the branches of the same bank. A partnership firm paying interest to a resident partner, there is no TDS, but to pay to a non-resident partner, there is TDS at the rate of 10%. All these rates are 10%. And any small individual, small HUF paying interest, there is no TDS. So your friend paying you interest, there will be no TDS. You paying to a bank, etc., never any TDS, because how can you deduct to a bank? Bank is the income, so for them they made an exception. Motor accident tribunal up to 50,000 rupees, no TDS. 194 dividend income, very important, which is now taxable and hence there is TDS. Yes, threshold limit is 5,000. Only above 5,000 there will be TDS at the rate of 10%. This threshold is not applicable if the dividend is paid in cash. 194K is Kotak mutual funds, same thing, above 5,000 of 10%. And 194EE, extremely exhausting. In case of 194EE, national savings certificate, on the amount, if it's more than 2,500, TDS at the rate of 10%. So on all these incomes, TDS rate is the same, that is 10%. On all of them, it's payment or credit, whichever is earlier, and all of them it is, if you don't give the PAN, then TDS at the rate of 20%. Then certain new things, guys. 194O. If you're selling goods on Zomato, Amazon, Flipkart, etc., that means 194O. If you're selling online, the government says, listen, when you're paying the sellers, you also deduct TDS at a very low rate, that is at the rate of 1%. This is 194O. But if the person who's selling is an individual HUF and he's selling on a particular website or a particular app up to 5 lakh rupees, then there is no TDS in that case. That is 194O. Very, very new thing, 194O. Next is 194N. If you're a bank or a financial institution and there are people who are withdrawing money, notes, 194N, the government, very, very interesting and different. The government says you need to deduct tax at the rate of 2% and pay to us. You can always take credit of the tax, guys. But this is only above 1 crore, only on the excess. Yes, first time only on the excess. This does not apply to government. This does not apply to banks when they are withdrawing. This does not apply to white label ATMs when they are withdrawing. And if you have not filed your returns for all the last 3 previous years whose deadline is over, then the limit is more than 20 lakh, 2%, and more than 1 crore, 5% TDS will be deducted. This is 194M only on the excess amount. And last, guys, is 194Q. Q is quantity. Here you are a buyer and you have bought more than 50 lakh rupees worth of goods from someone, and this is a seller. Guys, you have to make a small change in your notes. Go to 194Q. The seller I have written is someone who's not a high value seller. Please write this again, has to be a high value seller. Please change that. It has to be a high value seller. That means in the last year the turnover should be more than 10 crore. So the seller should be high value seller and you have bought more than 50 lakh from this person. So whenever you're paying him that money above 50 lakhs, only the excess, yes, this is also the excess, you need to deduct TDS at the rate of 0.1% and pay to the government. But on this similar transaction, can there be TCS also? Yes. And if TCS is collected, then you don't have to deduct TDS under 194Q. Guys, just repeating 194Q, it's quantity. If the buyer is buying more than 50 lakhs in a year from a seller who's a big seller, high value seller, yes, then TDS at the rate of 0.1%. But this, if there is already TCS, then there will be no TDS under 194Q. These are the main sections of TDS, guys. Remember TDS. Let me just see if there's all of them have been covered. Yes. Perfect. This is 194P. Small thing, we'll do it in the next session tomorrow on a Finance Act 2021. 194Q is here. Alright. If high value seller is buying the goods. Alright. Under provision of section 196, no tax is required to be deducted at source. Yes, if you are paying to the government, then you don't need to deduct any TDS. Guys, 194Q, if you are confused, don't worry. We are doing it tomorrow anyways in Finance Act 2021. But just repeating, in this case, it should be a high value seller. If you are paying to the government, no tax is required to be deducted. If you are paying to the government, example, if you rented a building from the government, there will be no TDS on that because you're renting it from the government. Guys, in case of rent, etc., if the rent is 1 lakh and the GST is 18%, the TDS will only be on 1 lakh and not on 1 lakh 18. It will only be on 1 lakh. TDS always on the gross amount. No TDS on the GST. There is no COVID discount. Last year there was a COVID discount. All rates are flat rates. Small individual, small HUF. And sweat equity share, something again that we will discuss tomorrow. Don't worry, small points. Not even very important for CA inter perspective. Alright. Just 1 second. Okay. Perfect. Guys, TDS should be deposited by the 7th of the next month. Otherwise, there will be an interest of 1 or 1.5%. And you have to file a quarterly statement. Not important, guys. TDS sections are important. One question from TDS for 6 to 8 marks is definite in your exam. This is TDS at a slightly higher rate. Again, something we'll do in the Finance Act 21. I'm not stressing attention on this. because we'll do it tomorrow, and that also will be uploaded on the website. So the Finance Act 2021 has brought in some small changes, don't worry. First, let's get done with everything and then we'll focus on the changes. If we get time today, we'll do it today itself, no problem with that. Next is TCS. Guys, in TCS, the focus is only and only on the seller, because TCS sells, so focus is only on the seller. This is the seller. When he's selling to the buyer, he will collect money. The government says collect some extra TCS also and pay it to us. This is the government, but we were not very bothered about TCS because TCS was only on few things. So let's say the seller is selling a car, he will collect TCS of 1% on that car and he will pay to the government by the 7th of the next month. Otherwise, interest rate 1.5%. Same thing. No TCS when you sell it to the government or the UN or embassies. No TCS in those cases. But it never impacted us because alcohol scraps my car. Only on alcohol for human consumption, not at retail level. Only on scrap, only on minerals like iron ore, etc. And only on fancy cars there was TCS at the rate of 1%, if you remember. And 2 licenses for 2.5% timber and 5 BDs. On this, the rates on licenses of parking lots, toll, etc. it was 2%. On timber it is 2.5%, and on BDs, that is Tendu leaves, it is 5%. That's how you'll remember the rates. As only on these products there was TCS, and hence we did not bother, because whenever I'm selling this laptop there is no TCS. Whenever I'm selling this pen there is no TCS. But the government made some changes. So this is TCS, these are the rates. You will collect it on either credit or receipt, whichever is earlier. As whenever you credit that person's books of accounts, debit that person's books of accounts, or you receive whichever is earlier, on that basis. So if today you've debited his books of accounts but you received it in March, then today is the relevant date, so you have to pay it by the 7th of March. But 3 new sections, guys. 206C is a section for TCS, but 1F is for fancy car. If a seller is selling a fancy car more than 10 lakh rupees, then there will be TCS at the rate of 1%. This is not at the manufacturer distributor level, this is only at retail level on every car sold. If the car is more than 10 lakh rupees, then TCS at the rate of 1%. 206C 1H, high value. If there is a seller who is a high value seller, that means last year's turnover is more than 10 crore rupees, and if he is selling to a buyer more than 50 lakhs in a year, then only on that excess amount he has to collect 0.1% and pay to the government as TCS. This was impacting everyone, yes, because this was not just on alcohol, but car, but anything that is sold high value. This sale value is excluding export, and this is 0.1 only on the excess amount. Yes, only on the excess amount. But guys, if this is collected, then 194Q will not apply. And generally this is collected first, because whenever you get an invoice, first you will get an invoice on which they will collect 0.1% and you will pay that, so there will be no TDS under 194Q. And next is 206C or 6C1G global. In that case, guys, there is a seller who is an authorized dealer and who is selling forex. And when he collects money from you, if the money collected is more than 7 lakhs, then he has to collect TCS at the rate of 5% and pay to the government. This limit will be reduced. This limit will be 7 lakhs, but the rate will be reduced to 0.5% in case this purchase of forex is for education purposes obtained through a loan, and this limit will not be there. The rate will be straight 5%. If it's for any holiday or tours, etc., it will be straight 5%. So this is the general limit and rate, but this changes for loan, but loan through education, and this changes for tours. They're almost punishing tour people without any limit, 5%, and for loan people they have a soft kind heart, so only 0.5%. Guys, remember TDS and TCS is not an additional tax. You can always take credit of the TDS already deducted. So that brings us to advance tax. Guys, what is advance tax? Advance tax, during the year that you earn money, that is the previous year, at 4 places, just send demanded money at these 4 installment dates: June, September, December and March, 15th of all dates. The government says you should keep paying me advance tax as and when you earn. This advance tax in a section called section 207, you need to pay advance tax in the previous year itself, yes. As per 208, advance tax is to be paid only if your liability after minusing TDS, TCS, etc. is more than 10,000. How do you remember? 2 plus 8 is 10. Only if it's more than 10,000, and that too if you're senior citizen, that is 60 years or more, having no PGBP income, there is no advance tax liability in your case. Then section 211 says that there are 4 installments, these 4, 1, 2, 3, 4, and you have to pay 15% of your tax liability after TDS TCS. Let's say that tax liability is 1 lakh, then 15%, 45%, 75% and 100% excellent needs to be paid, but cumulatively. So first 15%, then 45%, no, then 30% more, then 30% more, and then 25% more. If you miss these dates, then there is a section called 234C which is checking on the installments, and if you miss or if you short pay, then there is 1% interest into 3 months, that is till the next deadline, and for March it is only for 1 month. But for the first two, up to 12% and up to 36% they've given a benefit. That means if your payment is up to those amounts, then there will be no interest. But if you pay 11%, then on the 4% shortfall there will be interest. Guys, on certain 4 incomes A, B, C, D, there is no advance tax till you earn it. Example, when you are getting dividend, you don't know when you will get the dividend. In fact, not even declaration. Finance Act 2021 has said when you receive the dividend, only then you have to pay advance tax. Next, any casual income, you don't know when you are going to win in KBC. Any new business and any asset sale, whenever these things happen, only then will you include them in your calculation and pay advance tax. Yes. Next, guys, for people who are under 44AD and 44ADA, then only the last installment of 15 March applies to them. So you don't have to bother about other installments. Straight away pay advance tax on the 15 March installment. And guys, there is a section called 234B which comes baad mein. So once the previous year is over, if you had to pay advance tax of 1 lakh and you have paid up to 90% of it, no problem. But if you paid only 87,000, then on the shortfall, that is 13,000, there will be interest at the rate of 1% per month till the return is filed. So first C and then B is baad mein. Remember, this is rounded off to the nearest hundreds. This is not rounded off to the nearest tens. This is rounded off to the nearest hundreds. This calculation of interest. This is section 234C, 234B, advance tax, the 4 installments, and this is your advance tax, section 207. In the RTP that we'll see after the break, we will do this advance tax calculation also, no problem with that. And with that, guys, we come to the last chapter, that is return of income and rates of tax. Computation of income, as you know, we've solved so many sums. There is nothing new in computation. It's only an aggregation of everything together. So right now I'm looking at return of income. Very, very cute, nice, important chapter. 4 marks guaranteed from this chapter. Return of income. Guys, once you finish the year, you have to give a report card to the government. So who has to file? Companies and firms have to compulsorily file. The others have to file only if their gross total income plus 54 exemption is greater than basic exemption limit, or if they drink coffee. What is coffee? Current account deposit of more than 1 crore. If you have asset abroad outside India but only for ROR. If you have foreign travel of more than 2 lakh, that is on the travel abroad, if you spend more than 2 lakh for yourself or for others, and if you have electricity expense of more than 1 crore, if you drink coffee, just like how I'm drinking right now, then you need to compulsorily file your return, even if your income is 0. The return has to be filed by certain due dates. 31st July for people who are not subject to audit. If you're subject to audit, we'll give you some more time, 31st October. International transaction, 30th November. But if you're a partner in a partnership firm, that hum saath saath hai, we're all in this together. That means the partnership firm and the partner will both have the same date. If the partnership firm is auditable, then even the partners will have 31st October as the due date. This is normal return. But is there a different loss return? No, it's the same return, but loss return has to be filed within due date. Otherwise, you will not be able to carry forward your losses. That is as per section 80. Except 4 losses which you know about. Can you revise your return and file belated return? Yes, you can file your belated return 4 months late also. Guys, that's just a shortcut. But you can file your belated return till the 31st of December or till they have assessed you. So basically till 31st December you can file a belated return, but guys, if there is no repercussion, everyone will file it belated, and hence it will impact your life. That means there will be a late fee of 5,000 rupees. If your total income is up to 5 lakh, then the late fee will be only 1,000. I is you will have to pay interest under 234A if there is any tax payable. And F is the fee. L is losses will not be allowed to be carried forward. L, I and F. What is late fee and what is revised return, guys? Can you revise it? Yes, you can revise it any number of times. Yes, everything can be changed except date. Date cannot be changed. And you can revise it till 31st December, guys. Both these are changed now. Earlier you could revise it till 31st March, and you can file it also till 31st March, but this has been changed now, so good. This will be definitely there in the exam. If after paying TDS TCS Advance Tax you still have to pay some tax, that is called self-assessment tax, and if you don't file a return on time, there will be interest under 234A. So first 234C, then 234B, and then 234A. Bulk return is not important. Along with your return, you need to fulfill certain requirements or details, like if you are maintaining your books of accounts and balance sheet, P&L account, manufacturing account, trading account, all cash flow you have to provide. And if you are not maintaining them, you have to give details like your debtors, creditors, stock, cash balances, net profit, expenses, details you have to give. Can a return be defective? Yes. If it does not have one of the details, then they will give you a notice. You have to return it. Within 15 days, you need to rectify it, otherwise it's an invalid return. Non-payment of tax does not make it defective. There is just 1 minute and we'll be back. Alright. Next, the return has to be verified. Generally, the person whose return it is, that person will have to verify. Verify means, Aadhaar, OTP, etc. verification. But in case of you are not here, etc., then an authorized person can also do it for your behalf. For a HUF, Karta or any member, including male or female member. For a company, the director, managing director, or any authorized person. But if it's an authorized person, then you need to attach the power of attorney. 139B, there are boys who are called tax return preparers. They can help you file your return, yes, but you should not be auditable. They cannot be CAs or lawyers. They cannot be employees of a bank they cannot be working with a bank with which you have relationship, and they cannot be working with companies, with entities other than companies. 139A says you need a PAN number. Yes, for most transactions, opening a bank account, credit card, etc., for most payments more than 50,000, you need a PAN, so please apply for a PAN. If you don't have a PAN, there will be repercussions. Aadhaar also is important, and now Aadhaar, guys, you have to link it, otherwise there's a fee of up to 1,000 rupees under 234H. H is home, Aadhaar is linked to your house, guys. Self-assessment tax is 140A. Please pay it, otherwise there will be interest of 234A. And 234B, 234C, you already know. This checks the 4 installments, and this is Baad mein. This is your return of income chapter. Next, guys, is rates of tax. Section 4 says rates of tax, whichever for that year are applicable, you will apply that. 3 rates of tax. There is basic tax, surcharge and cess for each person. Basic tax changes from person to person. Surcharge also changes, but only for higher incomes. HEC is good because it remains constant, 4%. For individuals, you have a basic exemption limit of 2.5 lakhs. If you are 60 years or more, then 3 lakhs. If you are 80 years or more, then 5 lakhs. But if you are a non-resident, no higher basic exemption limit. You will get a basic exemption limit only up to 2.5 lakhs. Then there is a rebate. A rebate is always after basic tax. If your total income is up to 5 lakh rupees, you will get a rebate of maximum 12,500. Rebate, etc. is not there. For casual income, rebate is not there. For long-term capital gain listed UU, it's not there. Then surcharge, only if the income is more than 50, more than 1, more than 2 and more than 5 crore, there will be a surcharge of 10, 15, 25 and 37%. Remember, 25 and 37% surcharge is not there for 3 incomes: dividend income, 111A and 112A. HEC is always 4%, and non-residents are not given a higher basic exemption limit, neither are they given a rebate. Maximum marginal rate is 42.744%. Alright. This is Thara, I think your doubt. Rebate under section 87A is however not applicable in respect of tax payable at 10% on long-term capital gain under section 112A. So only for 112A there is no rebate calculation. For HUF guys, it's the same, only HUFs don't get higher basic exemption limit, HUFs don't get rebate. So they have the same things otherwise, yes. Partnership firm LLP play a flat 30% tax rate. Surcharge is very simple, it's 12% more than 1 crore. And HEC is the same for everyone, no rebate here, no basic exemption limit here. Companies, domestic companies pay tax at the rate of 30%. And if they generally pay at 30%, and if not last year but last to last year, that is 1920, if the turnover is up to 400 crores, then tax rate is even lower, that is 25%. Foreign companies pay 40%, but foreign companies pay lower surcharge, that is 2% and 5% only, above 1 crore and 10 crore respectively. And 2 plus 5 is 7, that is what domestic companies pay, plus 12%. So 7 and 12% domestic companies. Surcharge is this. HEC is the same for both, 4%, 4%. Marginal relief, whenever because of surcharge you are earning, let's say 1 crore, I am earning 1 crore 1 lakh. So I will pay surcharge at 15%. Unfortunately, you will pay only surcharge at 10%. So you will calculate your basic tax, I will calculate my basic tax. You will calculate your surcharge, I will calculate my surcharge, and we'll calculate, let's say your tax is 30 lakhs. My tax is 1,65,000. So how much am I paying extra? I am paying extra 1,65,000 to earn how much extra income? To earn only 1 lakh extra income. So that 65,000 rupees will be a relief called marginal relief. This is to be checked only if the income is slightly above the threshold limit of surcharge. This applies to everyone. Yes, applies to everyone. Next guys is better alternative choice. It is a choice only for individuals and HUFs. They get to choose this, but the slabs rates are much better. They increase only by 2.5 lakh till 15 lakhs. And the rates are also better. They increase only by 5%, so no sudden jump. No alternate minimum tax in this case. You can choose it whenever you want till your return filing, unless you're a salaried person, and you can opt in, opt out unless you're PGBP. But the bad part is you don't get a lot of deductions. What are the deductions? In IFOS, no family pension deduction. In capital gain, no change. In PGBP, additional scientists developed awesome Covaxin. Anything in blue is as shortcut. Anything in yellow right now is for CA final. So additional depreciation you don't get. Scientific research for donation outsiders you don't get. In-house you still get. 35 AD 100% reduction you don't get. Awesome area 10A you don't get. And Covaxin is something that you will see at CA final. This is also something you don't get. T development, site restoration, this is all at CA final. In IFHP, the SOP 24B you don't get, LOP you get, SOP you don't get because you're not offering something, so they've taken away 24B for SOP. In salaries you get nothing except blind can do tours. Only this you get, otherwise you don't get any leave travel, any HRA, anything you SAP, SEP, nothing you get except blind can do tours. So blind, conveyance, daily and tour, that exemption you will still get. Clubbing, 1032 you will not get. Set off and carry forward you will not get of these expenses in PGBP, like additional depreciation you cannot carry it forward, 35 AD you cannot carry it forward, scientific research expenditure you cannot carry it forward. Exemption, oh we forgot to write this guys. So 1017, only one thing in the exemption you will not get. MPs and MLAs will not get 1017. If you can write that in your notes in this chapter. And deductions, you will not get any deductions except guys, this also make a small change. You will not get these two deductions, 80 JJAA and 80 CCD2. I think I told you joint return Q by mistake, so please change it. You will not get any deductions except 80 JJAA, that you will get, and please remove 80 QQB and 80 RRB and only 80 CCD2. Only these two you will get. So only 80 CCD2 and 80 JJAA, not joint return Q. And last, if you have PGBP income, then you can opt in, opt out only once. Next is alternate minimum tax. Guys, sometimes when your electricity bill is very low, like 700 rupees, they knock on your door to ask you an alternate minimum amount, but they'll give you a credit of the balance. Same way in tax also, they will knock on your door because you are sad. What is sad? that is specified deduction 35 AD, then awesome area deduction 10 AA, and those deductions, that is joint return Q. If only in these cases they will knock on your door and they will ask you to pay alternate minimum tax. This applies to everyone except companies. For this, you will first calculate your regular tax with surcharge, cess, everything, and let's say that is A, and let's say that is 1 lakh rupees or 10 lakh rupees. And then you will find out your AMT. How will you find out your AMT? You will take the total income. You will start off with total income, and you will add the SAT deductions to get your adjusted total income. On that, you will multiply it with 18.5%. If you're in an IFSC, that's not important for you, but an International Financial Service Center, then 18.5% becomes 9%, but doesn't matter, guys. This 18.5% of your ATI plus surcharge. If your ATI is more than 50 lakh, more than 1 crore, more than 2 crore, whatever is the surcharge limit, and HEC will calculate. And that amount, let's say that is 17 lakh 30,000, that is B. Only if B is more than A, is it? Yes. So then you will pay B and you will get a credit of 7 lakh 30,000. This is the credit that you can use for the next 15 years whenever your A is more than your B. This is called 115JC, alternate minimum tax. Always check in the exam if they don't tell you that whenever you have SAT deductions, only then will you apply AMT. Also guys, if your adjusted total income is up to 20 lakhs, then no alternate minimum tax. But this limit is not for, threshold limit is not for partnership firms, LLPs. Wow. And with that guys, right in the nick of time, in 4 hours, we've completed a massive portion of direct taxes. Amazing stuff. Watch this recording whenever you want to revise, whenever you want to start your revision, or even when you're studying for the first time. Just watch it, just listen to this recording, and you will be well versed, and then you start your preparation. Just 4 hours worth of investment. Very happy with the progress we've made. Now when we come back in the break, we will do a nice RTP, a revision test paper of 2021. We'll apply all our knowledge on that, and then we will conclude today's day. Excellent session. It's also getting recorded and it will be uploaded on my YouTube channel very soon. All the best. Thank you, and reach out for any questions. In the next session, we'll open up for questions as well. Thank you so much, guys. All right, bye. Thank you. All right, hi guys, and welcome back. This is the one-shot revision of not IDT but DT, and we're looking at completely revising DT, which we already have done. Guys, we've done chapters right from the first chapter, which is introduction to rates of tax, and we've completed all of that. I hope the audio is perfectly fine, guys. Let me know if there's any hitch in the audio. Otherwise, guys, good afternoon, welcome back. Guys, this session is all about applying now from an exam perspective. What are the questions that can be asked from an exam perspective? How do you apply that? How do you answer that really well? So that's the whole idea behind this session. I'm going to quickly upload the RTP. Guys, I hope audio and video are perfectly fine. Just give me a heads up if they're fine. Can you hear me properly? Anyone? So just looking at the RTP question. Perfect. This is the RTP of November 21. Good afternoon everyone, welcome back. This is the RTP of November 21, guys. Whatever we have now studied conceptually, I want you to focus less on concepts and more on sums, because in the exam this is what is asked. So hence let's try and do this. The first is an MCQ based question. We are going to understand and do this question one after the other. There is 1 2 3 4 5 6 7 8 9 10 11 13 14. There are about 15 questions in this RTP. Let's do them really well so that we know how to do our answers as well. Guys, here is a case scenario, and based on this case, this is exactly how the exam asks it. There is 1 2 3 4 5 questions which are based on this RTP MCQ. So let's see the case and let's move ahead on this case. Just 1 second. Okay. Guys, here is Mr. Animish, who is an Indian citizen. Every word is important. Who's 61 years old and has set up a business in Canada and is residing in Canada since 2009. So they are trying to push you to think that he's a non-resident. Let's see how that goes. He owns a house property in Canada, half of which is used by him for his residence and half is given on rent. So basically he has some Canadian income, but whether Canadian income is taxable in India or not, we'll only know when we know his residential status. He purchased a flat in Delhi, so this definitely is an Indian income. He purchased it for 42 lakh. The stamp duty value of the flat was 35 lakh in the year 1819. We are in the year 2021, guys. So doesn't matter what happened that year. He has taken a loan from Canara Bank in India of 34 lakhs. So he will have exemption or deduction, under 80C of the principal repayment. The interest on such loan was 3 lakh 14. So he'll have 24B and he'll have 80 EEA maybe if the house is only worth 45 lakh. The stamp duty value of the house was 35 lakh. Mr. Animish has given this flat on a monthly rent of 32,500 since April 2019. The annual property tax of Delhi flat is 40,000, which is paid by Animish whenever he comes to tax to India to meet his parents. Mr. Animish visited India for 124 days during the previous year 2021. So stay in India during the previous year 2021 is 124 days. Before that, he had visited in the last 4 preceding years. He stayed in India for 366 days. This may be helpful in finding out his residential status. Let's try and see. Basic condition 1. Is his stay greater than or equal to 182 days? The answer is no. And hence you go to second basic condition 2, but you stop yourself. He's an Indian citizen visiting India, and hence the second basic condition will not apply. So we try and make him a non-resident, but suddenly we remember there are two amendments, Amendment 1 and Amendment 2. Amendment 1 says that if he's an Indian citizen or PIO having dear income greater than 15 lakhs, and here also greater than 15 lakhs. So now our attempt is to find out his dear income, which is either more than 15 lakhs or not. Let's try and do that. So first is his Delhi flat income. His rent is 32,500. So 32,500 into 12 is 3,90,000. That is his GAV in the absence of municipal value, fair rent or standard rent. Municipal taxes, he definitely has come to India, so he is going to pay that 40,000 rupees of municipal taxes. So his NAV is 3,50,000. 24A is on 3,50,000, 30%, that is 1,05,000, and 24B is 3,50,000 minus 1,05,000 minus 3,14,000, which gives you negative 69,000. So this actually is a loss from house property. So this one is no income but loss from house property. Keep it ready in just in case. This is the house in Delhi. Next, he had a house in Ranchi which was sold in May 2017. In respect of this house, he received arrears of rent of 2,96,000 during the year, which is not taxed earlier. So on that 2,96,000, after minusing 30%, his income from house property, even though the house is sold, is 2,07,200. You can set one against the other, that's not a problem. Moving ahead, I am only looking at dear income. He also derives some other incomes during the year, which are as follows: profit from a business in Canada, not dear. Interest of bonds on Canadian 6,20,000, out of which 50% was received in India. So this will be IFOS 3,10,000. Income from apple orchids in Nepal given on contract and the yearly contract fee of 5 lakh was received by Animesh in Nepal. So this again is not dear income. Mr. Animesh sold 10,000 listed shares on which STT was paid. So it's listed UU, ATSCP. Asset, he sold it. What is the sale price? 480. 480 into 10,000 is 48 lakh is the sale price. Cost which he acquired before Arun Jaitley's speech date at 100 rupees per share. He sold it for 480. So you'll have to take a new cost. And is this long term? Yes, this is long term, but you don't get any indexation. So what is cost? Cost is the old cost, that is 100 rupees, or the new cost. What is the new cost? Lower of fair market value, which is 300, or the sale price, which is 480. So lower is 300. So 300 or 100, the cost is 300, which is basically 30 lakhs. So 30 lakh minus 48 lakh minus 30 lakh is 18 lakhs, which is your long term capital gain listed UU. Suddenly your dear income is more than 15 lakhs. And if that is the case, then will the second basic condition 2 apply? Yes, the second basic condition 2 will apply, but 60 days will be replaced by 120 days. Yash, you've just joined the class. We're looking at the RTP of 21. We finished revision of the entire DT, which will also be recorded and which will be also uploaded on my YouTube channel. You can join the link on the Telegram link for any more details that you'd want. Watch it and enjoy the class. So your basic condition 2 will become applicable if only 60 days replaced by 120 days. So what is the second basic condition now? Stay in India greater than or equal to 120 days, and in the last 4 years stay in India greater than or equal to 365 days. Let's see if this is answering yes. His stay in India is 124 days, yes, and last 4 years is 366 days, yes. So basic condition 2 is applicable. So he's a RNOR. Congratulations. This is how you use your amendment. Let's now go to the questions, guys. What would be the residential status of Mr. Animesh during the year? He is a resident but not ordinary resident. This is your answer. For this you should get at least 2 marks or more. What would be the amount of income taxable under income from house property in the hands of Animesh during the year? Guys, here there is a loss and there is an income from house property. Can I set it off? Yes, you can. And if you set it off, then 138,200 is your income from house property, which is the next question. So 138,200. What amount of capital gain would arise in the hands of Mr. Animesh on transfer of shares? Guys, how much capital gain arising? Not how much will be taxable. How much is arising? 18 lakhs. So 18 lakhs. And how much will be taxable? Only 17 lakhs will be taxable, guys. You know, only on 17 lakh you will pay at the rate of 10% because this is listed UU. So there is a section called 112A. Guys, it is this question that I am really worried about. In the exam, a question like total income, a question like tax liability, you should not do starting because it will spoil your paper. You will spend a lot of time on this. So what ideally you should do is, in questions like this, you should be coming back unless you get a very clear answer. So let's see if we get a very clear answer. Guys, please tell me, is there any salaries income in this case? Is there any salaries income? No. Is there any income from house property? Yes, 1,38,200. Is there any PGBP income? Doesn't look like. Is there any capital gain? Yes, 18 lakh, which will be taxed at the rate of 10%. So I'm keeping it separate. Is there any IFOS? Yes, 3,10,000. So this is his income in India. Dear income. Income from apple orchids in Nepal is not to be included because that's not dear. This is also not to be included. Nothing else is to be included. So this looks like the total gross total income. Seems simple. 1,38,200 plus 18 lakh plus 3,10,000 is basically 22,48,200. Now let's see the deductions, guys, if any. Do we have any deductions which we can minus? I don't see any 80C, I don't see any 80D, I don't see any 80E. EEA is there, but we've already taken the entire loss here, interest, so hence we are not taking under 80EA. Electric bike is not there, there is no G. Is there any interest income? No TTA, nothing, guys. I don't see any deductions here. So what would be his total income if he does not opt to pay 115 BSC? So then answer is 22,48,200. Let me also check the answers parallelly. This is the fourth question. The fourth question, 1 minute. Alright, so interest on bonds, income from apple orchids, yes. Just 1 second. Guys, there is one deduction which we missed out, that is principal repayment of 80,000. So let's do that. 80C, 80,000 principal repayment. So that is 21,68,200. Because I wrote it here while I was reading, I know there is a 80C deduction. So this is my total income, guys. Total income is 21,68,200, which is here 21,68,200. What would be the tax liability computed in the manner to minimize his tax liability for Mr. Animish during the year? So what is his tax liability, guys? Now let's check his tax liability. Out of this income, first you will minus anything which has specific rates of tax. So from 28,68,200, I'm minusing 18 lakhs. So 3,68,200 is normal rates of tax, and 18 lakh will be taxed at the rate of 10% above 1 lakh. Guys, he's Animish and he's 61 years old. So what is his basic exemption limit? His basic exemption limit is 3 lakhs, but he's a RNOR. Do RNORs get the higher basic exemption limit? Yes, they are still residents, so they will still get it. So 3 lakh is his basic exemption limit. So entire basic exemption limit use, and 68,200 into 5%, that is 3,410, plus on 17 lakh into 10%, that is 1,70,000, plus 3,410 is 1,73,410. On this there will be no surcharge because it's only 21 lakhs, but there will be a cess of 104%. So 180,346.4, ignore the point, so 180,350. That should be the answer. 180,350. That is the answer, guys. The fifth one. Perfectly alright. Guys, why have they written to minimize this tax liability? Because you know how to adjust the basic exemption limit. I hope this is absolutely clear with the rounding off. This is your total tax liability. Guys, typical exam question. Alright. Next. Mr. T, an Indian citizen and a resident of India, earned dividend income of 4,500 from an Indian company, which was declared on 1st October 2020 and paid in cash to Mr. T. What are the tax implications with respect to the dividend in the hands of T and in the Indian company? In the hands of T, will it be taxable? Yes. So it will be taxable. So anything which is other than that is a wrong answer. So this one is wrong. So such dividend is taxable, and TDS will apply at the rate of, guys, that year there was a COVID discount. So you ignore the rate. The rate will be 10%. Yes. Even if it's less than 5,000, yes, because it's paid in cash. So answer is B. It will be at the rate of 10%. Guys, here is the next one. Mr. X is a partner and Mr. Y is a partner. One is working partner, one is non-working partner of a partnership firm. The partnership firm is subjected to audit. So hence the partnership firm's due date will be 31st October. What is the due date for filing return of income for the partners for both X and Y? Guys, partner and the partnership firm have the same date, if you remember. So they have the same date. So for both of them, it is 31st October for both X and Y. Earlier, guys, for working partner it was different, for non-working it is different. Now it is the same for both. So this is for both. Next, very, very important question. And guys, you won't believe this same question was there in the exam. If you don't believe, I'll show it to you. Guys, this is your November 21 RTP that people had prepared for their December or November exam. This 8th question is on NPS contribution, guys. Retirement benefits. This same question was there. I'll just show it to you. I'm just going to go to the end and I'm going to upload the December 21 paper just to show you how important RTP is. A very difficult question came just the same. If people had done an RTP, they would know this question also. Here is the exam paper, December paper. So guys, if you really want to work smartly, it's a very smart thing to do your RTPs. Here is the question. Yep, guys. There is an employee of the central government and both the employee and the government contribute 20% to their national pension scheme. This in fact is the biggest thing here because others are very, very simple. So this is the sum for 6 marks, where out of 6 at least 3 marks will be your national pension scheme. So here we go. Let's try and do this. Okay. Everyone, very, very carefully. Arpit is an employee of a private company. How much deduction is available under Chapter 6A while computing the income of Mr. Arpit? So we have to only look at Arpit's deductions under Chapter 6A. While we read, at least let's put the sections, if not the numbers. He has contributed 1,61,280 towards National Pension Scheme. Guys, when he contributes, where will the deductions lie? Under 80 CCD 1. Under 80 CCD 1B, if you know, these two are his contributions. Next, his employer has also contributed. For that, will he also get a deduction? Yes, 80 CCD 2. Guys, I hope this is clear. Alright. His basic salary is 80,000 per month. So I'm just writing B. What is B? 80,000 into 12. That is 9,60,000. His dearness allowance is 40% of basic. So dearness allowance is 40%. So 9,60,000 into 40% is 3,84,000. His dearness allowance is 40%, which forms part of retirement benefits. So the entire 3,84,000 forms part of retirement benefits. So that is entirely D. There is no C. So what is the BDC? As BDC is 13,44,000. Just keep it ready for any calculation that we might have to do. Alright. He also paid 55,000 towards LIC premium for himself and his wife. So that will go in 80C. How much can I put? 55,000. Yes. And medical insurance premium of 35,000 by cross check for his mother being a senior citizen during the previous year 2021. As in 80D, how much can I put? Can I put 35,000 assuming the mother is a resident, senior citizen and a resident? That's an assumption. That's it, guys. So now it all boils down to National Pension Scheme. There is no 80CCC. There is nothing of that sort. So first, let's do your contribution. How much are you contributing? 1,61,280. Out of which, first, let's put here 80CCD1. How much can be put? 10% of your GTI can be put here. Sorry, 10% of your salary can be put here. Your salary is 13,44,000 into 10%. That is 1,34,400. But if I put 1,34,400, is this going above 1,50,000? Yes. So hence I have to limit it to 1,50,000. So here 55 is here. So remaining 95 I will take here. So I'm just going to remove this and put 95. Guys, is this limit over of 1,50,000? Yes, this limit is over. But you have contributed 1,61,280. Out of that, 95,000 was already taken in 80 CCD1. So what is the balance? The balance is 66,280. Can I take this entire 66,280 here? No, unfortunately, I can only take 50,000. So let's take this and let's put it in box the final numbers. So 95 is final, 50 is final. Always guys, put these numbers first and then see the overall limit of 1,50,000. Now that this is done, let's look at 80 CCD2. 2 is employer's contribution. Employer also gets only 10%, guys. How much is the employer contributing? He is contributing 1,61,280. How much deduction will he get? 10% of salary. For central government, 14%. So this is 10%. So 1,34,400. And the same thing which the employer gets in PGBP, you will get under 80 CCD2, 1,34,400. Let's total it up. Is there any other deduction which is there? No. So 55 plus 95 plus 50 plus 1,34,400 plus 35,000 is 3,69,400. Guys, total it up. 3,69,400. That's your answer for the 8th question. I hope this is understood, guys. So go very slow and steady and you will never go wrong. This is indication that NPS is very important. Alright. Next. A building was acquired in 1995 for 20 lakh and sold for 80 lakh in 2020. The stamp duty value on the date of transfer was 85 lakh. The fair market value of the building as on 1st of April 2001 was 25 lakh. The stamp duty value on the same day was 22 lakh. Compute the capital gain. The moment I see capital gain, only thing you need to figure is A, T, S, CP. Everything else will take care of itself. Is there an asset, guys, which is being sold? Yes. Is there a transfer? Yes, sold. What is the selling price, guys? Selling price is 80 lakh. On that day, is there a stamp duty value? Yes, 85 lakh. Only one stamp duty value. So will you check? Yes, 50C. So 80 lakh sale consideration into 110% is 88 lakhs. So is my stamp duty value within the range? Yes. So I will believe my sale consideration is 80 lakhs. Perfect. Next. My period of holding, is this more than 2 years? Yes, definitely. So cost has to be indexed. So let's find out the original cost, guys. You bought the building for 20 lakhs when the fair market value was 25 lakhs. So can I take the FMV? Yes, I can take the FMV, which is 25 lakh, but it cannot be over the ceiling for land and building. What is the ceiling? The stamp duty value as on that date was only 22 lakh. So my ceiling is only 22 lakhs. So hence my cost can only be 22 lakhs. I will index it, divide by 100 into 301. So 22 lakhs divide by 100 into 301 is 66 lakh 22,000. And when you minus that from 80 lakh, you get 13 lakh 78,000. Guys, have a look at it. Any question, think about it, reach out, no problem. Very nice question. Perfect. Next. 10th question. Guys, take this minute, pause the video and do it yourself once before you listen to what the solution is. Mr. Vikas received a gold ring worth 60,000 on the occasion of his daughter's wedding from his best friend Mr. Vishnu. So guys, he is getting a gold ring, which is MISB SAT job. Yes. It is on the occasion of his daughter's wedding, so it is not one of the situations. So step number 3, is it movable property? Yes. Is it more than 50,000? Yes. So will he be taxed? Yes. He will be taxed on 60,000. Mr. Vishnu also gifted a gold chain to Kavya, the daughter of Vikas, on the said occasion of the marriage. So in Kavya's hands, it's from marriage, so not taxable. So such gifts are not taxable in the hands of Mr. Vikas. Wrong. Value of gold ring is taxable in the hands of Vikas. Perfect. Value of gold chain is not taxable in the hands of Kavya. Perfectly right. Section is 56 to 10. Answer is C, 10C. Moving ahead to the 11th one, we've gone on super speed, guys, and doing all of these. Guys, there's a small mistake in this sum, but no problem. We'll still live with it and we'll still do the sum. There's a company called Messrs Rajveer. It's a proprietorship firm, has two units, Unit X and Unit Y. Unit X is located in the SEZ and Unit Y in the domestic tariff area. You know, guys, the star unit is Unit X, which should be in the focus. Total sales is 85 lakh, 50 lakh is Unit Y, so hence 35 lakh will be Unit X. 55 minus 28 will basically give you 27 lakhs of export. So hence domestic is only 8. Actually, if you calculate here, it shows 18, but it's only 8, and net profit is 6 lakh. So let's focus on these numbers. Now ignore these two numbers. So basically, this is the number. These are Unit X. We have to only focus now on Unit X. What are they asking? Let's see what are they asking. Total sales include freight of 5 lakh for delivery of goods outside India with respect to Unit X. So there is FIT, freight, insurance and telecommunication charge, which has to be ignored. Both the units were set up and started manufacturing in the year 17-18. So basically we are in the first 5 years. Compute the amount of deduction. Guys, for 10 AA deduction, all you need to figure is the export profit. What is the export sales? 27 lakhs. What is the total sales? 35 lakhs. But from both of these I need to minus 5. So this becomes 26 lakh 50 and this becomes 34 lakh 50 because, sorry, my bad, 5 lakhs I need to minus. I think freight is 5 lakh. Let me just check. Freight is 5 lakh, yes. So I need to minus 5 lakhs. So from 27 I minus 5, that is 22 lakhs. And this is 30 lakhs. This is the export percentage into the profit. What is the profit? The profit is 6 lakh. So 22 lakh divided by 30 lakh into 6 lakh will give you 4 lakh 40,000. Guys, 4 lakh 40,000 is basically your deduction. Will I take the entire 100%? Yes, because the first 5 years. So 10 AA deduction is 4 lakh 40,000. Alright. Guys, this you have to explain, and hence I'll just show you. We are not solving this sum, I'm just showing you how this is to be done. Question number 11, in case you want to write, I'm just showing it to you. This one, you will first say that Messrs Rajveer has set up the SEZ unit in the year 17-18. Thus, it is eligible for a deduction of 100% of profits of the SEZ unit from export sales. So hence it is eligible for a deduction of 100% of profits of the SEZ unit from export sales. Export turnover and total turnover should not include freight charges of 5 lakh rupees. So they should not include 5 lakh rupees of charges. Therefore, export turnover divided by total turnover is equal to 27 minus 5 upon 35 minus 5 is equal to 22 divided by 30. That percentage you have to write is equal to 73.33%. Further, profits in relation to export is equal to 6 lakh into 73.33% is equal to 4,40,000. Therefore, deduction under section 10AA is equal to 100% of the above, that is 4,40,000. Guys, this is how you'll have to explain it, show it, so you get your marks. Generally, this kind of question is asked in a tabulated format while calculating your total income. But here they don't want your total income, they only want the deduction. So that's what we've given them, only the deduction. Guys, again, this is a very good sum which we are going to do in fair. This is the 12th question, 12, 13, 14 and 15. Only 4 questions away and this chapter will be completely done and dusted. While we look at this, let's first take a minute. You can pause the video at this juncture and you can do the sum yourself, try it once yourself, and then we can start doing, because there are some students who are watching this live as well. I'm just going to wait for like 5 minutes. I'm going to wait for them to first try it once on their own and then we will do. I'm just going to read it till then. Miss Aarti is a resident individual, provides the following information for the income of losses during the year. Compute the GTI of Aarti and ascertain the amount of loss that can be carried forward. Miss Aarti has always filed a return within the due date specified under 139A. She does not want to opt for 115BAC. Alright. Guys, salary income we have some PGBP income, but that is the net annual value. You know how to calculate after that. Share of profit from partnership firm in which he is a partner, you know this is exempt. Loss from specified business. Income from textile business before adjusting the following items. Current year depreciation, definitely you have to minus. Unabsorbed depreciation, you have to wait. Brought forward loss, you can minus. Between those, who will minus first, you will have to check. LTCG, LTCL, long term capital loss, unique blood. Long term capital gain, dividend and repayment. Basically, this is 80C deduction. Over to you all, take your time guys. Here there is also some interest payment, so watch out because you have some house property. So see till the end, and you don't have to see deduction. So 80C you don't have to see, you have to only see till gross total income. The next 5 minutes are yours to try, and this please do try. Exams are closed, you will have to try it on your own there. So please try 5 minutes and then we will start doing this sum. Alright guys, good try. Here let's start. Guys, income from salary is 8,20,000. So I'm just parking it over here. From house property, you have NAV of 1,20,000. I'm just going to calculate it here. 1,20,000 is the NAV. I'm calculating slightly lower. We will solve this in fair so that you get some practice. I don't see any municipal taxes honestly, but there is an interest repayment towards housing loan taken from a scheduled bank. Out of this 3,28,000, payment towards interest was payment towards interest and rest was towards payment of principal. So from 1,28,000, I will have a 30% deduction, which is 36,000, and then I can minus 3,28,000 here. There is no limit, so I can minus 3,28,000. So 1,20,000 minus 36 minus 3,28,000 will give you 2,44,000. Guys, you could also, we don't know the house value, but you can also split up between this and 80 EA if you remember. So this is a loss from house property, 2,44,000. Next, this is the exempt, so there will not be tax, there will be a note. Next, loss from specified business, 67,000. So this is PGBP, and in PGBP this is 35 AD, specified business loss, unique blood, so it will be 67,000. Next, income from textile business is 3,30,000. So this is normal business, 3,30,000. You got to minus depreciation current year, that is 53 first. So 3,30,000 minus 53,000 will give you 2,77,000. From that, which one will you minus first, guys? You will first minus brought forward loss of the previous year, so that is 1,90,000. So this is over 1,90,000, and from the remaining 87,000, can you minus 1,85,000? Yes, so I will minus the entire 87. So this becomes 0, and this 1,85,000, only 98,000 remains. I'm just writing 98,000 remains. This is unabsorbed depreciation. Long-term capital gain is 1,50,000. I don't need to care whether it listed UU etc. because they have not asked for taxes. Long-term capital loss is 1,50,000 exactly. Can I minus one against the other? Yes. And again there is a long-term capital gain of 2,50,000. So I have 2,50,000 extra gain here. This both get minus. Next, dividend from UTI is taxable now. So dividend is 1,15,000 which is taxable. That's about it. There is no other income. Now guys, let's see. Within the family we've already done, outside the family. So 2 lakh goes away from here. So 6,20,000 remains here. And they've taken 2 lakhs, so only 45,000 remains, 44, which will be carried forward. Yes, this will be carried forward to the next 8 years. This will be taxable. Next, specified loss, there is nothing, so this will be carried forward, 67,000. This is 0. 2,50,000, but there is unabsorbed depreciation which can be minus. From salaries, no. From here, yes. So 2,50,000 minus 98 will give you 1,52,000, which will now be taxed, and 1,15,000 will be taxed. So in the box 1, 2, 3 they will be taxed, and these brackets will be carried forward. Guys, this is the question. Let's try and solve it in fair. I'll show you how this is to be presented. This is Miss Aarti. Let's try and do this. This is question number 12, I think. Yes, please write question number 12. Let's start writing. Computation of gross total income of Miss Aarti for financial year 2021 in bracket assessment year 21-22. Guys, in case you're writing in your fair books where you've also written the notes, you can write this is an RTP question, RTP 2021, RTP November 21. Alright. Amount column and particulars column, so very, very important. Particulars, amount, very, very important. What we will do is first let's recap, first let's finish the entire thing and then we'll come back, guys, so that people who don't want to solve, they don't waste their time on YouTube watching this. So let's first do all the sum and we'll come back and I'll show you how to present this. So guys, this is how it is. 6,20,000 plus 1,52,000 plus 1,15,000. This is 8,87,000. Absolutely right answer. 8,87,000 is the gross total income and 2 losses are to be carried forward. This is the 12th question. Let's go to the 13th question, guys. Mr. Uday Shankar, who's 67 years old, is retired from public sector undertaking. He resides in Indore, Madhya Pradesh. He provides you the following particulars of his income and certain payments, investments for the previous year. Compute his income. Let's see what we need to compute. Compute the total income of Mr. Uday, assuming he does not offer 1/5 BSc, only total income, no tax, so only till total income. Let's do this, only till your total income. Perfect. I'm going to write his total income here, and as in when we find some incomes, we will tax it. Perfect. Let's do this. Pension income of 7,80,000, guys, is pension taxable? Yes. And it is taxable under salaries, and you get the SEP deduction also, 7,80,000, and you can get 50,000 minus also. So this is salaries income, 7,80,000. Please remember, you can also minus 50,000. Interest from fixed deposits of 2,35,000 gross. Interest from FD, guys, will this be added to IFOS? Yes. And he's 67 years old, so will he get 80 TTB of 50,000? Yes. So just remember that. So what is the interest income? 2,35,000, I think. Yes. So IFOS 2,35,000, and with that only keep in mind 80 TTB is 50,000. Only for individuals, he's an individuals, and only for resident, assuming he's a resident. Yes. We go to the next page. Chetan, whoever's joining new Drishti, guys, we are looking at RTP 21. We've finished the entire DT revision and we've also uploaded it on my YouTube channel. For any difficulties or anything, you can join the Telegram channel and you can solve your doubts there as well. Next, guys, life insurance premium paid by check 25,500 for insurance of his life. The insurance policy was taken after 1/4/2012, so hence the limit is only 10%. He's paid slightly more than 10, so his deduction under 80C, guys, will be only 10%, that is 25,000. Next, premium of 36,000 paid by check for health insurance of self and wife, who's also a senior citizen. They have 50,000 rupee limit. So in 80D, can you take 50,000? Can you take 36? Yes, 36 can be taken. 3,500 paid in cash for health checkup and 4,500 paid through check for preventive health checkup for his mother, 90 years. So 3,500 and 4,500 both can be taken. Ideally both can be taken, but guys, your limit is only 5,000. So for 80D, you can take how much for yourself? You can take 3,500, then only 1,500 for parents. Overall, you can take 5,000. Yes, overall 5,000. Guys, if you want to do it properly, I'll show you properly. Here, you have already taken 36,000. Do you have a limit of 50? Yes. So do you have 3,500 more? Yes. So for you, it's 39,500. And for your parents, you spend 4,500. Can you take that? Yes, ideally you can take that. They have a limit, but the limit of health checkup is only 5,000. Out of it, 3,500 is used, so only 1,500 rupees here. So this is how you'll have to do it. 39,500 plus 1,500, which is 41,000. So you can directly put 41,000 as well. Next, guys, but of course you'll have to show this as a working note. Next, paid interest of 9,500 on loan taken for MBA course pursued by his daughter. So can you minus that? Yes. 80E deduction, you can minus that. 8,500. If it's paid, yes, it has to be paid. A sum of 95,000 donated by check to an institution approved for the purpose of section 80G for promoting family planning. Guys, this is the third category. Sorry, this is the third category. In the third category, you have to do ATI. So you'll have to finish everything and do ATI. So let's finish everything else. 20,000 towards PM Cares Fund. These two we cannot do. We have to wait for ATI. Now guys, let's do 7 lakh 80 minus 50 is 7 lakh 30. Salary income, IFOS is 2 lakh 35. So that gives you 9 lakh 65 as the gross total income. Are both of these available? Yes, this is your gross total income. Both of these are available because there is no specific rates. And from this, guys, can I minus all of this? Yes. 9 lakh 65 minus 8,500 minus 41,000 minus 25,000 and minus 50,000 is 8 lakh 40,500. Guys, so your adjusted total income is 8 lakh 40,500. So 10% of that is 84,050. I hope this is perfectly right. 7 lakh 80 minus 50, 7 lakh 30. Yeah, this seems okay. Guys, this is your limit. Now let's see who's using the limit first. Of course, 20,000 will be taken. No problem with that. So 80G, 20,000 you can take without any limit because that's the first category, PM cares. But the second one, 80G, it's 95,000. So 95 or 84, which one, guys? 95,000. You have to first compare which is lower. The lower is 84,050, and you can take the entire thing. Yes, you can take the entire thing. 9,500. 1 second. Oh, that is 9,500. Sorry. Alright, guys, we'll have to do this once again. Sorry, my bad. So it's nothing. 8 lakh 40,500 minus 1,000. 8 lakh 39,500. This becomes 8 lakh 39,500. Into 10% will give you 83,950. I hope you've taken all the deductions also, guys. 80GE. Yes. Now you'll compare this with 95,000 and this is lower, and you'll take 100% of this. Yes, 83,950. So whenever there is third and fourth category, the entire 80G you will ignore. You will find out your ATI and then you will do this. So guys, this is your total income. Total income is 8,39,500 minus 20,000 minus 83,950 is basically 7,35,550. I've done nothing but taken this GTI and minused all these deductions. Perfect. Guys, this is your question. In the end, guys, when we get more time, I'll first finish the recording and then we'll also show you how to solve this question. Alright. Guys, this is the next one. Mr. Dheeraj. This is also computing his income, maybe tax payable also. Let's see Mr. Dheeraj. What does he want? You are required to compute his total income and tax liability on Mr. Dheeraj. So let's do this. First, let's do it orally and then I'll show you how to present this as well. Alright, one after the other, guys. Let's take the incomes. Just 1 second. Okay. Mr. Dheeraj, who's 48 years old, a resident. Just 1 second, guys. Alright. Mr. Dheeraj, who's 48 years old, a resident Indian, again has furnished the following particulars for the year ended 31st March 21. He occupies the ground floor of his residential building. So there is an SOP and there is an LOP, and has let out the first floor for residential use at an annual rent of 34,400. So this is the actual rent. He paid municipal taxes of 30,000 for the current year. Both these floors are of equal size. So here SOP, everything is nil except interest. Let's see how much is the interest. As per the interest certificate from ICAI Bank, he paid 1,80,000 as interest and 95,000 towards principal repayment for the residential building in the year 2014. Guys, I already know there is a 80C deduction of 95,000. And 1,80,000 is the interest. Out of this, I can take 90,000 here as a loss from house property. And here, let's start calculating. This is 15,000 municipal tax. Don't forget to half the municipal tax. So 3,34,000 minus 15,000 is 3,19,000. From that you minus 30%, that is 95,700. From that you minus another 90,000 for interest, and that's how you'll get your income from house property. 3,19,000 minus 95,700 minus 90,000 will give you 1,33,300. This is your income, this is your loss, minus 90,000 will give you 43,300. Just let's check the numbers once. 3,34,000 minus how much is municipal tax? 15,000. 3,19,000 into 70% minus 90,000. Yes, perfect. So 43,300 is your income from house property. Guys, I'm removing all of this and I'm just keeping 43,300 as your income from house property because of lack of space. Income from house property 43,300. Yes, 43,300. Done with the first and the second point. He owns an industrial undertaking established in SEZ and which had commenced operation during the year 1819, so the first 5 years. Total turnover was 400 lakhs, which includes 120 as export. The industrial undertaking fulfills all the condition of 10A. Profit is 45 lakhs. So PGBP, guys, you have to put 45 lakhs here. And in 10AA, you will put 100% of the export profit. What is the export profit? 120 divided by 400 into 45. So 120 divided by 400 into 45 will give you 13,50,000. Guys, I'm showing you how to present it also, but right now let's do it quickly so that people who want to revise everything quickly, especially this video on YouTube one day before the exam, can revise it. This one I put the deduction also, nothing else from here. He employed 20 new employees for the said industrial undertaking during the year 2021. Of the 20 employees, 12 were employed on 1st of May for a monthly emolument of 18,000. So 12 into how much is the salary? 18,000 into April and May, so 11 months. And the remaining were on 1st of August. So if you see August, have you completed 240 days? August, September, October, November, December, Jan, Feb and March. Yes, you have completed. So those also 12,000 into 8. So 8 employees into 12,000 into August, September, October, November, December, Jan, Feb, March, 8 months. So on this you'll get 30% reduction under 80 JJAA. Guys, this one is 12 into 18,000 into 12 into 18,000 into 11 into 30%, which is 7,12,800, and 8 into 12,000 into 8 into 30% is 2,30,400. So this is your 80 JJAA deduction plus 7,12,800. So 9,43,200. This is 9,43,200. Guys, you are auditable. Yes, his turnover will be high. He must be auditable. That's for somewhere we'll have to assume, and we have to assume that he's also contributing to their PF. Perfect. All right. Definitely auditable, guys, because his turnover is very, very high. Yes. Okay. He earned 30,000 and 45,000 as interest on saving bank and fixed deposits. So 30 and 45 is 75,000. I'm writing IFOS is 75,000. And guys, he's 48 years old, so he'll get 80 TTA of 10,000. Do it simultaneously so you never forget. And last, guys, he also sold his vacant land on the 1st of December 2020 for 13 lakhs. The stamp duty value was 14 lakhs. So 13 into 110% is 14 lakh 30. So we are perfectly right with the sale consideration of 13 lakhs. The FMV of the land as on 1st of April 2001 was 4.5 lakhs. Stamp duty value was 4 lakhs. So the limit is 4 lakhs, the ceiling. So cost is 4 lakhs. The land was acquired by him in 1997. He incurred registration charges. So 2,80,000 plus 12,000 is 2,92,000. So you will obviously take 4 lakhs. The cost inflation is 100 and 301. So we'll do that. 100 and 301. So 4 lakh divide by 100 into 301 will give you 12 lakh 4,000. So this is 96,000, but remember this is at a flat rate of 20% and this is unavailable for GTI or deductions. So this is capital gain, long-term capital gain, and this is 96,000. They has to be taxed at the rate of 20%. Anything else, guys? Let's check. He paid insurance premium 49,000 towards life of his son who is not dependent on him, doesn't matter. Assuming it is within the limits, 49,000 I can minus under 80C. I already have 80C, I'm just putting 49,000 to it. So total 80C is 95 plus 49 is 1,44,000. Can I take 1,44,000? Yes, I can. So this is 1,44,000. Alright, so let's start doing the calculations. This is the gross total income. 43,300 plus 45 lakh plus 75,000 plus 96,000 will give you 47 lakh 14,300. You don't have to round it off. From this minus 96,000. So basically your available one is, I'm just putting in bracket, 46 lakh 18,300. This much is available. Your deductions cannot be more than this. Check. Your deductions are not more than this, definitely. So I'll minus all the deductions. So 47 14,300 minus 13 lakh 50 minus 1 lakh 44 minus 943,200 minus 10,000 is equal to 22,67,100. That is your total income. Watch out, guys. This total income of 22,61,100, now you have to find out the tax. Guys, please tell me, in this case, is there anything which is at a flat rate of tax? Yes, 96,000, which is at 10%. So remaining 21,71,100 is at normal rates. Yes, PGBP, IFOS, everything is normal. So this is 9,600 basic tax on 21,71,100 minus, if you calculate, you'll get 4,63,830. How do you get this? On the first 2.5 lakh, nothing, because he's 48 years old. From 2.5 to 5 to 5 to 10 and 10 to 21,71,100 is this, plus 9,600 is that is basic tax. Yes, 4,73,430. On that, will there be any surcharge? No, because income is 22 lakh, but there will be cess. So into 104%, which is 4,92,367.2. Ignore in percentage, 4,92,370. This is the total income and this is the tax payable. Guys, I hope this is clear. Absolutely good question. Can be there in your exam for 14 marks, definitely. As in when you see a deduction, put it. As in when you see something, put it down. So keep it ready for solving it ahead. Now moving to the last question, guys. Guys, but here, do you also have to check AMT, alternate minimum tax? Yes, guys. Because do you have 10 AA deduction? Yes. And do you have 80 JJ deduction? Yes. So you also have to check alternate minimum tax. Let's try and see how do you check alternate minimum tax. You take your total income, that is 22,67,100. You add both these. So 13,50,000 I will add and 9,43,200 I will add. So I will get 22,67,100, 22,67,100 plus 13,50,000 plus 943,200, which will give you 45,60,300. On this 18.5%, this should be more than 20 lakhs. Yes. So 8,43,655.5. On that surcharge, there will be no surcharge, but cess, yes, 104% will give you 8,77,401.72. Ignore this, which will give you 8,77,400. Is this more? Yes, it is more. So will you pay that? Yes, you will pay alternate minimum tax. Alright, we come to the last bit. 15A and 15B, and that's the end of your RTP. Mr. Ayansh, who's a resident individual, is a dealer of garments. During the year, his total turnover of his business is 105 lakhs, out of which 15 lakhs was received by account paychecks, so a lot of cash, so hence definitely auditable. Mr. Ayansh does not opt to pay tax as per the provision of 115 BSc. What would be your advice to Mr. Ayansh relating to the provisions of advance tax with the due date along with the amount payable, assuming he wishes to make maximum tax savings without getting his books audited? If you don't want your books audited, then can you fall under 44 AD? Yes, he is an individual resident and his total turnover is up to 2 crores, so he can fall under, but for that he has to show on 15 lakhs he can show 6%, and on the remaining 90 lakhs he has to show 8%, and whatever is his tax liability, so 15 lakh into 6%, that is 90,000, and 90 lakh into 8%, that is 7,20,000, plus 90,000 is 8,10,000. On that you have to calculate his tax liability. Let's calculate his tax liability. He is 35 years old, so 12,500 up to 5 lakhs plus 3,10,000 into 20% will give you 62,000, which is 74,500. No surcharge but cess, so 77,480. This is more than 10,000, so will there be any advance tax liability? Yes, but because it's under 44 AD, there's only one installment of 15th March, 100% by 15th March. Can Mr. Raghuram file his return for the year 21-22 belatedly under section 139(4) in the previous year 22-23? Yes. Sorry, 1 minute. Assessment year is 21-22. Can you file it in the next year? No. If he has failed to file the said return on or before the due date of the return for the year 21-22 due to inadvertent errors, no. You can file it late, but you can't file it so late. You can file it only in the assessment year up to 31st December 22. And specify the consequences of late filing. If you file it late, what are the consequences, guys? Life. Losses will not be allowed to be carried forward. There will be interest under section 234A on the tax payable if any, and there will be a late fee of up to 5,000, not up to 5,000, late fee of 5,000, but if the total income is up to 5 lakh, then there will be a late fee of 1,000 rupees. This will be your answer. This is your RTP, this is your DT, and this is our one shot revision. Super revision, guys, super. Thank you. I'm just going to stop the recording here.